Hello my dear learners, so how are you all? I hope all of you are fit and fine. In the previous video, as we have gone through the overview of the topics that we are going to discuss in this particular chapter, now we are going to start the chapter with the first topic, that is, what is demand? Or you can say, meaning of demand. So let's discuss what is demand. See, if we ask a layman, that is a person who is not having the knowledge of economics, to define demand, he will simply say that demand means desire. What is desire? Desire here means want or wish to have something which is not with us right now. That is, you want to purchase something which you are not having right now. For example, Ram is having iPhone 13 right now. He is a college going boy and now he wants iPhone 14 Pro. So, he asked his father to get him iPhone 14 Pro. So, here we can see that Mr. Ram wants to purchase iPhone 14 Pro, which he is not having with him right now, right? So, he requests his father to get him iPhone 14 Pro. The request by Mr. Ram to his father to get him iPhone 14 Pro is basically the demand done by Mr. Ram to his father. So in the layman language, demand means the desire, or you can say wish or want to have something which is not with us right now. But if we talk about economics, then demand is not only about desire, but demand is the combination of three terms, and those are desire, purchasing power, and willingness to pay. Willingness to pay. So basically demand is a combination of all these three items. That is, demand is equal to desire plus purchasing power plus willingness to pay. So let's understand all these items one by one. First, desire. As we have already discussed, desire means want or wish to purchase something which you are not having right now. For example, if I want to buy an i20 car, then this is my desire, right? Next, purchasing power. Now what do you mean by power? Power means the ability. So what is purchasing power? As the name suggests, purchasing power means whether you have the power to purchase a particular commodity or not. Will you be able to purchase a particular commodity or not? So basically the purchasing power of every individual depends on the amount of money that he or she is having. Let's understand the purchasing power with the help of an example. Let's extend this example to understand about the purchasing power. See, as I told you, I want to buy an i20 car. So I'm having the desire, right? And let's suppose I am having 10 lakh rupees in my bank account. This is my bank account. And I am having 10 lakh rupees in my bank account. And the price of i20 car is, rupees 8 lakhs. Since the price of i20 car is 8 lakh rupees and I am having 10 lakh rupees in my bank account, that means I can buy i20 car. as I need 8 lakh rupees to buy I-20 car and I am having 10 lakh rupees in my bank account. So I can easily buy I-20 car. This means I am having the purchasing power of I-20 car. So purchasing power basically depends on money. If you are having the enough money, then you can buy a particular commodity. If you are not having the money, then you cannot buy a particular commodity. Students, here please note that money is basically means to purchase. Means to purchase. Now what do you mean by means to purchase? Means to purchase basically refers to the resources required to buy anything. For example, if I want to purchase an I-20 car, I require money, right? So money is a means to purchase. Okay. So basically it is the means to purchase that will determine your purchasing power. If you are having the means to purchase, that means you are having the purchasing power. And if you are not having means to purchase, then that means you are not having the purchasing power. Now, the third element is willingness to pay. Willingness to pay means desire to make payment. Let's understand it with the help of the example. As I told you, I want to buy an I-20 car. So this is my desire. Next, price of I-20 car is 8 lakh rupees, right? And I am having 10 lakh rupees in my bank account. Next, the third term is willingness to pay. Now to understand what is willingness to pay, let's go back to the example. As I told you, the price of I-20 car is rupees 8 lakh, right? And I am having 10 lakh rupees in my bank account. So I can purchase I-20 car very easily, right? I can use 8 lakhs out of the 10 lakhs in my bank account to purchase I-20 car. But what if I am planning to spend this 10 lakh rupees on my sister's marriage? Then what do you think, students? Will I be able to purchase the I-20 car? Then no, I will not be able to purchase the I-20 car. So students, having 8 lakh rupees is not enough, or you can say having the money is not enough. So you can say having 8 lakh rupees to buy I-20 car is not enough. You must have the mindset also to spend that 8 lakh rupees on the purchase of I-20 car. Only then you can purchase the I-20 car. But if you are planning to use your money for any other purpose apart from buying the I-20 car, then you cannot purchase I-20 car, right? So having money is not enough. You must have the mindset also to spend your money on a particular commodity. For example, I can buy I-20 car only if I am having the mindset to spend this 8 lakh rupees to purchase I-20 car only, right? So that means I am having the willingness to pay. Here, willingness to pay means the mindset to use the means to purchase for the purpose of purchasing a particular commodity. Okay. So whenever the three elements are combined together, then only it will lead to demand. Let's understand some few examples to understand the combination of all these leads to demand. Students, let's talk about Mr. Ram first. Mr. Ram wants to buy an iPhone 14, but he is not having the enough money to buy iPhone 14. That means he is not having the purchasing power. Although he is having the desire, but he is not having the purchasing power. So, what do you think? Does Mr. Ram can demand iPhone 14? No, right? Because the element of purchasing power is missing here. Now, let's talk about Mr. Sham. Mr. Sham wants to purchase iPhone 14. That means he is having the desire, right? Second thing, As we know that the price of iPhone 14 is 1,25,000 rupees around, right? And he is having 5 lakh rupees in his bank account. That means Mr. Sham is having the means to purchase also. So Mr. Sham is having the purchasing power also. But Mr. Sham wants to spend 5 lakh rupees of his bank account for attaining his further education. So Mr. Sham is not having willingness to pay, right? That is, he is not having the desire, or you can say he is not having the mindset to use the means to purchase to buy iPhone 14, right? So the third element is missing here. So Mr. Sham cannot demand iPhone 14. Now let's talk about Mr. Ashok. Mr. Ashok is having 1 crore rupees in his bank account. Okay. That means he can easily buy iPhone 14, right? But he doesn't wish to buy iPhone 14. That means he is not having the desire to buy iPhone 14, right? Although he is having the purchasing power. So students, what do you think? Will Mr. Ashok purchase iPhone 14? No, he will not. Why? Because we only purchase those things which we desire to, right? Although he is having the purchasing power, but he is not having the wish to buy iPhone 14. So he will not purchase iPhone 14. So Mr. Ashok will not demand iPhone 14. Because the first element, which is desire, is basically missing. So from all the three examples, what we can see that even if one element is missing out of the three elements, then demand is not possible. Demand is possible only when all the three elements are there. For example, I will be able to buy an i20 car only when I am having the desire to buy it. Also, I am having the purchasing power, or you can say means to purchase for i20 car. And the third one, I am having the willingness to use my means to purchase for buying i20 car, right? So with all the three elements, I will be able to buy an i20 car. So now, how would we define demand? So demand is basically that desire which is backed by. Backed by means supported by. Supported by the purchasing power and willingness to pay the price. Okay. So students, now the question arises about how to define demand. So as we can see, the demand is not only the desire alone, but the desire in combination with purchasing power and willingness to pay, or you can say willingness to pay the price of the commodity, constitutes the demand, right? So we can say that demand is that desire which is backed by. Backed by means supported by, or you can say in combination with, supported by the purchasing power and willingness to pay the price. Okay. So students, let's go through the meaning of demand. Demand means desire. This is according to the layman, right? But in economics, demand means desire backed by the purchasing power and willingness to pay the price. So let's recall it. Demand means desire, but in economics, demand means desire backed by the purchasing power and willingness to pay the price. Next, we have requirements for an effective demand. Here, effective demand means actual demand. So, for actually demanding the good or a service, what do we require? We require the three things that we have already discussed. And those are, first, desire. Second, means to purchase. Third, willingness to use those means to purchase. Please note it down till here. So let's recall it. Requirements for an effective demand. First, desire. Second, means to purchase. Third, willingness to use those means to purchase. So students, this is all about the first meaning of demand. In our next video, we will discuss about the second meaning of demand. We have gone through the meaning of demand. Demand is basically desire, which is backed by, or you can say supported by the purchasing power or means to purchase and willingness to pay the price. That is, willingness to use those means to purchase for purchasing the commodity or any service. Now in this video we are going to discuss the another meaning of demand. So let's get started. See students, whenever someone asks you about how much price do you purchase for your home? How much rice do you purchase for your home? Okay, then how would you answer? You'll definitely answer like this, 10 kgs or 5 kgs or 2 kgs, right? That means in your answer about how much rice do you purchase for your home, you will tell the quantity. As without quantity, the question to this answer is not possible, right? So without quantity, we cannot tell the demand of anything, right? Next element that we need to mention is basically the price of rice. Now why I need to mention the price of rice? See, let's understand it with the help of an example. Let's suppose right now you are purchasing 5 kgs of rice at 10 rupees per kg. Basically 10 rupees per kg is the price of the rice. Now the price of rice increased to 120 rupees per kg. Now the rice has become costly, right? So since it become costly, now you are going to purchase the less quantity of rice. You might have reduced the quantity from 5 kgs to 3 kgs, right? And let's suppose if the price is being decreased to 80 rupees per kg, then the rice will become cheaper for you, right? So now you will purchase more quantity than before. You will purchase more quantity of rice than before. Let's suppose you will purchase 7 kgs, right? So what have you seen that the consumer purchases 5 kgs of rice at the rate of 100 rupees per kg. And when the price increases to 120 rupees per kg, then the consumer start purchasing 3 kgs of rice. And when the price decreases to 80 rupees per kg, then the consumer purchases 7 kgs of rice, right? So we can see that at different prices of rice, there will be different quantity demanded, right? So we need to mention the particular price at which the consumer is demanding 5 kgs. Because at different prices, the quantity demanded would be different. So that's why it is important to mention the price of the commodity for telling the demand. Next, we need to mention the time, or you can say period of time. That is, for what time period we are demanding 5 kgs of rice at the rate of 100 rupees per kg. See students, if I ask you, how much rice do you purchase for your home? You will tell me, ma'am, 5 kgs. Then various questions will arise in my mind. Is he purchased 5 kgs for a month, or for a week, or for a day, or for a year, right? For what time period he is purchasing 5 kgs of rice at the rate of 100 rupees per kg. Since demand is basically linked with the period of time, right? Now, what is period of time? Period of time means length of time, like 1 day, 1 week, 1 month, quarter, right? So we need to mention the time period also, because demand is linked with the time period. And whatever is linked with the period of time, that is called flow. So we can say that demand is a flow concept. So students, we have seen that there are 3 things to mention while telling the demand to someone. First one is quantity, second one is price of the quantity, and the third one is time period, right? For example, Mr. Ram purchases 5 kgs of rice at the rate of rupees 100 per kg in a month. So here you can see that 5 kgs is the quantity, 100 rupees per kg is the price of the rice, a month is basically the time period. Okay, so this is a perfect way to define the demand to someone, that you tell the quantity, price and time period also. So using this example, how would you define the demand of rice by Mr. Ram? That Mr. Ram demands 5 kgs of rice at the rate of 100 rupees per kg in a month. So what is demand? Demand is basically the quantity of the good that a consumer is willing, or you can say is able to buy. You can see that Mr. Ram is willing and able to buy 5 kgs of rice, right? So demand is the quantity which the consumer is willing and able to buy. At the rate, you need to mention a particular price also. At a particular price, right? Which is 100 rupees per kg, and in a month, you need to mention a particular time period. Particular time period. Students, so let's note down the meaning of demand. Demand is that quantity of the good or service which a buyer is willing to buy, that is want to buy, and able to buy, that is he is able to purchase at a particular price, that is at a specified price during a particular period of time, that is specified period of time. For example, Mr. Sham purchases 10 kgs of wheat at the rate of rupees 50 per kg in a week. So here, this is the quantity, that is 10 kgs of wheat. Price of the wheat is 50 rupees per kg. So Mr. Sham is purchasing 10 kgs of wheat at the rate of 50 rupees per kg, or you can say when the price of the wheat is 50 rupees per kg in a week. So a week, that is 1 week, is basically the time period. So here I have specified that what quantity of wheat Mr. Sham wants to purchase and is able to purchase at a particular price. Here the particular price is 50 rupees per kg and during a particular period of time. Here the particular time period is a week. Particular time period. So I hope students this meaning of demand is clear to you. Now students, there are some points to be noted about quantity demanded. So let's discuss the points to note about quantity demanded. As already discussed, the quantity demanded is always expressed at a given price, right? Or you can say at a particular price. Now, why the quantity demanded is always expressed at a particular price? It is because at different prices, there are different quantities of the good which is demanded, or you can say different quantities of a commodity which is demanded. So let's recall it. The quantity demanded is always expressed at a given price. At different prices, different quantities of a commodity are generally demanded. Next we have the quantity demanded is basically a flow concept. As we already discussed, that quantity demanded is a flow concept because the quantity demanded is linked with the particular time period, right? So we must express demand as so much per period of time. For example, 4 dozen of oranges per week, right? So in a week, a consumer demands 4 dozens of oranges. So here, 1 week is basically a period of time. So while expressing the demand, we need to link the quantity with the time period. So let's recall it. The quantity demanded is a flow. We must express demand as so much per period of time. For example, 4 dozens of oranges per week. So I hope students the meaning of demand is clear to you. So demand is basically a quantity which a consumer is willing and able to buy at a particular price during a particular period of time. And basically demand is a flow concept as it is linked with a particular period of time. So students, this is all about the meaning of demand. In our next video, we will discuss about the determinants of demand, that is factors affecting demand in detail. Hello my dear students, so how are you all? I hope all of you are fit and fine. In the previous video, we have gone through the meaning of demand, and in this video, we are going to discuss about the another topic which is related to demand, that is determinants of demand. Now, what do you mean by the word determinants? Determinants means factors affecting. Factors affecting. What are determinants of demand? Determinants of demand means factors affecting demand. Or you can say determinants of demand refers to the factors which can change the demand of a particular commodity. That is, the factors or the items which can increase or decrease the demand of a particular commodity. So, as we have already discussed under the example of rice, that when the price of rice is 100 rupees per kg, then the buyer purchases 5 kgs of rice in a month. And when the price of rice increases from 100 rupees per kg to 120 rupees per kg, then the consumer demands 3 kgs of rice. And when the price of rice decreases to 80 rupees per kg, then the consumer demands 7 kgs of rice. So here we can see that when the price of rice increases, then the quantity purchased of rice, that is demand for rice, decreases. And vice versa. Vice versa means the opposite stands true. That is, if the price of rice decreases, then the demand for rice will increase. Right? So here we can see that the price of rice affects the demand for rice. Whenever the price of rice increases, the demand for rice decreases. And whenever the price of rice decreases, the demand for rice increases. So here we can say that price of rice affects the demand for rice. So in general, we can say that price of the commodity affects the demand for the commodity. Okay. That is, if the price of the commodity increases, then the demand for that commodity decreases. And when the price of the commodity decreases, then the demand for that commodity increases. Okay. So price of the commodity is one of the factors that affect the demand of a commodity. And apart from the own price of the good, there are various other factors also which affects the demand of a particular commodity, and those factors are known as determinants of demand. So let's first have an overview on the list of the determinants of demand, that is the factors affecting demand, or you can say the factors influencing the demand of a particular commodity. And later we are going to discuss about these determinants in detail. So we'll first have the look on the list of the determinants of demand, that is the factors affecting demand. First, price of the commodity, already discussed. Price of the commodity here refers to the price of the commodity itself, or you can say own price of the commodity. We can say that whenever the price of the commodity increases, the demand for the commodity decreases, and vice versa. Next, price of related commodities. Now, apart from the price of the good itself, or you can say price of the commodity itself, price of related commodities also affect the demand of a particular commodity. Now, what are the related commodities? Related commodities are complementary goods, and substitute goods. There are basically two types of related goods, complementary goods and substitute goods. Later I will let you know what are complementary goods and what are substitute goods. So the price of complementary goods and the price of substitute goods affect the demand of a particular commodity. Next, disposable income of the consumer. Now, what is the disposable income of the consumer? Disposable income of the consumer is the income which is left after paying taxes to the government and left after important deductions. So basically, disposable income of the consumer also affects the demand of a particular commodity. Next, taste and preferences of buyers, that is likings and selections of buyers also affects the demand of a particular commodity. Next, consumers' expectations. Now, consumers' expectations about the future prices, about the supply of the commodity also affects the demand of a particular commodity. Next, other factors. Now, what are included under other factors? Size of population. Size of population also affects the demand of a particular commodity. Size of population refers to the total number of individuals living in a particular country. Next, age distribution of population. Age distribution of population here refers to the composition of population. That is, proportion of individuals under different age groups included in the population. That is, how many children are there, how many working age adults are there, and how many senior citizens are there in the population constitutes the age distribution of population. Next, the level of national income and its distribution. Now, what is national income? National income is basically the income earned by the country within the country and outside the country, right? Or you can say the income earned by the residents of the country within the country and outside the country. So, the level of national income, that is the amount of national income, also affects the demand for goods and services. And how the national income is being distributed, or you can say how the national income is being allocated among the members of the country, also determines the demand for the goods and services. Next, consumer credit facility and interest rate. Now, consumer credit facility means the finance facilities which are provided to the consumers. That is the loan facilities provided to the consumers. Now, consumer credit facility also affects the demand for goods and services. Moreover, the interest rates which are charged for providing the credit facility to the customers, or you can say consumers, also determines the demand for goods and services in the country. Next, government policies and regulations also affect the demand for goods and services in the country. What are government policies and regulations? Government policies and regulations are the rules and regulations framed by the government in order to administer or to manage the entire country. For example, taxation policy of the government, and subsidy policy of the government, etc. So here in this video we have gone through the list of the determinants of demand. Let's recall the list once again. Determinants of demand: price of the commodity, price of related commodities, disposable income of the consumer, taste and preferences of buyers, consumers' expectations, size of population, age distribution of population, the level of national income and its distribution, consumer credit facility and interest rates, government policies and regulations. So this is the list of the determinants of demand. So in this video we have gone through the overview of the determinants of demand. In our next video we are going to discuss about all these determinants one by one in detail. Hello my dear students, how are you all? I hope all of you are fit and fine. So in our previous video we have gone through the overview of the determinants of demand. Now we are going to discuss about the determinants of demand in detail. So we will first talk about the price of the commodity as a determinant of demand in this video. So let's talk about the first determinant of demand, which is price of the commodity. The price of the commodity is also known as price of the commodity itself. Price of the commodity itself. Or you can say own price of the commodity. Now let's see how the price of the commodity affects the demand of a particular good. See, the consumers always purchase the commodity by considering the price of that commodity. Or you can say the consumers takes the buying decision by considering the price of the commodity. Whenever the price of the commodity increases, then the commodity becomes costly for the consumers. So they purchase less quantity of that particular commodity. So quantity purchased, or you can say demand of that commodity will be reduced. And whenever the price of the commodity decreases, then the commodity becomes cheaper for the consumers and the consumers will purchase more quantity of that particular commodity. That is, the demand for that particular commodity will increase. For example, if you go to BBA showroom to purchase the kurtis, right? And before leaving for the showroom from your home, you had decided that you will purchase one kurti of BBA. Okay? And after reaching the showroom, you came to know that the BBA is providing 50% off today on all the kurtis. So now the kurtis become very cheaper for you today, right? Because all the kurtis will be available to you on half rate. For example, if price of one kurti, or you can say MRP of one kurti is 2000 rupees, then it will be available to you at 1000 rupees, right? So the kurti has become cheaper for you today, right? So you will purchase two kurtis instead of one. So why you increase the quantity purchased of kurtis? It is because the kurtis are cheaper because of the discount on them. Okay. So this is the example that shows whenever the price of the commodity decreases, then the quantity purchased, or you can say the demand for that particular commodity increases. Okay. Now let's mold this example to understand the another aspect of the relationship of price and demand. Now let's suppose you left your home for the BBA showroom and before leaving the home you had decided that you will purchase two kurtis from BBA showroom. As your friend told you that BBA is providing 50% off on all the kurtis. Okay. But when you reached the showroom, you came to know that the discount offer was valid till yesterday and from today onwards there is no discount. So now the kurtis will be costly for you and you will purchase only one kurti instead of the two. Why? Because now the kurtis are costly for you, right? So whenever the price increases, the quantity purchased, or you can say demand of that particular commodity decreases. So from the example, it is clear that whenever the price of the commodity increases, its quantity demanded decreases, and whenever the price of the commodity decreases, its quantity demanded increases. That is, both the price of the same commodity and the demand of the same commodity moves in the opposite directions, right? And whenever two variables move in the opposite directions, then that relationship is known as negative or indirect or inverse, or you can say opposite. So there is a negative or indirect or inverse or opposite relationship between the price of the good and its quantity demanded, or you can say demand. Always remember that I'm talking about the same commodity. Whenever the price of the same commodity increases, its quantity demanded decreases, and whenever the price of the same commodity decreases, its quantity demanded increases. For example, let's talk about this digital pen. If the price of this digital pen will increase, the quantity demanded of this digital pen will decrease, and vice versa. So let's recall price of the commodity. The demand for a commodity is inversely related to its price. Okay. This implies a rise in the price of a commodity brings about a fall in the quantity purchased, and vice versa. So let's recall it. The demand for a commodity is inversely related to its price. It implies that a rise in the price of a commodity brings about a fall in the quantity purchased, and vice versa. So students, this is all about the price of the commodity as a determinant of demand. Now we are going to discuss about the price of related commodities as a determinant of demand. That is, we are going to discuss about how the price of related commodities affects the demand of a particular commodity. So to discuss about how the price of related commodities affects the demand of a particular commodity, we should first have the knowledge of related commodities. So let's talk about what are related commodities. Now to understand what are related commodities, we first need to understand the two types of related commodities, and those are first complementary goods and the another one is competing goods, or you can say substitutes or substitute goods. Okay. So there are basically two types of related commodities. First is complementary goods and the another one is substitute goods. So in this video, we are going to understand the meaning of complementary goods and how the price of complementary goods affects the demand of a particular commodity. And what are substitute goods and how the price of the substitute goods affect the demand of a particular commodity. So let's begin the discussion. Students, as already discussed, there are basically two types of related goods. Related goods are also known as other goods. And there are two types of related goods, or you can say there are two types of other goods, and those are complementary goods and substitute goods. Now let's understand what are complementary goods. See students, if you are at your home, okay, and you want to visit your friend's home, and you are having your car at home, but there is no petrol in the car. So can you travel from your home to your friend's home with the use of car without petrol? So definitely no, right? So if you want to travel from your home to your friend's home, you must have the car with the petrol, right? So we can say that car and petrol are the goods which are used together to satisfy your human want. Here the human want is that you want to travel from home to friend's home, right? So car and petrol are used jointly to satisfy a human want, right? So complementary goods are basically those goods which are used jointly goods which are used jointly to satisfy a human want. For example, car and petrol. Another example of complementary goods is bread and butter. Okay. Now let's talk about the substitute goods. Let's suppose you go to the market and you ask the shopkeeper to give you Pepsi. And the shopkeeper said, the Pepsi is not available today. So what you will say? You will say, then no problem, give me Coke. Right? This means that if Pepsi is not available, then you can use Coke in place of Pepsi in order to satisfy your want. Right? Similarly, if Coke is not available, then you can use Pepsi in place of Coke in order to satisfy your human want. Same happens with Munch and Perk, right? Munch and Perk. Whenever the chocolate of Munch is not available, then you can have Perk, right? And whenever the Perk is not available, then you can have Munch in place of Perk in order to satisfy your want, right? So, substitute goods. As the name suggests, substitute means replace. So, these are basically those goods which can replace each other. For example, Pepsi can replace Coke, Coke can replace Pepsi, Munch can replace Perk, Perk can replace Munch, right? So, these are those goods which can be used in place of each other, or you can say which can replace each other in order to satisfy human want. Because these goods provide the same level of satisfaction. That's why the consumer is indifferent between the two. I can have either Pepsi or Coke because both Pepsi and Coke provides me the same level of satisfaction. That's why for me, both Pepsi and Coke are substitutes of each other. So substitute goods are basically those goods which can be used in place of each other. For example, Pepsi and Coke, Munch and Perk, tea and coffee, etc. So students, on the basis of the types of related goods, we can say that related goods are basically those goods which have some relation between them. That is, either they are used jointly to satisfy the human want or used in place of each other to satisfy human want. Okay. So this meaning is nothing but a combination of the meaning of the complementary goods and the substitute goods. Because related goods includes two types of goods, and those are substitute goods and complementary goods. So related goods are those goods which have some relation between them. And what type of relation is there? The relation can be that the both goods are either used jointly to satisfy the human want, or both the goods used in place of each other to satisfy the human want. So I hope the meaning of related goods and the meaning of complementary goods and substitute goods are properly clear to you. Students, let's go through the content given in the PPT regarding whatever we have discussed till yet. So, price of related commodities. Related commodities are basically of two types, right? And those are first complementary goods and the second one is competing goods or substitutes or substitute goods. Substitute goods are also known as competing goods or substitutes, or you can say the synonyms of substitute goods are competing goods as well as substitutes. Next, complementary goods. Complementary goods are basically those goods which are brought or consumed together. that is which are purchased together, or you can say purchased simultaneously. Simultaneously means together, right? Or you can say used jointly. These are purchased together because these are used jointly. So, for example, tea and sugar, automobile and petrol, pen and ink. So as we know that tea and sugar are consumed together, that's why tea and sugar are the examples of complementary goods. Same with automobile and petrol. Like we had discussed the example of car and petrol, right? Here car is an automobile. And pen and ink. You are having the pen but there is no ink. Then you will not be able to write anything, right? So you always require a pen with the ink in order to write down something, in order to prepare your notes, right? So pen and ink are used together. So these are also the complementary goods. So let's recall it. Complementary goods are those goods that are brought or consumed together or simultaneously. For example, tea and sugar, automobile and petrol, pen and ink. Next, we will talk about the substitute goods. Two commodities are called competing goods, or you can say substitutes of each other when they satisfy the same want, right? And can be used with ease. That is, can be used easily in place of each other. Or you can say can be replaced easily. Okay? For example, you can either use the tea or coffee, right? And you can either use the ink pen or ball pen to prepare your notes. So ink pen and ball pen are the substitutes of each other. So let's recall it. Substitute goods. Two commodities are called competing goods or substitutes when they satisfy the same want and can be used with ease in place of one another. For example, tea and coffee, ink pen and ball pen, etc. So students, now we have gone through the meaning of related goods as well as the meaning of substitute goods and complementary goods. Now we will discuss about how the price of related goods, that is the price of the complementary goods and the price of the substitute goods, affects the demand of a particular commodity. So let's first discuss how the price of complementary goods affects the demand of a commodity. So students, let's take the example of bread and butter to understand about how the price of complementary goods affects the demand of a commodity. See, please note here that whenever we talk about how the price of complementary goods or the price of substitute goods affects the demand of a commodity, or how the price of related goods affects the demand of a commodity, then in these cases, we need to highlight the relationship between the price of one good and the demand of another good. For example, in case of bread and butter, we need to highlight the relationship about how the change in price of bread affects the demand for the butter. Okay, so let's get started. Now, let's suppose the price of bread increases. Okay, now as a result of increase in price of bread, now the bread becomes costly for the consumers. So the consumers will consume less quantity of the bread. So we can say that quantity demanded of bread will decrease, right? Now, as a result of decrease in quantity demanded of bread, the demand for butter will decrease. Demand for butter will also decrease. Why? It is because bread and butter are used jointly. So, if the consumers are consuming less quantity of bread, then definitely they will consume less quantity of butter also, because both are used jointly. Now, let's take the another aspect. Let's suppose if the price of bread decreases. Now, when the price of bread decreases in the market, then the bread will become cheaper for the consumers. So the consumers will purchase more quantity of bread, or you can say the quantity demanded bread will increase, right? So now as the consumers are consuming more quantity of bread, so they will require more butter also. Why? Because both bread and butter are used jointly to satisfy the appetite, right? So the demand for butter will increase, right? So here we can see that when the price of bread increases, then the demand for butter decreases, right? And when the price of bread decreases, then the demand for butter increases. So we can say that there is opposite, or you can say inverse, or indirect, or you can say negative relationship between the price of one good and the demand for another good in case of complementary goods, right? So this is the relationship between the price of one good and the demand for another good in case of complementary goods. So let's recall it. When two commodities are complements, that is when two commodities are complementary goods, a fall in the price of one good will lead to increase in demand for another good and vice versa. Vice versa means here that a rise in price of one good will lead to decrease in demand for another good. So there is an inverse relation between the demand for a good and price of its complement. So let's recall it. When two commodities are complements, a fall in the price of one good will lead to increase in demand for another good and vice versa. There is an inverse relation between the demand for a good and the price of its complement. So students, till now we have gone through the price of complementary goods as a determinant of demand. Now we are going to discuss about the price of substitute goods as a determinant of demand. That is, we are going to discuss about how the change in price of substitute goods will affect the demand of a particular commodity. So let's take the example of Pepsi and Coke in order to understand the price of substitute goods as a determinant of demand. Before understanding this example, we should know that in economics we study the behavior of the rational people. Rational people means the people who are very sensible, that is, who focus on saving even 1 rupee also. So now let's suppose that the price of Pepsi and Coke is 10 rupees. Okay. So the consumer will be indifferent between the two. That means the consumer will purchase either the two, right? The consumer can either purchase the Coke or the consumer can either purchase the Pepsi, because both are available at the same price, that is 10 rupees. Now let's suppose the price of Pepsi increases to 11 rupees, but the price of Coke will remain same, which is 10 rupees. So now we can see that in comparison to Coke, Pepsi has become costly now, right? Or you can say the Coke has become relatively cheaper than Pepsi. What does it mean? That if we compare the Coke with Pepsi, then Coke is cheaper than Pepsi, or you can say Coke is cheaper as compared to Pepsi. So Coke has become relatively cheaper. So the consumers who were earlier purchasing Pepsi now will purchase Coke in place of Pepsi, because both the goods are substitutes of each other. That means both the goods will give the same satisfaction to the consumer. So the consumer will save his 1 rupee by consuming the Coke in place of Pepsi. because he will get the same satisfaction, and by getting the same satisfaction, he can save the 1 rupee also. So, the demand for Coke will increase whenever the price of Pepsi will increase. So, let's see. When price of Pepsi increases, then the quantity demanded for Pepsi will decrease. Quantity demanded for Pepsi will decrease. Why? The reason being because now the Pepsi has become costly as compared to Coke, right? So, the consumer who were earlier purchasing Pepsi will now purchase the Coke because Coke is relatively cheaper than Pepsi. So, the demand for Coke will increase. The reason being Coke is relatively cheaper than Pepsi, right? Now let's talk about the another aspect. So let's suppose the price of Pepsi and Coke is 10 rupees each, and now the price of Pepsi is reduced to 9 rupees, but the price of Coke remains same at 10 rupees. So here we can say that Pepsi has become cheaper and Coke has become relatively costlier. Right? So now the consumers will purchase more Pepsi, as the consumers who were earlier purchasing Coke will now purchase the Pepsi in place of Coke, because both will give the same satisfaction to the consumer. So the rational consumers will save their 1 rupee by consuming the Pepsi. Students, here we can say that if price of Pepsi will decrease, then quantity demanded for Pepsi will increase. Quantity demanded for Pepsi will increase. And a result of increase in quantity demanded for Pepsi, the demand for Coke will reduce. The demand for Coke will reduce. So here what we can see is when the price of Pepsi increases, then the demand for Coke also increases. And when the price of Pepsi decreases, then the demand for Coke also decreases. So, both the price of Pepsi and demand for Coke move in the same direction, and this type of relationship where two variables move in the same direction, that is, the two variables increases together and the two variables decreases together, then this type of relationship is known as positive, or you can say direct relationship. So here we can say that if two goods are substitute goods, then there is a positive relationship, or you can say direct relationship between the price of one good and the demand for another good. That is, if the price of one good increases, then the demand for another good decreases and vice versa. So let's recall it. When two goods are substitutes of each other, then if price of one good increases, then the demand for its substitute good also increases, right? And vice versa. That is, if the price of one good decreases, then the demand for its substitute good decreases. So there is a positive relationship between the price of one good and the demand for its substitute good. So let's recall it. When goods are substitutes, if the price of one good increases, then the demand for its substitute good increases and vice versa. There is a positive relationship between the price of one good and the demand for its substitute good. So students, in this video we have discussed that there is a negative relationship between the price of one good and the demand for another good in case of complementary goods. And there is a positive relationship between the price of one good and the demand for another good in case of substitute goods. So this is all about the price of related goods as a determinant of demand. Now we are going to discuss about disposable income of the consumer as a determinant of demand. That is how the disposable income of the consumer affects the demand of a particular commodity. So let's get started. First, we will understand what is disposable income. Basically, disposable income is that earnings of a person which he can use as the way he likes. Okay, so this refers to that part of income, or you can say that earnings of a person which he can use as the way he likes. Means he can spend as the way he likes. Basically, it refers to that amount of money which a consumer can spend the way as he likes. Okay, basically, this is the income left after taxes and mandatory deductions. So as we know that we pay various taxes to the government like income tax, GST, wealth tax, gift tax, etc. So whatever income is left after paying taxes to the government and mandatory deductions. Now what are these mandatory deductions? Mandatory deduction means important deductions. Or you can say mandatory deductions refers to the amount of the items which are important to be deducted from the overall income of the individual. And some of the examples of these mandatory deductions are health insurance premium. So if the employer of any person provides him the facility of health insurance, then the individual has to pay the health insurance premium. And health insurance premium is a part of mandatory deduction. Next example of mandatory deductions is union dues. So if you are a member of any trade union, then you need to pay the union dues also. So whatever income is left for spending or saving after taxes and mandatory deductions is called as disposable income of the individual. Now disposable income of the individual in economics is represented by the letter Y. Now a question might arise in your mind is that ma'am, why the disposable income is denoted by the letter Y? Why is not it denoted by the letter I, as I stands for income? So here in economics, investment is represented by the letter I. That's why income cannot be expressed by the letter I. So it is expressed by the letter Y. So I hope the concept of disposable income is clear to you. So students, let's understand the formula of disposable income. Disposable income is equal to gross income. Gross income means total income. It is basically the total earnings of the individual. And from the gross income, the taxes and the mandatory deductions are deducted for calculating the disposable income. So the formula to calculate the disposable income is equal to gross income minus taxes minus mandatory deductions. For example, the gross income of an individual is rupees 10 lakhs and he need to pay the taxes to the government amounting rupees 2 lakhs, and also he is liable for the mandatory deductions amounting 1 lakh rupees. So in this case, what would be the amount of the disposable income? So the disposable income would be equal to the gross income, that is 10 lakhs, minus taxes, which is 2 lakh, minus mandatory deduction, which is 1 lakh. So the disposable income in this case is 7 lakhs. Okay. So this means here the individual can spend or save 7 lakhs as the way he likes, right? So now let's consider another hypothetical example. Let's suppose the gross income is 15 lakhs and the taxes that the individual is liable to pay to the government is basically 3 lakhs and the individual is liable for mandatory deductions amounting 2 lakhs. So what would be the disposable income in this case? The disposable income in this case would be disposable income in this case would be 15 lakhs, that is the gross income, minus taxes, which is 3 lakh, minus mandatory deductions, which is 2 lakhs. So here we get 10 lakh. Disposable income is 10 lakh here. So this means the individual can either save or spend 10 lakhs in as the way he likes. So basically in the first example, the purchasing power of the person is 7 lakh rupees, and in this example, the purchasing power of the individual is 10 lakh rupees. So here we can say that now it is basically the disposable income on which the purchasing power of the individual depends. There is a positive relationship between the disposable income and the purchasing power of the individual. That is, if the disposable income will increase, then the purchasing power of the individual will increase. And if the disposable income decreases, then the purchasing power of the individual will also decrease. Okay. So as we know that the demand for goods and services by the individual is basically dependent on the purchasing power of that individual. So if the purchasing power of the individual will increase, then he will increase the demand for particular goods and services. And if the purchasing power of the individual will decrease, then he will reduce the demand for particular goods and services. So students, this is all about the general relationship between the disposable income of the individual and the demand for particular goods and services by the individual. That is, if the disposable income of the individual will increase, then the demand for particular goods and services will increase by him and vice versa. So students, let's go through the content done till yet. Disposable income of the consumer. Basically, the purchasing power of a buyer is determined by the level of his disposable income. That is, the purchasing power of a buyer is dependent on the level of the disposable income of the buyer. Next, and the demand for a commodity depends upon the disposable income of the potential purchasers. Now, what are the potential purchasers? Potential purchasers are those purchasers who are not the existing purchasers of the company, but yes, can become the purchasers of the products of the company. So basically, these are those people who can become the buyers of the company. So here we have that demand for a commodity is basically dependent on the disposable income of the potential purchasers. So the demand for a commodity is dependent on the disposable income of the people who can become the buyers of the company. So let's recall it. The purchasing power of a buyer is determined by the level of his disposable income. The demand for a commodity depends upon the disposable income of the potential purchasers. Further, we have the relationship between the disposable income and the demand for particular types of goods and services. So here we have, in general, increase in disposable income will lead to increase the demand for particular types of goods and services at any given price, that is at the particular price, and vice versa. So here we have that whenever there is increase in the disposable income of the consumer, then it will lead to increase in demand for particular types of goods and services at the particular prices, and vice versa. Vice versa here means whenever there is decrease in the disposable income, then it will lead to decrease in demand for particular types of goods and services at the given price. So let's recall it. In general, increase in disposable income tends to increase the demand for particular types of goods and services at any given price, and vice versa. So students, this is basically the general relationship between the disposable income and the demand for various goods and services. But now we are going to study about the specific relationship of the disposable income and the demand for various types of goods. Students, if we need to study the relationship between the disposable income and demand of the commodity, then we need to study 4 types of goods. And those are normal goods, inferior goods, essential consumer goods, and luxury goods. We will first talk about the normal goods and the inferior goods. So, inferior goods are basically those goods which are having low quality. Since these goods are having low quality, so these are available at very low prices. So the people who is having very low level of income can afford the inferior goods because these inferior goods are available at very low prices. Now let's go through some of the examples of inferior goods. Examples are bajra and toned milk. Whereas normal goods are basically those goods which are having quality which is above the quality of the inferior goods, and the prices are also above the prices of the inferior goods. Okay, so these are those goods having normal quality, or you can say okay quality, and normal prices, or you can say available at normal, or you can say reasonable prices. Okay. Now let's talk about some of the examples of normal goods. The examples of normal goods are wheat and full cream milk. Okay. Now we will talk about 2 types of relationship. First, the relationship between the disposable income and the demand for normal goods. Second, the relationship between the disposable income and the demand for inferior goods. So let's talk about it. So whenever the income of the consumer is very low, then the consumer purchases the inferior goods because he can only afford the inferior goods. So when the income level of the consumer, or you can say disposable income of the consumer, is very low, then the demand for inferior goods is high, or you can say the demand for inferior goods increases. And whenever the income of the consumer increases, then the consumer switches to the normal goods because now the consumer can afford the normal goods. Then why would he buy the inferior goods? Earlier, when the income level was low, then he was compelled to buy the inferior goods. But now, since he can easily afford the normal goods with the increase in level of income, so he will demand the normal goods more as compared to the inferior goods. So with the increase in disposable income of the consumer, the demand for inferior goods will reduce. Demand for inferior goods will reduce. Okay. So here what we can see that there is a negative relationship between the level of the disposable income of the consumer and the demand for inferior goods. That is, if the disposable income of the consumer decreases, then the demand for inferior goods increases. And when the income level of the consumer increases, then the demand for inferior goods decreases. Now we will talk about the relationship between the income of the consumer, or you can say disposable income of the consumer, and the demand for normal goods. So whenever the disposable income of the consumer is less, or you can say whenever the disposable income of the consumer is low, then the consumer cannot afford the normal goods properly, right? So at that time the consumer demands more of the inferior goods. So the demand for normal goods is less. Demand for normal goods is decreased, or you can say is less. And whenever the income level of the consumer increases, or you can say whenever the disposable income of the consumer increases, then the consumer can easily afford the normal goods, right? So the consumer will purchase more of the normal goods than the inferior goods. So with the increase in disposable income, the demand for normal goods increases, right? So here we can see that there is a positive relationship between the disposable income of the consumer and demand for the normal goods. That is, if the disposable income of the consumer decreases, then the demand for normal goods also decreases, and vice versa. So we have gone through the relationship between the disposable income of the consumer and the demand for normal goods, and also the relationship between the disposable income of the consumer and the demand for inferior goods. Based on these relationships, we can give the meaning of normal goods and the inferior goods. Basically, normal goods are those goods which are demanded more when the disposable income of the consumer increases, and vice versa. And inferior goods are those goods which are demanded less with the increase in disposable level of the income of the consumer, and vice versa. Okay. Next we have essential consumer goods. As the name suggests, essential means important. So these are those goods which are consumed by the consumers, and these goods are very important for their survival. So goods which are ultimately consumed by the consumers for their survival. For example, milk, sugar, etc. Now we will talk about the relationship between the disposable income and the demand for essential consumer goods. See, whenever the disposable income of the consumer increases, then he increases the demand for essential consumer goods, because these goods are basically important for the survival. So he demands these goods more. Okay. But whenever the income of the consumer becomes so much high after increase, then in that case also, when the disposable income of the consumer increases, the demand for essential consumer goods increases. But the increase in demand, the demand for essential consumer goods, is less than the increase in income. It is because when the consumer becomes rich, then the importance of the food items and the essential consumer goods decreases, and also the importance of non-durable goods decreases, and the importance of durable goods and the luxury goods increases. That is, he focuses on utilizing his additional income in order to purchase the luxury goods now. Okay. So that's why the increase in demand for essential consumer goods is less than increase in income of consumer. Or you can say the increase in disposable income of the consumer. Now students, we will study about the luxury goods. Luxury goods are basically those goods which are purchased by the rich people. These are very expensive goods. So these are only purchased by the rich people. These goods are purchased in order to show off the status in the society. So that's why these goods are also known as status symbol goods. Status symbol goods. For example, expensive cars like BMW car, iPhone 14 Pro, that is the latest one, right? So now we will talk about the relationship between disposable income of the consumer and demand for luxury goods. So basically, rich people demands luxury goods because these are very expensive. So these can be affordable only by the rich people. So whenever the income is very high, or you can say whenever the income level is extremely high or you can say whenever the disposable income of the consumer is extremely high, then the demand for luxury goods increases. Okay. So this is all about the relationship between the disposable income of the consumer and the demand for various types of goods. So now let's recall the content. As already discussed, nature of relationship between disposable income and quantity demanded depends upon the nature of goods. That is normal goods, inferior goods, essential consumer goods and luxury goods. So let's recall it. The nature of relationship between disposable income and quantity demanded depends upon the nature of goods. That is normal goods, inferior goods, essential consumer goods and luxury goods. Next, about the normal goods. Now, normal goods are those goods which are demanded in increasing quantities as consumer income increases. That is, normal goods are those goods which are demanded more as the income of the consumer increases. And vice versa. Vice versa here means whenever the income level of the consumer decreases, then he will demand the normal goods in less quantities. For example, household furniture, clothing, etc. So let's recall it. Normal goods. Normal goods are those goods that are demanded in increasing quantities as consumers' income increases and vice versa. For example, household furniture, clothing, etc. Next, inferior goods. Inferior goods are those goods whose demand falls with increase in level of income. That is, inferior goods are those goods whose demand decreases with the increase in level of income of the consumer, and vice versa here means the demand for inferior goods increases with the decrease in level of income of the consumer. For example, toned milk. So let's recall it. Inferior goods. Inferior goods are those goods whose demand falls with the increase in level of income and vice versa. For example, toned milk. Next, essential consumer goods. Now, what are essential consumer goods? These are basically those goods which satisfy the basic necessities of life. Or you can say these are those goods which fulfill the basic requirements of life and are consumed by all the individuals in the society. These are basically consumed by all the individuals in the society. It is because these goods are very essential for the survival. So let's recall it. Essential consumer goods. These goods satisfy the basic necessities of life and consumed by all the individuals in a society. Further we have a change in consumers' income will cause increase in demand for these necessities. That is, whenever there is increase in the income of the consumer, the demand for these necessities will also increase. But as already discussed, increase in demand would be less than increase in income. So let's recall it. A change in consumers' income will cause an increase in demand for these necessities. But the increase in demand will be less than increase in income. Next we have luxury goods. Now, luxury goods are basically those goods which are demanded to show off the status in the society. These goods are basically demanded by rich people. So let's recall it. Luxury goods. Luxury goods are the goods which are demanded to show off the status in the society. These goods are basically demanded by rich people. Further we have that luxury goods are demanded more at higher levels of income. So let's recall it. The luxury goods are demanded more at higher levels of income. So students, this is all about the disposable income of the consumer as a determinant of demand. Hello my dear students. In the previous video, we have gone through the disposable income of the consumer as a determinant of demand. Now in this video, we are going to understand the taste and preferences of buyers as a determinant of demand. That is, we are going to discuss that how the taste and preferences of the consumers, or you can say how the taste and preferences of the buyers affects the demand for the commodities. So let's get started. Now first we will understand what are taste and preferences. So basically, taste and preferences refers to the liking and selections of the consumers. See students, whenever you want to buy anything, you keep certain things in mind about how you are going to select the product. For example, Mr. Ram wants to purchase a mobile. Then there are certain features that he is looking for while selecting the mobiles, and those are good battery backup, good camera quality, good storage. So what are these? These are basically the features that Mr. Ram is looking for selecting the mobile phone for him. Okay. So the features which Mr. Ram is looking for while selecting the mobile phone are basically his taste and preferences. Okay. Or you can say his liking and selections. So every one of us has taste and preferences towards the products that we want to buy. Okay. So this is all about the meaning of taste and preferences of the consumers. Now we will understand how these taste and preferences affects the demand for the commodities. Taste and preferences. Students, you must have observed that the demand for Android mobile phones is greater than the demand for keypad mobile phones, and the demand for LEDs is greater than the demand for black and white TVs. Now, have you ever wondered why it is so? It is so because the Android mobile phones and LEDs are according to the taste and preferences of the consumers, whereas keypad mobile phones and black and white TVs are not according to the taste and preferences of the consumers. That is, the consumer likes to buy Android mobile phone over keypad mobile phones, and the consumer likes to buy LEDs over black and white TVs. So this is a major reason that demand for Android mobile phones is greater than the demand for keypad mobile phones, and the demand for LEDs is greater than the demand for black and white TVs. So here we can say that goods which are according to the taste and preferences of the consumers, are demanded more, whereas the goods which are not according to the taste and preferences of the consumers are demanded less. Now students, here we need to understand that the goods which are modern and are in fashion are the goods which are according to the taste and preferences of the consumers. That is, modern goods and the goods which are in fashion. Now, what do you mean by modern goods? Modern goods are basically those goods which have introduced in the market recently and have the updated features, or you can say have the new features in them. For example, iPhone 14 Pro, right? And the goods which are in fashion are basically the goods which are in style, or you can say are the stylish goods. For example, cord sets in ladies' garments are mostly running nowadays, right? So these are the goods which are in fashion. So basically the modern goods and the goods which are in style, or you can say the goods which are in fashion, are the goods according to the taste and preferences of the consumers and hence demanded more by the consumers. And whereas the goods which are outdated, that is the goods which do not have the latest features, the features of that goods become old now. For example, iPhone 11, right? So that is the outdated good because the features in iPhone 11 is old, right? So outdated goods and the goods which are out of fashion. Out of fashion means those goods which are not running right now, which are not in, or which are not stylish. Okay. For example, salwar suit under ladies garments. So these are the goods basically which are not according to the taste and preferences of the consumers and hence are demanded less. So students, let's recall the content done till yet. Taste and preferences of buyers. Goods which are modern or more in fashion command higher demand than goods which are old design or out of fashion. So let's recall it. Goods which are modern or more in fashion command higher demand than goods which are of old design or are out of fashion. So these lines are saying that the goods which are the modern goods and which are running in, or you can say the trendy goods, are having more demand than the goods which are having old design or are out of fashion. Further, we have consumer may perceive a product as obsolete and discard it before it is being fully utilized and then prefer another good which is currently in fashion. Now what they are saying whenever consumer uses any product, let's suppose the consumer is using iPhone 14 Pro. Okay. So right now iPhone 14 Pro is in fashion. Okay. And it is modern good. So the consumer is using it. But whenever the Apple company will launch iPhone 15, then the consumers who were earlier using iPhone 14 Pro will purchase iPhone 15. Although iPhone 14 Pro is not fully utilized. That means the life of iPhone 14 Pro is still there. But the consumer will not use iPhone 14 Pro because the consumer wants to use the latest good, or you can say the modern good. With the entry of iPhone 15 in the market, the iPhone 14 Pro has become out of fashion, or iPhone 14 Pro has become obsolete. Okay. Now what do you mean by obsolete? Obsolete means that whenever any latest good enters in the market, then the previous good becomes out of fashion and the people stop using that particular good, or the demand for that particular good decreases. So this is called obsolete. So let's recall it. Consumers may perceive a product. Here perceive means think. So consumer may think about the product that the product has become obsolete. So consumers may perceive a product as obsolete and discard it. Discard it means throw it away. Throw it away. Or you can say decided not to use that particular product before it is fully utilized. Before it is fully utilized means it is not used completely. Okay. That means the life of the product is still there. The product can still be in use and then prefer another good which is currently in fashion. And then the consumer prefer the another good which is right now in fashion. That is, the consumer gives importance to the another good which is right now in trend. Now students, we need to understand that there are certain external effects on utility which affects the demand for the commodities. Now what do you mean by external effects on utility? Basically, these are the effects of the factors that are outside the control of the individual, and these factors which are outside the control of the individual. Now students, we need to understand that there are certain external effects on utility that affects the demand for the commodity. Demand for the commodity. Or you can say the demand for the commodity is also decided with the external effects on utility. Now what do you mean by external effects on utility? External effects on utility. Utility means the satisfaction. Utility basically means the amount of satisfaction that a consumer gets after consuming the commodity. And external effects means the effects of the factors that are external, or you can say the effects of the factors that are outside the control of the individual. Okay. So external effects on utility means the effects of the factors that are outside the control of the individual affects the satisfaction of the individual after consuming that particular commodity. Okay. So let's understand an example to know it better. For example, Mr. Ram purchases Samsung mobile phone, owing to the fact that his friend Mr. Sham is using Samsung mobile phone. So here Mr. Ram has purchased Samsung mobile phone because his friend Mr. Sham is using Samsung mobile phone. Now here the demand for Samsung mobile phone by Mr. Ram is dependent on the mobile phone which Mr. Sham is using, or is dependent on the mobile phone which his friend is using. Okay. So whatever the mobile phone his friend is using is not under his control, right? So here this is an external factor, or you can say the factor which is not under the control of Mr. Ram, but it is posing an effect on the satisfaction of Mr. Ram, right? So this is called the external effect on utility. That Mr. Ram knows that Mr. Sham is a wise decision maker, and whatever mobile phone Mr. Sham is using, he must have taken after a good purchasing decision. So purchasing the same mobile phone which Mr. Sham is using would be worthful. So purchasing the same mobile phone that Mr. Sham is using is providing a satisfaction to Mr. Ram. So the satisfaction, or you can say the utility of Mr. Ram, is dependent on the external factor. Now students, we need to understand that what are included under external effects on utility. So there are basically 4 items which are included under external effects on utility, and those are demonstration effect, bandwagon effect, snob effect, and Veblen effect. Here we need to understand that how the demonstration effect, bandwagon effect, snob effect, and Veblen effect affects the demand for the commodity. So let's take an example of demonstration effect first. As already discussed, Mr. Ram purchases a Samsung mobile phone, owing to the fact that Mr. Sham, that is his friend, is a wise decision maker and he is using Samsung mobile phone. So that means the Samsung mobile phone is good to go with, right? Because my friend always takes the wise decisions. So here Mr. Ram has purchased a mobile phone because he is having the faith on the purchasing decisions made by the Mr. Sham, right? So this is called the demonstration effect. So demonstration effect means when the consumer purchases a particular commodity because he is influenced by the other people who are using the same commodity, and those people are having good decision making power while purchasing the commodities. In short, demonstration effect occurs when the consumer is influenced by the decisions made by the other people while purchasing the commodity. Next one is bandwagon effect. Now what is bandwagon effect? Bandwagon effect is Mr. Ram purchases the Samsung mobile phone by having a look that most of his friends are also using Samsung mobile phones. Here the decision is being taken just by copying the consumption pattern of the friends and without thinking whether the purchase of Samsung mobile phone would be worthful or not. Or you can say without thinking the merits and demerits of the commodity. So this is called bandwagon effect. So bandwagon effect means when the consumer follows the consumption pattern of the crowd while purchasing the commodity. Okay, that is, in this example, Mr. Ram has followed the consumption pattern of his friends while purchasing the Samsung mobile phone. So bandwagon effect occurs when the commodity is purchased owing to the fact that all the other people are using the same commodity. Now we will understand what is snob effect. Now to understand the meaning of snob effect, let's take an example. Mr. Ram is right now using the Samsung mobile phone and most of his friends are also using the Samsung mobile phones. Samsung mobile phones. Now Mr. Ram wants to purchase a new mobile phone. So while taking the decision, Mr. Ram thinks that all of his friends are using the Samsung mobile phone. Now he wants to purchase something different that makes him unique among his friends. So he decided not to purchase the Samsung mobile phone but to purchase any other mobile apart from the Samsung mobile phones. So Mr. Ram purchases the Redmi mobile phone because he doesn't wanted to copy his friends now, because he wanted to purchase something unique than his friends. So Mr. Ram, in order to become unique, has decreased the demand for Samsung mobile phones and purchased the Redmi mobile phone because all of his friends are using Samsung mobile phone. So snob effect means whenever the product becomes common among all, then some of the people stop the consumption of that particular product and wants to purchase a new product, or you can say wants to purchase an unique product. So under this, the purchasing decision is not taken while copying the commodity that the crowd is using, right? Rather, the consumer prefers to purchase an unique commodity apart from the commodity that the crowd is using. So here the demand for the commodity that most of the people are using goes down. Now students, we will understand about the Veblen effect. Now to understand the Veblen effect, let's take an example. Mr. Ram is very rich. Okay, so he always purchases the expensive items. The expensive items. That is the items which are available at very higher prices, like iPhone 14 Pro and expensive car like BMW. So Mr. Ram is engaged in purchasing iPhone 14 Pro, BMW car, etc. Why? In order to show off his status in the society. Show off his status in society. So This is called Veblen effect. Veblen effect means when the good is purchased because of its higher price. Generally, Veblen effect is related with the wealthy people, or you can say with the rich people, because rich people are able to afford the expensive items and rich people are able to buy the expensive item and thus show off their status in the society. So whenever the goods are purchased because the goods are of higher prices and purchasing the goods would be to show off the status in the society, then it is called Veblen effect. So now students, let's recall the content done till yet. So external effects on utility such as demonstration effect, bandwagon effect, Veblen effect and snob effect play important roles in determining the demand for a product. Here important means crucial and determining means deciding. So external effects on utility such as demonstration effect, bandwagon effect, Veblen effect and snob effect plays a crucial role in deciding the demand for a commodity. So let's recall it. External effects on utility such as demonstration effect, bandwagon effect, Veblen effect and snob effect do play important roles in determining the demand for a product. Now students, we have demonstration effect. So demonstration effect was coined by means given by James Dusenberry. Now James Dusenberry was an American economist. He was well known for his contributions in macroeconomics and consumer behavior. He was particular well known for his relative income or relative consumption theory. Under relative income or relative consumption theory, Dusenberry explains that the demand for goods and services is not affected only by the absolute level of income of the individuals, that is exact level of income of the individuals, but it is rather dependent on the income of the individuals in comparison to the income of their friends and the income of their relatives. That is, the demand for the products is dependent on the relative income of the individuals also. Basically, individuals compare their income and consumption with that of their friends and relatives and tries to improve their relative position either by saving less or by borrowings. So let's note it down. Relative income or relative consumption theory. Individuals compares their students. Let's note down the relative income or relative consumption theory. Under this theory, individuals compare their income and consumption with the income and consumption of their friends and relatives and tries to maintain their relative position either by saving less or by borrowings. For example, if the income of Mr. Ram increases, but the income of his friends increases more, then the friends of Mr. Ram is having a car, then Mr. Ram will also purchase the car either by saving less or by borrowing the amount from others. So this is called relative consumption theory. Further, we have under demonstration effect is that people buy things because they see that other people are able to have them. That is, people purchase the items because the other people are able to purchase that items. For example, if the neighbor of Mr. Ram has purchased iPhone 14 Pro, then Mr. Ram will also purchase the iPhone 14 Pro, owing to the fact that if his neighbor can purchase the iPhone 14 Pro, then why not he can't purchase? This is called demonstration effect. So let's recall it. Demonstration effect. Demonstration effect was coined by James Dusenberry. People buy things because they see that other people are able to have them. So students, this is all about the demonstration effect. We are going to talk about the bandwagon effect, snob effect, and the Veblen effect. So let's talk about the bandwagon effect first. So as already discussed that Mr. Ram has purchased Samsung mobile phone because all of his friends are using Samsung mobile phones. Samsung mobile phones. This is called bandwagon effect. So in this example, the demand for Samsung mobile phones is increased because the other people are using the Samsung mobile phones, right? So bandwagon effect is basically the degree of increase in the demand for the product because the other people are also using that particular product. So let's recall bandwagon effect. It is basically the extent to which the demand for a commodity is increased. Here extent means degree. That is how much the demand for a commodity is increased due to the fact that others are also consuming the same commodity. Due to the fact that other people are also using the same commodity. It refers to the extent to which the demand for a commodity is increased due to fact that others are also consuming the same commodity. Now further we are talking about the fact that why the people is using that particular commodity or why the people purchases that particular commodity which most of the people are using. It is because in order to be stylish or fashionable. Generally, the goods which are fashionable or stylish are consumed by the people. So whatever is consumed by most of the people are fashionable. So in order to be fashionable, people copy the crowd. So let's recall it. It is done in order to be stylish or fashionable. For example, nowadays the girls are purchasing and using the coat sets, owing to the facts that most of the girls nowadays are wearing coat sets. So this is all about the bandwagon effect. Now we will talk about the snob effect. Now what is snob effect? As we have already discussed that Mr. Ram was earlier using the Samsung mobile phone and his friends are also using the Samsung mobile phone. Samsung mobile phones. Now Mr. Ram wants to purchase a new mobile and while taking the decision for purchasing the new mobile, Mr. Ram thought that all of his friends are using the Samsung mobile phones. So he doesn't want to take the Samsung mobile phones because these Samsung mobile phones have become common among the friends. So Mr. Ram wants to purchase something unique. So in order to be unique among his friends, he decided to purchase Redmi mobile phone. Redmi mobile phone. So the demand of Samsung mobile phone is being reduced by Mr. Ram in order to become unique, right? In the same way, most of the people execute the behavior like Mr. Ram does. So sometimes the demand for the consumer's good is decreased. And why it is so? Because others are consuming the same commodity. So some of the people do not want to follow the crowd because they want to be unique. And in order to be unique, they start using the different product from the product being used by the crowd. So snob effect refers to the extent or you can say the degree by which the demand for a particular product, or you can say demand for a consumer's good, is decreased. And why so? Because others are consuming or using the same commodity. So it refers to the extent to which the demand for a consumer's good is decreased owing to the fact that others are also consuming the same commodity. So under Snob effect, the commodity is purchased different from that commodity which the crowd is following. And why it is so? It is done in order to be different from the common herd. Now what is common herd? Common herd means the crowd. It basically means a crowd of the people who are just following the majority and do not take their individual decisions. So let's recall it. It is done to be different from the common herd. So this is all about the Snob effect. Students, in the next video we will discuss about the difference between demonstration or bandwagon effect and the Snob effect. Students, till now we have discussed about demonstration effect, bandwagon effect, Snob effect and Veblen effect. Now in this video we are going to discuss about the difference between demonstration or bandwagon effect and Snob effect. So let's talk about it. See, under demonstration or bandwagon effect, the demand for a particular commodity is increased. Why so? Because others are also using that particular commodity, right? So demonstration or bandwagon effect is basically psychological effect. Psychological effect means mental effect, or you can say mental impact, in which people do the same what others are doing. The people do not apply their own thinking skills, their own belief while taking the purchasing decision or while taking some actions. They just copy others while taking the purchasing decisions. But under Snob effect, we have already discussed that this is basically a desire or a wish to possess a unique commodity. Because under Snob effect, the individual wants to be unique from the crowd, right? So individual desire to possess means to have a unique commodity. Unique commodity means a different commodity. Having a prestige value means the value of respect and good status among other people. Okay. So Snob effect means the desire to possess the unique commodity or the different commodity which will enhance the reputation and the status of the individual holding the commodity among the others. So let's recall, under demonstration or bandwagon effect, it is a psychological effect in which people do the same what others are doing. They do not have their own belief and thinking. Whereas under Snob effect we have, it is understood as the desire to possess a unique commodity having a prestige value. Further we have that under demonstration or bandwagon effect, there is increase in demand of a particular commodity. Because under this the individual purchase the commodity which others are consuming, right? So it leads to increase in demand of a particular commodity. Whereas under Snob effect, there is decrease in demand of a particular commodity, because here the individual do not purchases a commodity that the crowd is consuming. Basically he focus on consuming some another commodity. So it leads to reduction in demand of that commodity which the crowd is following. So let's recall it. Under bandwagon or demonstration effect we have, it leads to increase in demand of a particular commodity. Whereas under Snob effect we have, it leads to decrease in demand of a particular commodity. So students, this is all about the difference between the demonstration or bandwagon effect and the Snob effect. In this video we are going to discuss about the Veblen effect and how the Veblen effect is different from the Snob effect. So let's get started. See, as in the example already discussed, that Mr. Ram is very rich and he is engaged in purchasing expensive items like iPhone 14 Pro and BMW car, etc. in order to show off his status in the society. Show off his status in the society. So Veblen effect means purchasing the luxury items in order to show off the status in the society. And basically the luxury items are being affordable by the rich people. So luxury items are purchased by the rich people. So we can say that Veblen effect means when rich people are consuming high priced goods. And why they are doing so? They are doing so for conspicuous consumption. That is using the goods to show off in the society. Conspicuous consumption means using the goods to show off in the society. Now let's talk about Veblen effect was given by whom. So Veblen effect was introduced by Thorstein Veblen. He was an American economist and sociologist. American economist and sociologist. He was against capitalism. So throughout his life, he was a critic of capitalist economy. That is the economy in which all the means of production are owned, controlled and managed by the private individual, or you can say private sector. Moreover, in the book of Theory of Leisure Class, basically this book was written by Thorstein Veblen. In his book of Theory of Leisure Class, he explained, or you can say he introduced the concept of conspicuous consumption and conspicuous leisure. So what is this conspicuous consumption? This we have already talked about. So it is basically using the goods to show off in the society, right? And conspicuous leisure means, leisure here means the free time. It means using the free time in order to show off the status in the society. For example, going on vacation shows that you are having good financial status, and even going on vacation to foreign countries shows that you are having a good financial status, right? So this is an example of conspicuous leisure. So in his book Theory of Leisure Class, he introduced the two terms, that is conspicuous consumption and the conspicuous leisure. The example of conspicuous consumption are expensive cars and jewels. So let's recall it. Veblen effect. It was named after Thorstein Veblen. Highly priced goods are consumed by status-seeking rich people to satisfy their need for conspicuous consumption. This is called Veblen effect. So under Veblen effect, we have that highly priced goods, or you can say the luxury goods, are consumed by status-seeking rich people. That is, are used by the rich people who wants to show off their status in the society in order to satisfy their need for conspicuous consumption. In order to satisfy their need for show off their status in the society. Next, example, expensive cars and jewels. So students, having understood the Veblen effect and Snob effect, now we will discuss about the difference between the Veblen effect and the Snob effect. So let's discuss Veblen effect versus Snob effect. See, under Snob effect, the demand for a commodity is decreased because the other people are also using that particular commodity, right? So Snob effect is basically dependent on the consumption of others. That is what other people are consuming. That is what the crowd is consuming, right? So Snob effect is a function of the consumption of others. Whereas under Veblen effect, the goods which are very highly priced are purchased in order to show off the status in the society. So under Veblen effect, the demand for the commodity is dependent on its price. So Veblen effect is basically a function of price. That is, it is dependent on the price of the product. So Veblen effect is a function of price. So the overall difference between the Veblen effect and the Snob effect is that Snob effect is a function of the consumption of others. That is, Snob effect is related to the consumption of others, whereas Veblen effect is related to the price of the products. So students, this is all about the difference between the Veblen effect and the Snob effect. So with all of this, we have finished the taste and preferences of the consumer as a determinant of demand. Now in our next video, we will discuss about the consumer's expectations as a determinant of demand. So students, as if now we have discussed the price of the commodity and price of related goods, disposable income of the consumer, and taste and preferences of the consumer as the determinants of demand. Now in this video, we are going to discuss about the fifth determinant of demand, and that is consumers' expectations. Or you can say we are going to discuss about the consumer's expectations as a determinant of demand. That is, we are going to discuss about how the consumer's expectations affect the demand for the commodity. Now first we will understand what are the expectations. Expectations means the anticipations or projections. Basically, consumers' expectations are the anticipations or projections made by the consumers regarding the future prices of the product or the financial position of themselves, etc. On the basis of the present and the past data, consumers' expectations also play a major role in deciding the demand for the goods and services. Now students, let's talk about how consumers' expectations affects the demand for the commodities. Okay. So first we will understand the consumers' expectations about future prices of the products. Now let's suppose Mr. Ram purchases good X and he made the expectations about the future prices of the good X, how he was going through the prices of good X in various months. So he observed that in the month of July, the price of good X was 100 rupees per unit. And in the month of August, the price of good X increases to 110 per unit. And in the month of September, the price of good X further increases to 120 rupees per unit. So based on the past data about the increase in prices of good X, Mr. Ram is expecting that the price of good X will further increase to 130 rupees per unit in the month of October. Right? So what will Mr. Ram do? Since he is expecting that the future price of good X will further increase in October, so he will purchase more quantities of good X in the month of September in order to save 10 rupees on 1 unit of good X. Right? So whenever consumers expect that the price of the commodity will further rise in near future, then they will increase the demand for the commodity in present. That is, the current demand of the commodity will increase, right? And the opposite also holds true. That means if consumers expect that the price of the commodity will further decrease in near future, instead of rise, the price of the commodity will further decrease in near future, then the consumer will postpone their use and will reduce the current demand. Right? So let's talk about it. Let's suppose in the month of July, the price of good X was 100 rupees per unit. And later on, it reduces to 90 rupees per unit in the month of August. And later on, it further reduces to 80 rupees per unit in the month of September. So based on the past data regarding the decrease in prices of the product, Mr. Ram is expecting that in the month of October, the price of good X will further reduce to 70 rupees per unit. So in this case, Mr. Ram will reduce the current demand for good X because he will prefer to purchase more quantity of good X when the price will further decrease. So in the case when consumers expect that the price of the commodity will further decrease in near future, then they will decrease the current demand for the commodity. So this is all about how the consumer's expectation about the future prices affects the demand for the particular commodity, or you can say how the consumer's expectation about the future prices affects the current demand for the commodity. Now students, further we will discuss about how the consumer's expectations about their income level affects the demand for the commodities. Affects the demand for the commodities. See, as we know that it is the income level of the consumers on which the purchasing power of the consumer is dependent, right? Purchasing power of the consumers is dependent. The consumers who are having high level of income will be able to purchase more as compared to the consumers who are having low level of income. So if the consumers expect that their income level will rise in near future, so in that case they will increase the current demand for the goods and services. Current demand for goods and services, or the current demand for goods and services will be increased. Now why the current demand for goods and services increases? Since their income level will increase in near future, so they are not worried about their future consumption. They just now think about the present consumption, as they need not to keep any provision for the future consumption. So they can do present consumption without compromises, right? So they will increase the current demand for goods and services. And whenever the consumers are expecting that their income level will decrease in near future, then they will be worried about their future consumption and they need to save the money in the present for the future consumption. So they will cut off their present consumption. So the current demand for goods and services, will be reduced. Or you can say whenever the income level of the consumer will decrease in near future, then the consumer will postpone the purchase of non-essential commodities. That is the goods which are not important for our survival. Okay, like the non-durable consumer goods like furniture, table, chair, etc. The use of such goods can be postponed for the future. So that's why the current demand for goods and services will be reduced. So this is how the consumer's expectation about their income level affects the demand for the goods and services. When the consumers are expecting that their income level will rise in near future, then they will increase the current demand for goods and services and vice versa. Now students, we will understand about how the consumers' expectations about the supply of the product affects the demand for the product. Let's suppose the consumer is expecting short supply of the product in near future. Short supply means the supply of the product will be less than the demand for the product. We know that whenever the supply of the product is less than the demand for it, then in that case, the prices will rise in near future for the products. So in order to avoid purchasing the product at relatively high prices, the consumer will increase the current demand for the product. Also, the consumers might have the fear of not getting the product in near future due to the short supply of the product. So the consumers will maintain enough stock of the product in the present. So for that also, the current demand for the product will increase. And if the consumer is expecting excess supply of the product in the near future, that is, if the consumer is expecting that in near future, the supply of the product will be greater than the demand for the product. So as a result of increase in supply of the product over the demand of the product, the prices of the product will decrease. The prices of the product will decrease in near future. So in this case, the consumer will prefer to buy the products when the price of that product will decrease in near future. So the current demand for the product will be reduced. The current demand for the product will be reduced. So this is how the consumer's expectation about the supply conditions, or you can say about the supply of the product, affects the demand for the product. So if the consumers are expecting that the product will be in short supply, so if the consumers are expecting the short supply of the product, then the current demand for the product will increase, and vice versa in case of excess supply. So let's recall it. Consumers' expectation regarding future prices, income, supply conditions, etc. influence current demand. Influence current demand means affects current demand. Please note it down. Hello my dear students, so how are you all? I hope all of you are fit and fine. So in our previous videos, we have gone through some of the determinants of demand like price of the commodity, price of related goods, disposable income of the consumer, taste and preferences of the consumers, and the consumer's expectations about the future prices and supply conditions, etc. Now in this video, we are going to cover up the remaining determinants of demand, and those are size of population, age distribution of population, the level of national income and its distribution, consumer credit facility and interest rates, government policies and regulations. So basically all these points starting from the point A to point E, that is starting from the point size of population to the government policies and regulations, all are clubbed under one point, that is other factors. Students, as we are already aware about the overview of these points, now we are going to discuss all of these points one by one in detail in this video. So let's start with the first point, that is size of population. Size of population as a determinant of demand. Now size of population as a determinant of demand means how the size of population affects the demand for the goods and services. Now what is size of population? Size of population basically refers to the number of individuals living in a specific area, or you can say the number of individuals residing in a specific area. For example, if we talk about the population of India, this means the number of individuals who are residing in the country of India. And if we talk about the population of Pakistan, then it means the number of individuals living in the country of Pakistan. Now, how the size of population affects the demand for goods and services. Now, let's see. If the size of population is large, this implies if more number of individuals are living in a specific area, then there would be more buyers, right? There would be more buyers, or you can say more consumers. because all individual consumes the goods and services, right? Or you can say all individual uses the goods and services for the satisfaction of their wants, right? So there would be more buyers, and whenever there would be more buyers, this means there would be more demand for goods and services. As buyers demands the goods and services, more demand for goods and services. And if the size of population is small, then this means the number of individuals living in a specific area is less, right? So there will be less buyers in this case. And if there will be less buyers and buyers do the demand for goods and services, so there will be less demand for goods and services. So let's take an example to understand it better. As we know that population of India is greater than population of Pakistan. So the demand for goods and services will be high in India as compared to Pakistan. The demand for goods and services will be high in India as compared to Pakistan. So I hope students it is clear to you about how the size of population affects the demand for goods and services. Now let's recall it. Size of population. Larger the size of population of a country or a region. Region here means area. Larger would be the number of buyers and the quantity demanded in the market would be higher at every price. So let's recall it. Size of population. Larger the size of population of a country or a region, larger would be the number of buyers and the quantity demanded in the market would be higher at every price. Now students, we will discuss about how the age distribution of population affects the demand for a particular commodity. That is, we are going to discuss about age distribution of population as a determinant of demand. Age distribution of population as a determinant of demand. Now we have discussed that the size of population also affects the demand for a commodity, or you can say the size of population also affects the demand for the goods and services. Now apart from the size of population, age distribution of population also affects the demand for goods and services. Now, what do you mean by age distribution of population? See, in a population, there are children, right? Basically, children are below 18 years and working adults. Now, working adults basically refers to the people who are 18 years or above and up to 60 years of age. And we have senior citizens. Senior citizens are those people who are above 60 years of age, right? So population constitutes of children, working adults and senior citizen. Now age distribution of population refers to how many children are there in the population, how many working adults are there in the population, how many senior citizens are there in the population. Basically, what is the composition of population, or you can say structure of population. So this is all about the meaning of age distribution of population. Now we will discuss about how the age distribution of population affects the demand for goods and services. See students, if there will be more children in the population, then the demand for chocolates, toys, children books will be high. And if there will be more working adults in the population, then the demand for laptops, laptop bags, etc. will be high. And if there will be more senior citizens, or you can say old age people, then the demand for healthcare services, or you can say medical services, spectacles, walking sticks, etc. will be high, right? So, age distribution of population also affects the demand for goods and services. So, let's recall it. Age distribution of population. If larger proportion of people belongs to old age group as compared to younger age groups, then there will be more demand, or you can say increased demand for geriatric care services. Now, what are geriatric care services? These are basically health care services, or you can say health care services provided to the old age people. Geriatricians are basically the doctors which are specialized in addressing the medical problems of the elderly people. So there would be increased demand for geriatric care services, spectacles, walking sticks, etc. and less demand for children's books. So let's recall it. Age distribution of population. If a larger proportion of people belong to old age group relative to younger age groups, there will be increased demand for geriatric care services, spectacles, walking sticks, etc. and less demand for children's books. And if the population consists of more children, then the demand for toys, baby foods, toffees, etc. will be more. So let's recall it. If the population consists of more of children, then demand for toys, baby foods, toffees, etc. will be more. Further we have, if there is migration from rural areas to urban areas. Migration means movement. If people will move from rural areas to urban areas, as this is generally seen that rural people move from the rural areas to urban areas in search of job opportunities, in search of work, etc. Then there will be decrease in demand for goods and services in the rural areas. So whenever the movement of people will take place from rural areas to urban areas, then the population living in the rural areas will decrease and the population living in urban areas will increase. So as a result of that, the demand for goods and services in rural areas will decrease and the demand for goods and services in the urban areas will increase. So let's recall it. If there is migration from rural areas to urban areas, then there will be decrease in demand for goods and services in rural areas. So students, this is all about the age distribution of population as a determinant of demand. Now we will talk about the level of national income and its distribution as a determinant of demand. That is, we are going to discuss about how the level of national income and its distribution affects the demand for goods and services. So let's get started. The level of national income and its distribution as a determinant of demand. Now first we will understand what is national income. National income earned by normal residents of the country from within the country and outside the country. Students, basically national income is basically the income of the entire country. Every country has its income and we know that the residents of the country are generating the income for the country, right? Let's suppose if I talk about the national income of India, then this means the income generated by the residents of India, right? And if I talk about the national income of Pakistan, then this means the income which is generated by the residents of the country Pakistan, right? So now what is national income? If we talk about the technical meaning of national income, then it means basically the income earned, that is the income generated, or you can say earnings done by normal residents. Normal residents are the people who are residing in a particular country for more than a year and their economic interest lies in that particular country. That is their source of earning also relates to that particular country. Now let's understand the meaning of normal residents with the help of an example. Mr. Ram is living in India since 1993. Since the year 1993, Mr. Ram is residing in India. That means he is living in India for more than a year. Living in India for more than a year and he is doing business in India. Okay. He is basically running a garment store in India for more than 10 years. So, he is residing in India for more than a year and also his source of economic interest, that is his business, or you can say his source of income is also in India. So, we can say that Mr. Ram is basically the normal residents of India. Now, whatever income earned by normal residents like Mr. Ram and other normal residents of the country from within the country, that is from inside the country, and outside the country, that is from foreign countries. Now let's understand the meaning of income generated from within the country and income generated outside the country from the help of the example. Like Mr. Ram is carrying out his business of garments, right? So if he is selling the garments in India, or you can say if he is selling the garments to the people living in India, then that means he is creating his income from within the country, that is India. And if he is exporting his garments to other countries and hence is able to earn the income, then that income is generated outside the country. Or you can say that income is generated outside India. So whatever income is earned, or you can say whatever income is generated by the normal residents of the country from within the country and outside the country, that is called national income of that particular country. So students, this is all about the meaning of national income. Now we will talk about how the level of national income affects the demand for the goods and services. Or you can say level of national income as a determinant of demand. Determinant of demand. First, we will understand what is the level of national income. Level of national income refers to the amount of national income. Or you can say amount of income which is generated in the country. So this is all about the meaning of level of national income. Now students, we will understand how the level of national income affects the demand for goods and services. See, if high level of national income will be generated in the country, high level of national income will be generated in the country, then purchasing power of people will increase in that particular country. Purchasing power of people will increase. Right? As we know that the national income is distributed among the members of the country, and if the high level of national income will be generated in the country, then that means more income will be distributed among the members of the country. As a result, the people will get a more share of national income in that particular country as compared to the country in which there is low level of national income generated, right? So purchasing power of people in this particular country where high level of national income is generated will be more, and hence the demand for goods and services will be high in the countries with high level of national income. Goods and services will be high. Now, if the level of national income which is generated is low, that is low level of national income, then the purchasing power of the people living in that particular country where low level of national income is generated would be low, or you can say would be less. Purchasing power of people would be less, right? So there will be less demand for goods and services in the country with low level of income. Goods and services will be less. For example, if we compare India and Pakistan, in India there is high level of national income which is generated as compared to Pakistan. So the demand for goods and services in India is higher as compared to demand for goods and services in Pakistan. So students, this is all about how the level of national income affects the demand for goods and services. Now we will talk about how the distribution of national income affects the demand for goods and services. Now here, what do you mean by distribution of national income? Distribution of national income means allocation of national income among the members of the country. Allocation of national income among the members of the country. So if we talk about the distribution of national income in terms of India, then it indicates that how the amount of national income of India is distributed, or you can say allocated, among the members of India. That is how the amount of national income is distributed among poor people, middle class people, and rich people. Now we will see how the distribution of national income affects the demand for goods and services. Now see students, distribution of national income can be fair or unfair. By fair distribution of national income, it means that the national income is distributed properly among the poor people, rich people, and middle class people. So whenever there is fair distribution of national income among the members of the country, then in that particular country, rich people, poor people, or you can say economically backward people, and middle class people will be able to do demand for goods and services. So in the countries where there is fair distribution of national income, then in that countries the demand for goods and services will be high. And whenever the distribution of national income in a country is done in an unfair way, that means the distribution of national income is not done properly among the rich people, poor people, and middle class people. It is done in such a way that only the middle class people and the rich people are gaining out of it, and poor people are not getting any benefit out of it. That is, if the distribution of national income is done in such a way that the gap between rich and poor people is increasing day by day, then that means the distribution of national income is unfair. And whenever there is unfair distribution of national income, then in that country only the rich people and the middle class people can demand the goods and services properly. Okay. So in the country where unfair distribution of national income is done, then in that countries the demand for goods and services is less, because here the demand will be done by rich people and middle class people only, and the poor people will not be able to do the demand for goods and services properly. So I hope students it's clear to you that how the distribution of national income affects the demand for goods and services. So till now we have seen that the size of national income as well as the distribution of national income affects the demand for goods and services, or you can say influences the demand for goods and services. So let's recall it, the level of national income and its distribution. Higher the national income, higher would be the demand for normal goods and services, and vice versa. Vice versa here means lower the national income, then lower would be the demand for normal goods and services. So let's go through the content till now. Higher the national income, higher will be the demand for all normal goods and services, and vice versa. Further we have, if national income is distributed in an unfair way among the members of the country, then the demand for goods and services will be less, and vice versa. Here vice versa means if national income is distributed among the members of the country in a fair way, then the demand for goods and services in that particular country will be more. So let's recall it. If the national income is distributed among the members of the country in an unfair way, then the demand for goods and services will be less, and vice versa. Students, as if now we have discussed about the size of population, age distribution of population, and the level of national income and its distribution as a determinants of demand. Now we will discuss about the consumer credit facility and interest rates, and the government policies and regulations as the determinants of demand. So let's start with the consumer credit facility and interest rates. Consumer credit facility and interest rate as a determinant of demand. Now, what is consumer credit facility and interest rate as a determinant of demand? Consumer credit facility and interest rate as a determinant of demand means that the consumer credit facility and interest rate affects the demand for goods and services. Now, students, we are going to understand about how the consumer credit facility and interest rate affects the demand for goods and services. So, what is consumer credit facility? Consumer credit facility refers to the loan facility provided to consumers. Okay, whenever loan facility is available, then consumer can purchase more than what he can purchase with his current income, right? That means his purchasing power becomes greater than the purchasing power with his current income. Let's suppose Mr. Ram is there. The income of Mr. Ram is rupees 15,000. So with his current income, he can purchase the goods up to rupees 15,000, right? But if Mr. Ram takes the loan of rupees 8,000, so now he can purchase the goods and services up to rupees 23,000, right? So by availing the loan facility, the consumers can purchase the goods and services worth current income plus the amount of loan, right? So the purchasing power of the people increases with the loan facility, or you can say with the credit facility. Further, we can say, students, if the credit facility is available with the consumers, then their purchasing power will increase. Purchasing power will increase. And the purchasing power will be equal to the current income plus amount borrowed. So with the increase in purchasing power, the demand for goods and services will increase, especially for durable products. Durable products are those products which have long life, like furniture, table, chair, etc. Okay. And the products which require bulky payments. Products which require bulky payments. And the products which require bulky payments, that is huge. And there are certain products which require bulky payments at the time of their purchase. For example, home, for example, diamond sets, etc. So with the credit facility, the consumer can easily purchase the durable products and the products which require the bulky payments. And if the credit facility is not available, with the consumers, their purchasing power is limited to their current income. So in this case, since their purchasing power is limited, so demand for goods and services will be less. Demand for goods and services will be less, or you can say will decrease. And the consumers finds difficult to purchase the durable products and the products which require the bulky payments. So he will demand only the non-durable products, but the demand for durable products and the products which require bulky payments will reduce in this case. So students, as we know that the credit facility is made available to the consumers at interest. Rate of interest is basically the price for availing loan. Now students, here we need to note that the rate of interest also plays an important role for determining the demand for goods and services. So let us understand how it plays an important role for determining the goods and services. So let's talk about rate of interest, or you can say interest rate as a determinant of demand. See students, if the credit facility is made available to the consumers at low rate of interest, or you can say at low interest rate, then this will induce the customers to take the loan, right? So here the consumers will take loan, or you can say the consumers will avail the credit facility. And whenever the consumers will avail the credit facility, their purchasing power will increase. Purchasing power will increase. And with the increase in purchasing power, they will increase the demand for goods and services. The demand for goods and services. And whenever the credit facility is made available to the consumers at high rate of interest, or you can say high interest rate, then in that case, consumers will discourage to take the loan, as they have to pay high amount of interest on the loan taken. So consumers will be discouraged to take loan. And as a result, the consumers will not take the loan and their purchasing power will be confined to their current income, right? Purchasing power would be confined, or you can say would be limited to their current income, and hence the demand for goods and services will be reduced. Demand will be reduced. So this is how the rate of interest affects the demand for goods and services. So let's recall it: consumer credit facility and interest rates. Availability of credit facilities induces here means attracts people to purchase more than what their current incomes permit them. So let's recall it: availability of credit facility induces people to purchase more than what their current incomes permit them. Further, we have credit facilities mostly determine means decide the demand for investment. It is basically with the credit facilities the business firms does the investment, right? So we can say that credit facilities decide the demand for investment also, and the demand for durable goods. As already discussed, when the credit facilities are available to the consumers, then the consumers can demand the durable goods very easily. Basically, durable goods are those goods which are expensive and require bulky payments at the time of purchase, and require huge payments to be paid to the seller at the time of the purchase. So let's recall it: credit facilities mostly determine the demand for investment and for durable goods, which are expensive and require bulk payments at the time of purchase. Moreover, we have low interest rates, that is, low rate of interest encourages people to borrow, and therefore demand will be more. Low interest rates encourages people to borrow, and therefore demand will be more. So this is all about how the credit facility and interest rates affect the demand for goods and services. Students, in our previous video, we have gone through the credit facility and interest rates as the determinant of demand. Now in this video, we are going to discuss about government policies and regulations as a determinant of demand. Now what are the government policies and regulations? See, government policies and regulations refers to the rules and laws prepared by the government. Now students, this is all about the meaning of government policies and regulations. Now we will discuss about how the government policies and regulations affects the demand for goods and services in the economy. So let's have a look on the government policies and regulations as a determinant of demand. See, government have a taxation policy, right? Taxation policy. The government can increase or decrease the rates of taxes, right? So if the tax rate by the government is being increased, then it will reduce the personal disposable income of the persons. As already discussed, guys, personal disposable income is the income after taxes and mandatory deductions, right? So whenever the government will increase the tax rate, the personal disposable income of the people will reduce. And we know that the purchasing power of the people depends on their personal disposable income. So as a result of decrease in personal disposable income, the purchasing power of the people will reduce. So the demand for goods and services will also reduce. Demand for goods and services will also reduce, or you can say decrease. And whenever the government will decrease the tax rate, as a result of decrease in tax rate, the personal disposable income of the people will increase, and as a result of increase in personal disposable income of the people, their purchasing power will increase, and with the increase in purchasing power of the people, the demand for goods and services will be increased by them. The demand for goods and services will be increased. services will increase. So students, this is how the taxation policy of the government affects the demand for goods and services in the economy. Now we will talk about how the expenditure policy of the government affects the demand for goods and services. Demand for goods and services. See, we know that the government does the expenses for the welfare of the people, right? And the expenses which are done by the government for the welfare of the people, or you can say for the benefit of the people, is called public expenditure. Public expenditure. So expenditure policy is also known as public expenditure policy. Now, the expenditure policy is basically based on the fact that expenditure by government is equal to the income of people. Whatever expenditure will be done by the government will generate the income for the people. Okay. So, for example, now let's suppose the government is involved in constructing the school. Now, for getting the school constructed, the government requires workers. Now, the government will hire the workers for the same. Now, whatever wages the government will provide to the workers for their services, it will be the income for the workers. But at the same time, these wages which are provided by the government to the workers are the expenditure for the government. So this is all about the basics of the expenditure policy of the government. Now we will see how the expenditure policy of the government affects the demand for goods and services. Okay. So there are two aspects of expenditure policy. Expenditure done by the government increases. So it is basically when the public expenditure increases, right? Then the income of people will also increase. Income of the people will also increase. As already discussed, that expenditure by the government becomes the income of the people. So whenever the government will increase the expenditure, then the income of the people will also increase. And whenever the income of the people will increase, then their purchasing power will increase. Purchasing power will increase. And whenever the purchasing power of the people will increase, demand for goods and services will increase. And whenever the expenditure done by the government decreases, expenditure done by the government decreases, then income of the people will also decrease. Income of the people will also decrease. Now, as a result of decrease in income of the people, their purchasing power will also decrease. Purchasing power will also decrease, and as a result of decrease in purchasing power, the demand for goods and services will also decrease. So this is how the expenditure policy affects the demand for goods and services. Now students, we will talk about the subsidy policy of the government. Okay. Subsidy policy of the government also affects the demand for goods and services. Or you can say subsidy policy is also the determinant of demand for goods and services. Right. Now what is subsidy? Subsidy is basically the financial assistance. Financial assistance. Or you can say financial help, which is provided by the government. Now subsidy is basically the financial assistance or financial help or financial aid which is provided by the government. Now to whom it is provided? It is basically provided to the producers of the good. Producers of the goods. Now why it is provided to the producers of the good? So that the goods can be reduced by them at less cost of production. Whenever the good will be produced at less cost of production, then it will be available to the consumers at less prices, and it is made available to the at less prices. So I hope guys you are clear with the meaning of subsidy. Now we will see how the subsidy policy affects the demand for goods and services. See, the goods on which subsidy is provided by the government. Subsidy is provided by the government. For example, LPG cylinders. Then as a result of this subsidy provided by the government, the producers are able to produce these goods at less cost of production. Less cost of production. Since the producers are able to produce these goods at less cost of production, so they will sell these goods to the customers at less prices. And the less prices will encourage the customers to buy these goods more. As we know that consumers demand more at less prices. So the demand for goods will increase in this case. And whenever on any goods, subsidy is not provided by the government. Subsidy is not provided by the government. Then the producer will be able to produce these goods at high cost of production. And as a result of high cost of production, the producer will charge higher prices for the goods to be sold to the customers. Higher prices will be charged from the customers in order to sell out these goods. And as a result of higher prices of the goods for the customers will buy less quantity of such goods. So the demand for such goods will reduce. So this is how the subsidy policy affects the demand for goods and services. The goods on which the subsidy is provided by the government are demanded more as compared to the goods on which the subsidy is not provided by the government. Now students, we will see government policies of international trade, or you can say foreign trade, as a determinant of domestic demand for goods and services. That is, we are going to discuss about how the government policies of international trade, or you can say government policies related to international trade, affects the domestic demand for goods and services. Okay. So now first we will understand what is foreign trade. See, foreign trade means when we are buying and selling the goods beyond the geographical boundaries of our domestic country. For example, import and export are a part of foreign trade. Import means when we are buying the goods from some foreign country, then it is called import. And export means when we are selling the goods to some foreign country. Now let's suppose the government levies heavy tariffs on imported goods. Now what are tariffs? Tariffs are basically the taxes levied on imported goods. Okay. Now if the government is levying heavy tariffs, that is heavy tax rates on the imported goods, then it will increase the price of imported goods in our domestic country, right? As we know that taxes increases the price of the goods, right? So price of imported goods for the Indians will increase. And as a result of increase in price of imported goods, the demand for imported goods will reduce. The demand for imported goods will be reduced, right? Because imported goods have become costly for the Indians. So they will not prefer the imported goods, then they will prefer the domestic goods. So the demand for domestic goods and services will be increased. Students, and the opposite case will also hold true in this case. For example, if the tariffs on imported goods will be less, then the price of imported goods will reduce, and as a reduction in price of imported goods, the demand for imported goods will increase, and whenever the demand for imported goods will increase, then the demand for domestic goods and services will decrease, right? Because whenever the lower taxes, or you can say the lower tariffs, will be imposed on imported goods, then the price of imported goods will reduce, and the reduction in price will induces the consumers to buy more imported goods rather than domestic goods. So the demand for imported goods will increase and the demand for domestic goods and services will reduce. So this is all about how the government policies of international trade affects the domestic demand for goods and services. So let's recall it. Government policies and regulations. The government's influence here means affects demand through its taxation policy, expenditure policy and subsidy policies. So let's go through the content. The government's influence demand through its taxation, expenditure and subsidy policies. Further, we have government's policies on international trade also affect the domestic demand for goods and services. So let's recall, government's policies on international trade also will affect the domestic demand for goods and services. So students, this is all about how the government policies and regulations affects the demand for goods and services. So now students, we have covered up all the main factors affecting demand. But there are certain factors which are not so important, but yes, these are given in your booklet in a very brief manner. So we will also go through these factors in a very brief manner. So let's go through point 2 note. So there are various factors such as weather conditions, business conditions, stage of business cycle, wealth, levels of education, marital status, habits of the consumer, salesmanship and advertisements, etc. play important roles in influencing demand. Influencing demand means affecting demand. So let's understand one by one how these factors affect the demand for goods and services. See, weather condition. We have summer season, we have rainy season, we have winter season, right? In the summer season, we demand cotton clothes more, right? And in the winter season, we demand woolen clothes more. And in the rainy season, we demand raincoats more. So the demand changes according to the change in weather conditions also. So weather conditions also affect the demand for goods and services. Next, business conditions. Business conditions refers to the situation in which the business operates. If business operates in an economy which is growing, then there will be more opportunities to grow the business as the consumers' demand will be high, as the income of the consumers in the growing economy is high, right? So the purchasing power of the consumers will high, which will in turn lead to increase in demand for goods and services in the economy. And whenever the goods and services in the economy will increase, the business will start flourishing. Next, stage of business cycles. Now there are various stages of business cycles like expansion phase, contraction phase, peak period, okay? So if the business is in expansion phase, then the demand for goods and services will be more. as compared to if the business is in contraction phase. If the business is in contraction phase, then the demand for goods and services will reduce. Next, wealth. Now, the people who are having more wealth will demand more goods and services as compared to the people who are having less wealth. Next, levels of education. Now, the people who have attained higher levels of education will be able to get good job and they will be able to earn higher income as compared to the people who have attained very less level of education, right? And when the people with higher levels of education will be able to get good job, so they will be able to earn good. And whenever they will be able to earn good, their purchasing power will increase. So the demand by people who has attained higher levels of education is more than the people who has attained lower levels of education. Moreover, highly qualified people, that is the people who are having higher levels of education, are ready to use the advanced and modern products. So the demand for advanced and modern products will be more in the economy if the people who are educated are more in the economy. Next, marital status. Now the demand for goods and services is also dependent on the marital status. That is, someone is married or someone is single. If someone is married, then he will definitely buy the goods for the entire family. For example, he will buy the vegetables and fruits for the entire family, right? But if someone is single, then he will buy the good for himself only. That means he will purchase the goods and services for himself only. So lesser quantity of goods and services will be produced by the single person as compared to the married person, because married person purchases the goods and services for the entire family, whereas single person purchases the goods and services for himself only. Now, habits of the consumer also affects the demand for the goods and services. For example, if someone is having the habit of smoking, then he will purchase more cigarettes. If someone is having the habit of consuming alcoholic products, then he will demand alcoholic products more, etc. Next, salesmanship. Now, as we know that salesmanship is done by the salesman, right? How much is the salesman is effective in attracting the customer also affects the demand for the goods and services. How much the salesman is able to convey the information about the product to the customer and attract the customers on the basis of the information provided by the salesman to the customer for the product also affects the demand for the product. If the salesman is able to explain the product to the customers easily and explain the utility of the products to the customers, then the customer will be attracted towards the purchase of that particular product and the demand for the products will be high. Next, advertisements. Advertisements also play an important role in affecting the demand for goods and services. The goods which are advertised more are demanded more as compared to the goods which are not advertised on TV, radio, newspaper or any other media, or the products which are advertised very less on various medias. So this is how the advertisements play an important role in influencing demand. So let's recall it. Point to note. Various factors such as weather conditions, business conditions, stage of business cycle, wealth, levels of education, marital status, habits of the consumer, salesmanship, and advertisements, etc. play important roles in influencing demand. So we have just finished the topic of determinants of demand. So in this video, we are going to conclude about the content that we have done under the topic determinants of demand. So basically, determinants of demand are the factors affecting demand, and there are various factors which affects the demand for the goods and services. First is price of the commodity. It is basically the own price of the commodity, or you can say price of the commodity itself. Price of the commodity is also one of the factors affecting demand. Price of the commodity and quantity demanded of the commodity has an inverse relation. That is, if the price of the commodity increases, then the quantity demanded of that commodity decreases and vice versa. Next, price of related commodities. Now, related commodities are those commodities which have some relation between them. Either the two commodities are used in place of each other, that is those commodities are substitute commodities, or you can say substitute goods, or the commodities are used jointly to satisfy the human wants, that is complementary goods, or you can say complementary commodities. Now the price of related goods also affects the demand for goods and services. That is, the price of the complementary goods and the price of the substitute goods also affects the demand for the commodity. In case of complementary goods, the relationship between price of one good and the demand for another good is inverse. That is, if the price of one good will increase, then the demand for another good will decrease. And in case of substitute, there is positive relationship between the price of one good and the demand for another good, or you can say the demand for its substitute. That is, if the price of one good will increase, then the demand for another good will also increase, and vice versa. Next, disposable income of the consumer. Now, disposable income is the income left after taxes and mandatory deductions. If the disposable income of the consumer is more, then the purchasing power of the consumer will be more, and he will be able to purchase more goods and services, and vice versa. Basically, it is the normal goods which are purchased more when the disposable income of the consumer is more, and the normal goods are demanded less in case of less disposable income of the consumer. That is, there is a direct relationship between the disposable income of the consumer and the demand for normal goods. But it is opposite in case of inferior goods. Whenever the disposable income of the consumer increases, then the demand for inferior goods goes down, and vice versa. Next, taste and preferences of buyers. The goods which are according to the taste and preferences of the consumers are demanded more as compared to the goods which are not according to the taste and preferences of the consumers. For example, the demand for Android mobile phones is greater than the demand for keypad mobile phones. The demand for LEDs is greater than the demand for black and white TVs. And 4 types of effects are covered under taste and preferences: bandwagon effect, demonstration effect, snob appeal, and Veblen effect. Next, consumers' expectations. Consumers' expectations also affect the demand for goods and services. If the consumers expect that the price of the product will further rise in near future, then the consumer will increase the current demand for the product, and vice versa. If the consumer expects that there will be shortage in supply of the product in near future, then the consumer will increase the current demand for the product, and vice versa. So consumers' expectations also play a major role in deciding the demand for the commodity. Further, we have other factors like size of population. Size of population also affects the demand for goods and services in the country, or you can say in the area. If the size of population is large, then that means more individuals or more persons are residing in a particular area. So there will be more buyers, and we know that buyers demand the goods and services. So whenever there will be more buyers, the demand for goods and services will be more. And when the size of population will be small, then the number of people residing in a particular area is less, and thus less demand for goods and services will be there because there will be less buyers. Next, age distribution of population. Age distribution of population refers to the composition of population. It means how many children are there, how many working adults are there, and how many senior citizens are there in the population. If more children are there in the population, then the demand for chocolates, toys, and children's books will be more. And if more working adults are there in the population, then the demand for laptops, laptop bags, etc. will be more. And if the senior citizens are more in the population, then the demand for healthcare services, medicines, spectacles, walking sticks, etc. will be more. Next, the level of national income and its distribution. Now, the level of national income and its distribution also affects the demand for goods and services in the economy. If the level of national income is high, then there will be more demand for goods and services in the economy, and vice versa. And if the national income is distributed in a fair way, then also there will be more demand for goods and services in the economy. And if the national income is not distributed in a fair way, that is, it is distributed in an unfair way, then the demand for goods and services in that economy will be reduced. Next, consumer credit facility and interest rates. Now, if the credit facility is available to the consumers, then the demand for goods and services will be increased, and vice versa. That is, if the credit facility is not available to the consumers, then the demand for goods and services will be less. Next, interest rates. If the credit facility is made available to the consumers at low interest rates, then the demand for goods and services will be high, and vice versa in case of higher interest rates. Next, government policies and regulations. Now, government policies and regulations also affect the demand for the goods and services in the economy. That is, the rules and regulations and the laws which are framed by the government also affects the demand for goods and services in the economy. For example, taxation policy, subsidy policy, and public expenditure policy of the government affects the demand for goods and services in the economy. So students, this is all about the determinants of demand. Now, in our next video, we will discuss about some of the basic concepts like what is demand function, what is demand schedule, what is demand curve, etc. Hello my dear students, how are you all? I hope all of you are fit and fine. And we have just finished the topic of determinants of demand in our previous videos. So I hope the determinants of demand is clear to you and you have prepared all your notes regarding that particular topic. Now we are going to start a new topic, that is the demand function. Now first we will understand what is function. See, function is something which shows the relationship between the variables. Okay, function is something which indicates that how the dependent variable is affected by the independent variable. Okay, so in economics, whenever any function will come, then that means it shows any relationship between the variables. So now what is the demand function? The demand function is basically the function which shows the relationship between the demand and its determinants. Okay, it shows the relationship between demand and its determinants. Students, keep in mind that every function shows the relationship between the item of which it is the function and the factors affecting of that particular item. So the demand function shows the relationship between the demand and its determinants. Okay. So as already discussed, the demand of a commodity is dependent on so many factors like price of the good itself, price of related goods, disposable income of the consumers, etc. Right? So demand function shows the relationship between the demand for a product and its determinants. That is, it shows how the demand is dependent on the factors affecting demand. Okay. So basically it is expressed in equation form. You can see it is the equation form, or you can say it is expressed symbolically. Okay. Here the demand function is expressed as Qx is equal to F within bracket Px y Pr. Now what is this? Now let's understand what this equation is indicating. So before understanding what does this equation indicates, we need to understand the denominations. See, Qx here represents the demand for good X. Demand for good X. F here means function of. Px means price of good X. Y means disposable income of consumer. Disposable income of consumer. PR indicates price of related goods, or you can say price of related commodities. Okay, so here this equation indicates that Qx, that is the demand for good X, is a function of, F here means function, is a function of Px, that is the price of good X, that is the price of good itself, right? As we know that we are talking about the demand for good X and here is the price of good X. it indicates that price of the good itself, right? Y here means disposable income of the consumer, and quantity for good X is a function of price of related goods also. And these dots are indicating that apart from these, there are various other items also on which the demand for good X is dependent, like weather conditions, taste and preferences of the consumers, etc. In short, this equation is indicating that quantity for good X is a function of price of good X, disposable income of the consumer, price of related goods, etc. That means demand for good X is dependent on price of good X, disposable income of the consumer, and price of related goods and other items also. So let's recall it. The demand function shows the relationship between the demand for a product and its determinants. Here, demand for a product is the dependent variable. As we can see that demand is dependent on other factors, right? Dependent variable. Whereas its determinants are independent variables. Independent variables. That is the variables which are not affected by any other item, right? So that's what I have already explained you, that function shows how the dependent variable is affected by the independent variable. That is how the independent variable or independent variables are affecting the dependent variable. So I hope the concept of demand function is clear to you students. Hello my dear students, so how are you all? I hope all of you are fit and fine. So as if now we have discussed about the meaning of demand, determinants of demand and the demand function. Now we are going to discuss about the demand schedule in detail. Basically, we are going to cover up the meaning of the demand schedule and the types of the demand schedule. So students, to understand the meaning of demand schedule, we need to understand the types of demand. And second, we need to understand the relationship between price and quantity demanded of the same good. Quantity demanded of the same good. So let's understand what are the types of demand. Students, we have already gone through the meaning of demand, right? Demand is basically the quantity which the consumer is willing to buy and able to buy at a particular price during a particular period of time, right? Now we are going to discuss what are the types of demand. Now there are basically two types of demand, and those are individual demand and market demand. Here the demand is divided into two types on the basis of number of consumers. Number of consumers. So let's understand what is individual demand and what is market demand. So if we talk about the meaning of individual, the meaning of individual means one, right? Or you can say single. So whenever we study the demand by one consumer only, then it is known as the individual demand. Study of demand by one consumer only. For example, if I study about how much sugar is being demanded by Mr. Ram in a month, okay? How much sugar is demanded by Mr. Ram in a month. So here I am studying the quantity demanded of sugar by Mr. Ram only. So I am confined to only one person, and that is Mr. Ram. So here I am studying the demand of sugar by one person only. So it is basically individual demand of sugar by Mr. Ram. Okay. And if I talk about market demand is also known as aggregate demand or total demand. Total demand. As we know that demand is being done by the buyers, right? And the demand by all the buyers in the market for a particular product is known as the market demand of that particular product. For example, there are only 3 buyers of sugar in the market. Okay, buyer A demands 10 kgs of sugar, buyer B demands 20 kgs of sugar, and buyer C demands 30 kgs of sugar. So the individual demand of sugar by buyer A is 10 kgs, whereas individual demand of sugar by consumer B is 20 kgs and the individual demand of sugar by consumer C is 30 kgs. So if we add all the individual demands of all the consumers present in the market, or you can say of all the buyers present in the market, then that is called the total demand. So here 10 plus 20 plus 30 kgs, that is equivalent to 60 kgs. So basically this 60 kgs is the sum of the individual demands of consumer A, consumer B and consumer C. Okay, so here 60 kgs is the market demand. As we have assumed that there are only 3 buyers in the market, that is buyer A, B and C. So I hope students you got the meaning of individual demand and market demand. So let's recall it once. Types of demand. Basically the demand is divided into 2 types on the basis of number of consumers. First is individual demand and another one is market demand. Individual demand, if we study the demand of the product by one consumer only, then it is the individual demand for that particular product. Second, market demand. Market demand is also known as aggregate demand, or you can say total demand. Market demand is basically the sum of the individual demands of all the buyers, or you can say of all the consumers present in the market. So students, so let's note down the meaning of individual demand. Demand by one consumer for a particular product is called individual demand. Next, market demand. Demand by all the consumers of the market taken together, or you can say it is the sum of all the individual demands of all the consumers present in the market. So students, this is all about the meaning of individual demand and market demand. Now we are going to recall the relationship between price and quantity demanded of the same good. Relationship between price and quantity demanded of the same good. Or you can say we are going to recall the price as a determinant of demand. Okay. So as already discussed, whenever the price of the commodity increases, or you can say whenever the price of the good increases, then it becomes costly for the consumers. So the consumer purchases the less quantity of that particular good. So whenever the price of the good increases, or you can say whenever the price of the commodity increases, then quantity demanded of that particular commodity decreases. Quantity demanded of that particular commodity decreases. And whenever the price of any commodity decreases, then it becomes cheaper for the consumers, and hence the consumers increase the purchases of that good. So quantity demanded by the consumers will increase. So basically, there is an inverse relationship between the price and the quantity demanded of the same good. That is, both the price and the quantity demanded of the same good moves in the opposite directions. That is, whenever the price of the commodity increases, then its quantity demanded decreases and vice versa. So students, this is all about the relationship between price and quantity demanded of the same good. Now we are going to understand the meaning of demand schedule. Now what is schedule? Schedule means tabular presentation. Tabular presentation. Whenever the term schedule will come in economics, it will always indicate the tabular presentation. Now what is tabular presentation? Tabular presentation is basically information which is represented in the form of table. Information represented in the form of table. Now what is table? Table is basically the arrangement of rows and columns. For example, this is the table, right? These are the vertical items, right? And these are the horizontal items. If we talk about the vertical items, these are columns. Vertical items are basically columns. C1, C2, C3 are the three columns of this particular table. And horizontal items, horizontal arrangements are basically the rows. For example, R1 and R2 are the two rows of this table. So this table is basically the arrangement of three columns and two rows. Basically, columns are the vertical arrangements and rows are the horizontal arrangements. So any information which is presented in the form of table, or you can say any information which is presented in the form of rows and columns, is basically called the schedule. Okay. So this is all about the meaning of schedule. Now what is demand schedule? First I'll prepare the demand schedule and then we'll let you know the meaning of demand schedule. So let's make a table. So here's the table. Now I am preparing two columns in the table. One column will represent the price in rupees and another column will represent the quantity demanded in kgs. Basically, I am preparing the demand schedule for the commodity sugar. Okay. So here price in rupees is indicating the price of sugar and quantity demanded in kgs is the quantity demanded of sugar. Okay. So let's suppose the price of the sugar is 50 rupees per kg. Then the consumer is demanding 20 kgs of the sugar. Okay. And when the price of the sugar increases to 60 rupees per kg, then the consumer starts demanding 15 kgs of sugar, right? And when the price of sugar further increases to 70 rupees per kg, then the consumer starts demanding 12 kgs of sugar. So now, what does this table indicates? This table is indicating that at the price of 50 rupees per kg of sugar, the consumer is demanding 20 kgs of sugar. And at the price of 60 rupees per kg of sugar, then the consumer is demanding 15 kgs of sugar. And at the price of 70 rupees per kg of sugar, the consumer is demanding 12 kgs of sugar. So basically, this table is indicating different quantities of the good, demanded at different prices. So as we know that whenever there is change in prices of the commodity, the quantity demanded of the commodity by the consumer will also change. It is because of the inverse relationship between price and quantity demanded of the same good. That is, if the price of the commodity increases, then its quantity demanded decreases and vice versa. So demand schedule is basically a table which shows us the different quantities of the commodity demanded by the consumer at different prices of that particular commodity. So here we can note down demand schedule is a tabular presentation which shows different quantities of the commodity demanded at different prices. Now students, whenever you prepare the demand schedule by your own, just remember the inverse relationship between the price and the quantity demanded of the same good. So as you can see that I have also kept in my mind the relationship between the price and the quantity demanded while preparing this demand schedule. Whenever I have increased the price of sugar, right, then I have decreased the quantity demanded of sugar, right? So this you need to keep in mind that if you are increasing the price, then you need to decrease the quantity demanded of the commodity. Or if you are decreasing the price of the commodity, then you need to increase the quantity demanded of the commodity. So this is all about the meaning of demand schedule. So let's go through the content of the demand schedule. A demand schedule is basically a tabular presentation, that is the presentation in the form of table, that shows various quantities of the good, that is different quantities of the good that are demanded at various levels of prices, that is different levels of prices. So demand schedule is basically a tabular presentation that shows different quantities of the good that are demanded by the consumer at different levels of the prices of that particular good. So let's recall it. The demand schedule. A demand schedule is a tabular presentation that shows the various quantities of the good that are demanded at various levels of prices. So students, this is all about the meaning of the demand schedule. Now we are going to discuss about the types of demand schedule. Demand schedule is basically divided into two categories, and those are individual demand schedule, and another one is market demand schedule. Now what is individual demand schedule? Individual demand schedule is linked with individual demand. That is the demand by one consumer only. Whereas market demand schedule is linked with market demand. That is the demand done by all the consumers taken together in the market. Now individual demand schedule is a tabular presentation which shows different quantities demanded of a commodity by one consumer at different levels of prices. Whereas market demand is a tabular presentation which shows different quantities of a commodity demanded by all the consumers in the market at different prices. Okay, so now we will understand it with the help of an example. Now students, there is a consumer And the name of that consumer is Mr. Ram. Mr. Ram is purchasing wheat. Now here I'm writing price of wheat in rupees and quantity demanded of wheat in kgs. Now I'm preparing a table. There are two columns of this table. One is representing the price of wheat in rupees and another one is representing the quantity demanded of wheat in kgs. Now let's suppose the price of wheat is 40 rupees per kg. Then Mr. Ram is demanding 30 kgs of wheat. And when the price of wheat reduced to 35 rupees per kg, then Mr. Ram starts demanding 40 kgs of wheat. And later on, when the price of wheat further reduces to 30 rupees per kg, then Mr. Ram starts demanding 50 kgs of wheat. So, this table is indicating that what different quantities of wheat is being demanded by Mr. Ram at different prices of wheat, right? Like Mr. Ram is demanding 30 kgs of wheat at the rate of 40 rupees per kg. Mr. Ram is demanding 40 kgs of wheat at the rate of rupees 35 per kg. And Mr. Ram is demanding 50 kgs of wheat at the rate of 30 rupees per kg, right? So this table is indicating the different quantities of the commodity, that is wheat, which is being demanded by Mr. Ram at different prices. So basically this table is showing us the individual demand of wheat done by Mr. Ram at different prices of wheat. So this is the example of individual demand schedule. Individual demand schedule. Now students, we will go through the example of market demand schedule. Now let's suppose there are three consumers in the market and the name of those consumers are Mr. Ram, Mr. Sham and Miss Simran. Okay, now let's suppose all the three consumers are purchasing wheat. Okay, or you can say there are only three consumers in the market for the commodity wheat, and those consumers are Mr. Ram, Mr. Sham and Miss Simran. So now let's make a table. Prices in rupees. Quantity demanded in kgs by Mr. Ram. Quantity demanded of wheat in kgs by Mr. Sham. Quantity demanded in kgs by Miss Simran. Now let's suppose guys, when the price of wheat was 20 rupees per kg, then Mr. Ram was demanding 100 kgs of wheat, Mr. Sham was demanding 80 kgs of wheat and Miss Simran was demanding 40 kgs of wheat. Now later on, when the price of wheat increased to 30 rupees per kg, then Mr. Ram reduces its demand to 80 kgs and Mr. Sham reduces its demand to 40 kgs and Miss Simran reduces its demand to 30 kgs. And later on, when the price of wheat further rises to 40 rupees per kg, then Mr. Ram starts demanding 40 kgs of wheat and Mr. Sham starts demanding 30 kgs of wheat and Miss Simran starts demanding 20 kgs of wheat. Now, we need to calculate the market demand here. Market demand at different prices here for the commodity wheat. Okay. So, at the price of 20 rupees per kg, we can see Mr. Ram demands 100 kgs, Mr. Sham demands 80 kgs and Miss Simran demands 40 kgs. So, the market demand at 20 rupees price is equal to 100 plus 80 plus 40. 100 plus 80 plus 40 kgs, which is 220 kgs. So this market demand would be in kgs. Later on, when the price increases to 30 rupees, then market demand in this case would be 80 plus 40 plus 30. So it is 150, right? 150 kgs. Next, when the price increases to 40 rupees per kg, then the individual demand of Mr. Ram is 40 kgs, Mr. Sham is 30 kg and Ms. Simran is 20 kgs. So adding 40 kgs, 30 kgs and 20 kgs, we get 90 kgs. So 90 kgs is the market demand of wheat at 40 rupees per kg. So here we can see that at the price of 20 rupees per kg, the market demand is 220 kgs. At the price of 30 rupees per kg of wheat, the market demand for wheat is 150 kgs. And at the price of 40 rupees per kg of wheat, then market demand for wheat is 90 kgs. So here we can see that it is a table. It is basically a table which is representing different market demands at different prices of the commodity. So this is a market demand schedule. I hope students you understand the meaning of the demand schedule and the types of demand schedule, that is individual demand schedule and market demand schedule. So this is all about in this video. In our next video, we are going to cover up the concept of demand curve. Hello my dear students, so how are you all? I hope all of you are fit and fine. So in the previous video, we have gone through the meaning of demand schedule and its types. Now in this video, we are going to understand about the concept of demand curve. Basically, we are going to understand the meaning of demand curve, types of demand curve, slope of demand curve, and shape of demand curve. So let's start with the meaning of demand curve. Demand curve. In economics, curve always refers to the graphical presentation. Graphical presentation. Now what is graphical presentation? Graphical presentation means the information which is expressed in the form of graph. Information which is expressed in the form of graph. Graph here refers to the panel which have x-axis and y-axis, right? So whenever in economics the curve will come, it will always represent the graphical presentation. That is, it will represent the information which is expressed in the form of graph. Okay. So now what is demand curve? See, you have just understood the meaning of demand schedule, right? Demand schedule is basically the tabular presentation which shows different quantities of the commodity demanded at different prices, right? Now, when the same information is represented in the form of curve in the graph, then it is called demand curve. Okay, so we can say that demand curve is basically the graphical presentation of demand schedule. Demand schedule. Okay, that is, whatever information is given by the demand schedule, the same information is given by the demand curve. But the major difference is that demand schedule gives the information in the form of table, whereas demand curves gives the information in the form of curve of a graph. Now based on this information, we can easily define the demand curve. So let's see what is demand curve. Basically, it is a graphical presentation that shows different quantities of the commodity demanded at different prices. Now let's understand it in a better way. Here I'll first take a demand schedule indicating the information about good X. So here are the prices of good X in rupees and quantity demanded of good X in units. So when the price of good X is 10 rupees, the consumer demands 100 units of the good. When the price of the good increases to 20 rupees, then the consumer decreases its demand to 80 units. And when the price of good X further increases to 30 rupees, then the consumer further decreases its demand to 60 units. And when the price of good X further rises to 40 rupees, then the consumer further decreases its quantity demanded to 40 units. So this is basically the demand schedule in front of you, which is showing the information about different quantities of good X demanded at different prices by the consumer, right? Now, I will share the same information with you in the form of graph. Now, in order to prepare a graph, we need to prepare the panel first. So here I am preparing the panel. Now I am denoting the origin by O, and standing axis is the y-axis and sleeping axis is the x-axis. On y-axis, or you can say on OY-axis, we show the price. So here I am writing price of good X in rupees. And on OX axis, we label the quantity demanded in units. Since the prices are 10, 20, 30 and 40, so let's take it on panel 10, 20, 30, 40. And the quantity demanded in units are 100, 80, 60, 40. So let's take the quantity demanded at a gap of 20 units. 20, 40, 60, 80, 100, 120, 140. Now after preparing and labeling the panel, I will be plotting the points on the graph based on the information given to me regarding good X. So when the price of good X is 10 rupees, the quantity demanded for good X is 100 units. So from y-axis we will take the price and from x-axis we will take the quantity demanded. So let's plot the first point. When the price is 10 rupees, then quantity demanded of good X is 100 units. So here's the point A. So first point we have plotted. Next, second point is when the price is 20 rupees, then quantity demanded is 80 units. So when the price is 20 rupees, then quantity demanded is 80 units. So here's the point B. Now, third point, when the price is 30 rupees, then the quantity demanded is 60 units. When the price is 30 rupees, then the quantity demanded is 60 units. Point C. Next, when the price is 40 rupees per unit, then the quantity demanded is 40 units. Here the price is 40 and the quantity demanded is 40. This is point D. So we have plotted all the points on the graph Now we will join these points. Joining these points will give us demand curve. So here's a demand curve which we have derived from the demand schedule. Since students, I have derived the demand curve from the demand schedule, so that's why we say that demand curve is basically the graphical presentation of demand schedule, right? Here you can see that demand curve is basically a curve which shows different quantities of the commodity demanded at different prices. Like you can see from point A that when the price of the commodity is 10 rupees, the quantity demanded of the commodity good X is 100 units. And when the price of good X increases to 20 rupees, then the quantity demanded of good X decreases to 80 units. Like you can see, when the price of good X is 20 units, then the quantity demanded of good X is 80 units. And when the price of good X is 30 rupees, then the quantity demanded of good X is 60 units. And when the price of good X is 40 rupees, then the quantity demanded of good X is 40 units, right? So, demand curve is basically a curve which shows different quantities of the commodity demanded at different prices. Now students, let's have an overview about the content of the demand curve. So, the demand curve is basically the graphical presentation of the demand schedule. So, this we have already discussed, right? And basically demand curve is a curve that shows various quantities of a good demanded at various levels of prices in the market. So let's recall it, the demand curve. The demand curve is a graphical presentation of the demand schedule. It is a curve that shows the various quantities of good that are demanded at various levels of prices in the market. Now students, this is all about the meaning of demand curve. Now we will talk about the shape of demand curve. So as we can see, here's the demand curve which we have derived, and it is basically going down, right? So this type of shape is known as demand curve. So basically this is the shape which is going from top to down, right? So this is called downward sloping, or you can say negatively sloped. Let's prepare a demand curve. Here's a panel. Here's the origin, y-axis, x-axis. Here I'll write price of in rupees, quantity demanded of good in units. Here's the demand curve, right? So students, please notice that how I prepare the demand curve. I am preparing it like in this way, like this, going downward, right? So this type of shape is known as downward sloping, or you can say negatively sloped. So we can say that the demand curve is downward sloping, or you can say downward sloping from left to right. You can see I'm going from left to right. So we can say demand curve is downward sloping from left to right. Now the question arises, why the demand curve is downward sloping, right? Or you can say why the demand curve is negatively sloped. So I am providing you some general tips about the shape of curves. Okay. In economics, the shape of curves are basically two. Mainly it is two. So here's a panel. One is like this. That is downward sloping. Another one is like this. This you can see it is going from origin to upward. This type of shape of curve is known as upward sloping, or you can say positively sloped. Now let's see what are these two types of shapes denoting? Now, we will consider 2 points on downward sloping curve. Let's suppose this is point A and this is point B. Now, on point A, here we can see that this portion of y-axis is covered and this portion of x-axis is covered. And moving to point B covers this much portion of y-axis and this much portion of x-axis. So here we can see that whenever the variable on y-axis is being increased, then the variable of x-axis is decreased. So basically when the shape of the curve is downward sloping, then that means it is indicating the inverse relationship. Inverse relationship. Between what? Between the variables. Between the variables shown on x-axis and y-axis. And when the shape of the curve is upward sloping, then what we get after moving from point A to point B, let's suppose we are on point A. So this covers y-axis and this much amount of x-axis is being covered by point A. And when we move to point B, then point B covers this much portion of y-axis and this much portion of x-axis, right? So here we can see that both are increasing, right? So moving from one point to another point will lead to increase in both the variables which are shown on x-axis and y-axis. So upward sloping or positively sloped curve will represent the positive relationship. Positive relationship between the variables shown on x-axis and y-axis. Okay. So basically students, I want to tell you that is increase in one variable will lead to increase in another variable and vice versa. That is decrease in one variable will lead to decrease in another variable. So now students, the shape of the curve can be downward sloping and can be upward sloping. Now what will be the shape of curve is basically dependent on the relationship between the variables that we are showing on y-axis and x-axis. If the relationship between the variables that we are going to show on y-axis and x-axis is inverse, that is increase in one variable will lead to decrease in another variable and vice versa, then the curve would be downward sloping, or you can say negatively sloped. And if the variables which are shown on y-axis and x-axis are having positive relationship between them, that is increase in one variable will lead to increase in another variable and vice versa, then the curve would be upward sloping. Okay. So here's the general tip. So let's conclude about the general tip. See students, the shape of curve can be downward sloping or upward sloping. The shape of the curve is basically dependent on the type of relationship between the variables which are shown on x-axis and y-axis. If the variables which are shown on x-axis and y-axis are having inverse relationship, or you can say negative relationship, or you can say indirect relationship, then in that case the curve would be downward sloping. And if the variables which are shown on x-axis and y-axis are having positive relationship, or you can say direct relationship, then the curve would be upward sloping, or you can say positively sloped. So now students, we will move on to the shape of demand curve. See students, whenever we prepare the demand curve, we take the price of the good on y-axis and quantity demanded of good on x-axis. Now, the relationship between price of the good and its quantity demanded is inverse, right? We have already discussed about the relationship between the price of the good and the quantity demanded of the same good, right? So we have already discussed that the price of the good and the quantity demanded of the good has an inverse relation between them. That is, if the price of the good increases, then the quantity demanded of the good decreases and vice versa. So, since the relationship between the variables which are shown on x-axis and y-axis, that is price of the good and quantity demanded of the good, is inverse, or you can say opposite, or you can say negative, or you can say indirect. So that's why the shape of demand curve is downward sloping. Now let's see what's the demand curve is denoting. Let's suppose the consumer is on point A of the demand curve. So the point A denotes that at OP price of the good, the consumer is demanding OQ quantity of the good. Now let's suppose the consumer moves to point B. Here's a point B. Now this indicates that at price OP1, the consumer is demanding OQ1 quantity, right? So moving from point A to point B for the consumer indicates that when the price of the commodity increases, the consumer start decreasing the quantity demanded of that particular good. So that's why the demand curve is downward sloping, or you can say negatively sloped. So demand curve is downward sloping, or you can say negatively sloped from left to right. It is because of the inverse relationship between the price and quantity demanded of the same good. So students, let's recall about the shape of demand curve. So basically the demand curve is downward sloping, or you can say negatively sloped. Why it is so? It is because of the inverse relationship between price of the good and its quantity demanded. So let's recall it. The demand curve is downward sloping or negatively sloped because of the inverse relationship between the price of the good and its quantity demanded. Now further we will understand the slope of the demand curve. Now what does the slope of the curve indicates? This is the panel, origin, y-axis, x-axis. Let's suppose this is the demand curve. Now if we talk about the slope of any curve, it means whenever a shift takes place from one point to another point on the curve, then what does that curve indicate is basically the slope of that particular curve. Okay. So if we talk about the slope of demand curve, then this means if we move from point A to point B on a demand curve, then what information is being indicated by the demand curve? So let's first label it. This is basically price of good X. Here's a quantity demanded of good X. Okay. So when the consumer was at point A, then he was demanding OQ quantity of good X at OP price of it. And later on, when the consumer moves to point B, then the consumer starts demanding OQ1 quantity of the good X at price OP1. So this indicates the decrease in quantity demanded, right? So this is basically change in quantity demanded. The change is represented by this delta. Delta indicates change. So this is basically change in quantity. And this portion is basically indicating the increase in price of good X. So this is basically change in price of good X. So now what information is shown by moving from point A to point B on a demand curve? It is basically showing that change in quantity demanded due to change in price, or it is showing the change in price due to change in quantity demanded, right? So that's why the slope of a demand curve is basically change in price upon change in quantity demanded. And here you can see that there is a negative sign. Now this negative sign doesn't have any mathematical importance. That means it is not for like 5 minus 7 is minus 2. No, this doesn't have any mathematical importance, but this sign is basically indicating the inverse relationship between price and quantity demanded of the same good. Okay, so the slope of demand curve is negative change in price over change in quantity. So let's recall it. Slope of demand curve. The slope of a demand curve is minus change in price over change in quantity. So students, this is all about the slope of demand curve. Now students, further we need to note here that it is basically the slope of demand curve on which the shape of demand curve, that is whether the demand curve would be straight line or not, is dependent. The student, here I am giving you a general tip. See, here's a general tip. See, the curve can be straight line or concave or convex. The straight line curve is like this, right? This or this, and concave shape is like this, and convex shape is like this, right? Now in economics, the curve can be straight line or concave or convex. And what would be the shape of the curve? That is, whether the shape of the curve is straight line or it would be concave or it would be convex is dependent on the slope of the curve. Okay? If the slope of the curve is constant, that is, the slope of the curve is neither increasing or decreasing, it remains same, then the curve would be straight line. And when the slope of the curve is increasing, then in that case the shape would be concave. And when the slope of the curve is decreasing, then in that case the curve would be convex. Okay? So please note this general tip. So the demand curve can be straight line. A straight line curve is also known as linear curve. Okay? So we can say the demand curve can be linear demand curve. And the demand curve would be linear, or you can say straight line, only when the slope of demand curve would be constant. As already discussed, the shape of any curve is dependent on its slope. So the shape of demand curve is dependent on the slope of demand curve. So the demand curve would be linear, or you can say straight line, when the slope of demand curve is constant. And the demand curve can be non-linear also. Non-linear means that the demand curve would not be straight line. It would be either concave or it would be either convex. Then also it is dependent on its slope, right? If the slope of the demand curve is not constant, that is, if the slope of the demand curve is either increasing or decreasing, then the shape of demand curve would be either convex or concave. So the demand curve can be linear or non-linear. Non-linear is also known as curvilinear. Okay? So let's recall it. Demand curve for a good doesn't have to be linear or straight line. It is not compulsory, it is not mandatory that the demand curve for a good would be straight line only. It can be curvilinear also. That is, it can be non-linear also. That is, the demand curve cannot be straight line also. It can be either convex or concave. So let's recall it. The demand curve for a good does not have to be linear or a straight line. It can be curvilinear, that is non-linear. So students, this is all about the demand curve. Now in our next video, we will discuss about the law of demand. Hello my dear students, so how are you all? I hope all of you are fit and fine. So in our previous video, we have gone through the meaning of demand curve, slope of demand curve, and even the shape of demand curve. Now in this video, we are going to talk about the types of demand curve. Students, as already discussed, that demand curve is basically the graphical presentation of the demand schedule, right? And we know that demand schedule is divided into two types. That is individual demand schedule and market demand schedule. Now let's talk about the types of demand curve. Types of demand curve. Basically, the demand curve is divided into two. Individual demand curve and market demand curve. Individual demand curve is the graphical presentation of the individual demand schedule. Graphical presentation of the individual demand schedule. Whereas market demand curve is the graphical presentation of the market demand schedule. Graphical presentation of the market demand schedule. Basically, individual demand curve is a curve or graphical presentation that shows different quantities of a product demanded by one consumer at different prices of that particular product. Whereas market demand curve is a curve, or you can say a graphical presentation that shows different quantities of a product demanded by all the buyers taken together in a market at different prices of that particular product. Now students, we will prepare the individual demand curve and market demand curve. Now let's suppose there are only two consumers in the market for the product sugar, Mr. Ram and Mr. Shyam. Let's go through their demand schedules. So here's are their demand schedules. Prices in rupees, quantity demanded of sugar in kgs. This is of Mr. Ram. 10 rupees per kg, 20 rupees per kg, 30 rupees per kg of price. Mr. Ram is demanding 5 kgs of sugar, 2 kgs of sugar and 1 kg of sugar. Next we will talk about the demand schedule of Mr. Shyam. Prices in rupees and quantity demanded in kgs. 10, 20, 30. So at the prices of 10, 20, 30, Mr. Shyam is demanding 4 kgs of sugar, 3 kgs of sugar and 2 kgs of sugar respectively. Now let's frame the market demand schedule here. Here's the prices in rupees. Here's the market demand. Prices would be same 10, 20, 30, right? And to get the figure of market demand, we need to add the quantity demanded by Mr. Ram and Mr. Shyam at a particular price. So, at the price of 10 rupees, Mr. Ram is demanding 5 kgs of sugar and Mr. Sham is demanding 4 kgs of sugar. So it would be 9 kgs of sugar. Market demand will also be in kgs. Later on, at the price of rupees 20, the market demand is 5 kgs, 2 plus 3. And at the price of rupees 30 per kg, the market demand would be 1 kg plus 2 kgs, which is 3 kgs. So now we are going to prepare the individual demand curve and market demand curve. So it is all about the individual demand schedules of Mr. Ram and Mr. Sham, and it is the market demand schedule, right? Now we are going to prepare the individual demand curves and the market demand curve. First, we will prepare the individual demand curves. Individual demand curves. Let's prepare the individual demand curve of Mr. Ram. We'll draw a panel. We'll mark the origin, y-axis and x-axis. As we already know, price of the product is shown on y-axis, whereas the quantity demanded of the product is shown on x-axis. Now we'll mark the prices 10, 20, 30. And now we will mark the quantity demanded 1, 2, 3, 4, 5, 6, right? Now when the price is 10 rupees, Mr. Ram is demanding 5 kgs of sugar. So here's the point. And when the price of sugar is 20 rupees per kg, then Mr. Ram is demanding 2 kgs of sugar. So here's the point. And when the price of sugar is 30 rupees per kg, then Mr. Ram is demanding 1 kg of sugar. So here's the third point. Now we are going to add all the 3 points to get the demand curve of sugar. So here's a demand curve of sugar by Mr. Ram. Now we will prepare the demand curve of sugar by Mr. Sham. We'll draw a panel first, mark the y-axis, x-axis and the origin. We'll label the price on y-axis and quantity demanded on x-axis. Now we will prepare the individual demand curve of sugar by Mr. Sham. We'll mark the prices 10, 20, 30. Quantity demanded 1, 2, 3, 4, 5. Now as per the demand schedule of sugar by Mr. Sham, when the price is 10 rupees per kg, Mr. Sham is demanding 4 kgs of sugar. And when the price of sugar is 20 rupees per kg, then Mr. Sham is demanding 3 kgs of sugar. And when the price is 30 rupees per kg, then Mr. Sham is demanding 2 kgs of sugar. So here's the points. Now we are going to add all these points. So this is the demand curve of sugar by Mr. Sham. So these two are the individual demand curves, right? Now we will derive the market demand curve. Market demand curve. We'll prepare a panel, mark the origin, y-axis and x-axis. And on the y-axis we'll show the prices in rupees and quantity demanded on x-axis, quantity demanded in kgs. Okay, here also we'll write in kgs. Now there are two ways of preparing market demand curve. Either you can prepare the market demand curve using the market demand schedule, okay, in the same way as I have prepared the individual demand curves using the individual demand schedules. Or the another way is to prepare the market demand curve is by using the individual demand curves. Okay. Now I'll tell you how to prepare the market demand curve using the individual demand curves. Now we'll first label all these 10, 20 and 30. And the quantity demanded is 4, 6, 8, 10. Now students, as already discussed that, there are two ways of preparing the market demand curve. we can either prepare the market demand curve by having a look on market demand schedule in the same way as we were preparing the individual demand curves by having a look on individual demand schedule. Or we can prepare the market demand curve using the individual demand curves of Mr. Ram and Mr. Sham. Now I am going to tell you about how to prepare the market demand curve using the demand curves of Mr. Ram and Mr. Sham. So let's get started. See, at a price of 30 rupees per kg, we can see that Mr. Ram is demanding 1 kg of sugar. And at the price of 30 rupees per kg, Mr. Sham is demanding 2 kgs of sugar. So overall, at the price of 30 rupees, the market demand of sugar is 3 kgs, right? So at the price of 30 rupees, the market demand for the sugar is 3 kgs. So here's the first point, point A for market demand curve. Now, when the price is 20 rupees per kg, then Mr. Ram is demanding 2 kgs of sugar and Mr. Sham is demanding 3 kgs of sugar. That means at the price of 20 rupees per kg, the market demand for sugar is 5 kgs, right? So, here's the next point. Point B for market demand curve. Now, at the price of 10 rupees per kg, Mr. Ram is demanding 5 kgs of sugar, whereas at the same price, Mr. Sham is demanding 4 kgs of sugar. That means at the price of 10 rupees per kg, the demand for sugar, or you can say the market demand for sugar, would be 9 kgs. So here's the third point. Now all the points of market demand curve has been obtained by using the points of individual demand curve of Mr. Sham and Mr. Ram, right? Now we are going to add all these points. Adding all these points will give us the market demand curve. So here's the market demand curve. So this is how we can derive the market demand curve using the individual demand curves of Mr. Ram and Mr. Sham. On the basis of this, we can say that the market demand curve is basically the horizontal summation of the individual demand curves of all the consumers taken together. So this is all about the types of demand curve. Till now we have gone through the 3 basic concepts, and those are demand function, demand schedule, and demand curve. Now in this video we are going to conclude about the demand function, demand schedule, and the demand curve. So let's have a look. First I'll let you know what is demand function. So demand function, as already discussed, it is basically a function which shows the relationship between demand and its determinants. Function which shows the relationship between demand and its determinants. It is basically expressed as follows: Qx is equal to F Px, Pr, Y, and so on. Here Qx is basically representing the quantity demanded of good X. F means is a function of, or you can say is dependent on, Px price of good X, Pr price of related goods, Y is disposable income of the consumer, and etc. So this is all about the demand function. Now we will talk about the demand schedule. Demand schedule is basically a tabular presentation which shows different quantities of the commodity demanded at different prices by the consumer. Demand schedule is a tabular presentation that shows different quantities of the good demanded at different prices. Basically, there are two types of demand schedule, and those are individual demand schedule, and market demand schedule. Individual demand schedule is basically the demand schedule of the product by one consumer only, and market demand schedule is the demand schedule of the product by all the consumers in the market. So individual demand schedule is basically representing the information about the quantities demanded of the product by one consumer at various prices in the form of table, whereas market demand schedule shows the market demand at different prices of the product in the form of table. Now we will discuss about demand curve. A demand curve is basically a graphical representation of the demand schedule. Graphical representation of the demand schedule. Now, graphical presentation of individual demand schedule is basically individual demand curve and graphical presentation of market demand schedule is the market demand curve. So there are two types of demand curve, that is individual demand curve and market demand curve. Individual demand curve is basically the graphical presentation of individual demand schedule, whereas market demand curve is basically the graphical presentation of market demand schedule. So this is all about the overview of demand function, demand schedule and demand curve. Now students, in our next video we are going to start a new topic, that is law of demand. Hello my dear students, so how are you all? I hope all of you are fit and fine. So as if now we have discussed the meaning of demand and the determinants of demand in detail and basic concepts of demand function, demand schedule and demand curve till yet. Now we are going to discuss about the law of demand. Under law of demand, we will discuss about the statement of law of demand, assumptions on which law of demand is based, causes of law of demand, or you can say rationale behind law of demand, and the exceptions of law of demand. So let's get started with the introduction of law of demand. See, what is basically law of demand? Law of demand is a fundamental principle of economics which explains the nature of relationship between price of the good and its quantity demanded. Basically, it is a basic principle, or you can say law of demand is a basic principle of economics which explains the type of relationship between the price of the good and its quantity demanded. In simple words, we can say that the law of demand explains us about if the price of this digital pen will increase, then what will happen to its quantity demanded? Will the quantity demanded of this particular digital pen will decrease or increase as a result of increase in price, and vice versa? That is, if the price of this digital pen will decrease, then what will happen to its quantity demanded? Whether the quantity demanded of this digital pen will increase or decrease as a result of decrease in price of the digital pen. So basically we can say that law of demand explains a relationship between the price and the quantity demanded of the same good. Law of demand explains us that if the price of one good increases, then what will happen to its quantity demanded? Whether its quantity demanded will increase or decrease as a result of increase in price of that particular good, and vice versa. That is, what will be the effect on the quantity demanded of the good if the price of that particular good changes. Now another question comes in our mind. Who gave the law of demand? See, students, law of demand has been developed over time. And the development of law of demand is not related to only one economist. Basically, there were various economists who contributed towards the development of law of demand. But the major contribution towards developing the law of demand goes to Alfred Marshall. Now, who was the Alfred Marshall? Alfred Marshall was a prominent British economist. Prominent British economist. He gave various contributions in the field of microeconomics. Various contributions in the field of microeconomics. That is, he basically developed the concepts of principles of demand, principles of supply, and the conditions of market equilibrium. Moreover, he developed the concept of marginalism. Marginalism is a technique to find out the equilibrium condition. Okay, so various concepts of microeconomics were developed by Alfred Marshall. His most famous work was the development of his book, that is Principles of Economics. Principles of Economics. This book was published in the year 1890. So students, let's recall the law of demand. First, the law of demand was given by Alfred Marshall. Alfred Marshall was basically a prominent British economist who made various contributions in the field of microeconomics, and his famous work was his book named Principles of Economics, which was published in the year 1890. Now, what is law of demand? Law of demand is basically a fundamental principle, or you can say a basic concept of economics, which explains the nature of relationship, or you can say type of relationship between the price of the good and its quantity demanded, or you can say it explains the types of relationship between the price and the quantity demanded of the same good. So this is all about the introduction of law of demand. In our next video, we will discuss about the assumptions and the statement of law of demand. So we have gone through the introduction of law of demand, where we have discussed that law of demand was given by various economists, but the major contribution towards the development of law of demand goes to Alfred Marshall. Okay, so Alfred Marshall developed the law of demand in order to find out the relationship between price and the quantity demanded of the same good. He wanted to find out that what will happen to the quantity demanded of the good if the price of the good changes. Now in this video, we are going to discuss about the statement of law of demand, that is what is included under law of demand, and we are going to discuss about the list of assumptions on which law of demand is based. So first we will discuss about the assumptions on which law of demand is based, and second one we will talk about the statement of law of demand. So let's discuss about the assumptions of law of demand first. See, Alfred Marshall developed the law of demand in order to find out the relationship between the price of the good itself, and its quantity demanded. But at the same time, Alfred Marshall knew that the demand is affected not only by the price of the good itself, only, but also demand for a good is affected by factors other than the price of the good itself simultaneously, right? So demand is affected by the price of the good itself and the factors other than the price of the good itself simultaneously. Now what are the factors other than the price of the good itself? So we have already discussed about the determinants of demand, and the determinants which were other than the price of the good itself are considered under the factors other than the price of the good itself. Now what are the factors other than the price of the good itself include? It includes basically price of related goods, that is price of complementary goods and price of substitute goods, taste and preferences of the consumer, disposable income of the consumer, right? And consumers' expectations. So these are some of the factors which are included under the factors other than the price of the good itself. But Alfred Marshall only wanted to know the relationship between the quantity demanded and the price of the good itself, right? So he took all other factors as constant because he wanted that the quantity demanded should not be affected by the change in any other factor apart from the price of the good itself, because he wanted to see only that if the price of the good itself changes, then what would be the effect on its quantity demanded. So he took the factors apart from the price of the good itself as constant. In order to remove the effect of these factors other than the price of the commodity itself, or you can say factors other than the price of the good itself on the demand of the good, as he just wanted that the only thing that could affect the demand of a good should be the price of the good itself. None other factor should affect the demand of the commodity, because he wanted to study the relationship just between the price and the demand of that particular commodity. So he took the factors other than the price of the good itself as constant. Okay, so these were the assumptions that were taken by Alfred Marshall for developing the law of demand. Now what are the assumptions? Assumptions are basically the beliefs or the ideas that are taken by economists as true without having any valid proof. Okay, so the Alfred Marshall took the assumptions that factors other than the price of the good itself will be constant. That is, there will be no change in the factors other than the price of the good itself. Now students, let's talk about these assumptions in detail. So as already discussed, that assumptions are basically the factors apart from the price of the good itself remains constant. That is, price of related goods remains constant. That is, the prices of the complementary good and the prices of the substitute good will remain constant. Next, taste and preferences of the consumer remains constant. That is, there is no change in the taste and preferences of the consumer. Next, disposable income of the consumer remains constant. That is, there is no change in the disposable income of the consumer. Next, consumers' expectations will remain constant. That is, there will be no change in the consumer's expectation. So these are basically the assumptions which were taken by Alfred Marshall to develop the law of demand. That is, factors other than the price of the good itself will remain constant. Okay. Now, the statement that factors apart from the price of the good itself will remain constant is basically ceteris paribus. Okay, this is known as ceteris paribus, that factors apart from the price of the good itself will remain constant, or you can say determinants which are other than the price of the good itself will remain same. Okay. So these are all about the assumptions of the law of demand. Now we will talk about the statement of law of demand. So let's discuss the statement of law of demand. What do you mean by statement of law of demand? Statement of law of demand means what is included under law of demand. What is the type of relationship between the price and quantity demanded of the same good? What is the nature of relationship that is existing between the price of the good and its quantity demanded? So students, as already discussed, that there is inverse, or you can say negative, or indirect, or opposite relationship between the price of the good and its quantity demanded. That is, if the price of the commodity increases, or you can say if the price of the good increases, then its quantity demanded decreases, and vice versa. That is, if price of the good decreases, then its quantity demanded increases. So as already discussed, when the price of the commodity increases, then it becomes costly for the consumers. So consumers prefer to purchase that good in less quantities. So the quantity demanded of that good as a result of increase in price decreases, and vice versa. That is, if the price of the commodity decreases, then it becomes cheaper for the consumers, and hence they purchase that good in more quantities. So the quantity demanded of that good increases as a result of decrease in its price. So the statement of law of demand is basically other things remaining constant, that is ceteris paribus, there is an inverse relationship between the price and quantity demanded of the same good. So I hope students the statement of law of demand is clear to you. So let's recall it. Statement of law of demand. Other things remaining constant, that is other things remaining same, or you can say the factors which are affecting the demand apart from the price of the good itself remains constant. There is an inverse relationship between the price and the quantity demanded, and there exists a negative relationship, or you can say an indirect or inverse or opposite relationship between the price and the quantity demanded of the same good. That is, if the price of the good increases, then its quantity demanded decreases, and vice versa. For example, if the price of this digital pen will increase, then the quantity demanded of this digital pen will decrease, and vice versa. Vice versa means if the price of this digital pen will decrease, then the quantity demanded of that digital pen will increase. So students, this is all about the statement of law of demand. In our next video, we will discuss about the reasons behind law of demand, or you can say reasons behind the operation of law of demand, or you can say rationale behind law of demand. Hello my dear students, so how are you all? I hope all of you are fit and fine. In our previous video, we have gone through the statement of the law of demand, and in this video, we are going to talk about the rationale of the law of demand. Now, what do you mean by rationale of the law of demand? It means causes of operation of law of demand, or you can say reasons behind the operation of law of demand. That is why the law of demand works. As we know that law of demand is basically related to the inverse relationship between the price of the good and its quantity demanded. That is, if the price of the good increases, then its quantity demanded decreases and vice versa. Now, rationale of the law of demand means why there is an inverse relationship between the price of the good and its quantity demanded. That is, why it is so that when the price of the good increases, then its quantity demanded decreases and vice versa. So, now students, we are going to discuss about the reasons behind the inverse relationship between the price and quantity demanded of the same good. Also, we know that the demand curve is downward sloping because of the fact that there exists an inverse relationship between the price and the quantity demanded of the same good. So, we can say that we are going to discuss about the reasons behind the downward sloping demand curve. That is, why the demand curve is downward sloping or why the demand curve is negatively sloped. So this is about the overview of the rationale of the law of demand. So let's discuss the reasons behind the inverse relationship between price and quantity demanded of the same good, or you can say rationale of the law of demand. First, students, we will discuss all the points regarding the rationale of the law of demand in brief, and later on we will discuss all these points in detail. So let's get started. First is price effect. Now students, price effect includes two types of effect, and those are substitution effect. Substitution effect is basically related to the concept of substitute goods. Next is income effect. Income effect is also known as real income effect. Basically, it is related to the real income, or you can say purchasing power of the consumer. Next, utility maximizing behavior of consumers. Now, as we know that every consumer, while consuming the commodities, wants to increase the satisfaction after consuming the commodity, right? And every consumer wants to get the maximum satisfaction out of the consumption of the commodity as possible. So, every consumer, or you can say every buyer, is involved in increasing the utility, or you can say the satisfaction on the consumption of good, or you can say every consumer wants to maximize the satisfaction from the consumption of the goods. So students, we will discuss about utility maximizing behavior of consumers as a rationale of the law of demand in detail in the further video. Next, arrival of new consumers. So whenever the price of the commodity decreases, the new consumers enters the market. As a result of that, total number of buyers, or you can say total number of consumers, will increase for the product in the market, and as a result of that, the demand will also increase. Next, different uses. As we know that various commodities are used for various uses. For example, milk is used for preparing sweet dishes, milk is used for drinking purpose, milk is used for making tea, right? So, milk is used for important purpose as well as for non-important purposes also. So, whenever the price of the good increases, the consumer start using the good only for important purposes, or you can say only for important uses. That is, he will use the milk only for drinking purpose. So, the demand for the commodity will reduce when the price of the commodity will increase, and vice versa. That is, if the price of the commodity will reduce, then the consumer will use that commodity for important as well as for non-important purposes also, and hence he will purchase more quantity of that particular good. So the demand for that particular good will increase as a result of decrease in price of that commodity. So here are the 4 reasons behind downward sloping demand curve. Now students, we will discuss all these points one by one in detail in our next video. Hello my dear students, so how are you all? I hope all of you are fit and fine. So in the previous video, we have gone through the overview of the reasons behind downward sloping demand curve, or you can say reasons behind inverse relationship between price and quantity demanded of the same good. Now in this video we are going to understand all those points in detail. So let's first understand about the price effect. As I already told you, price effect basically includes substitution effect and income effect, or we can say price effect is equal to substitution effect plus income effect. In other words, we can say that the combination of substitution effect and income effect is basically the price effect. Now to understand what is price effect, we will first understand the substitution effect and income effect separately. So let's first understand what is substitution effect. So let's have a look on the substitution effect. Substitution effect. Now substitution effect is related to the concept of substitute goods. Substitute goods are basically those goods which can be used in place of each other. This was already discussed under determinants of demand, right? So substitute goods are those goods which can be used in place of each other to satisfy the human wants. So as already discussed, substitute goods are basically those goods which can replace each other in order to satisfy the human wants, right? For example, tea and coffee, munch and perk. As under price of related goods, we have discussed about the price of substitute goods as a determinant of demand. Price of substitute goods under determinant of demand. So we have discussed that whenever the price of the commodity increases, then it becomes relatively costlier than its substitute good. Becomes relatively costlier than its substitute good. Or you can say the substitute good will become relatively cheaper since the commodity whose price has increased becomes relatively costlier. So the consumers will switch to their substitute goods. So the consumer will switch to substitute good. So the demand for its substitute good increases. Since the demand for its substitute good increased, so the demand for the main commodity, that is the commodity whose price have increased, will decrease, right? So this is one of the reasons that why the price of the commodity increases, then its demand decreases. It is because when the price of the commodity increases, then it becomes relatively costlier than its substitute good. So the consumers will prefer to buy its substitute good instead of the good whose price have increased. So that's why whenever the price of the commodity increases, then its demand decreases. For example, if tea and coffee are available at the same prices, then the consumers will be indifferent between the two. But if the price of tea increases, then tea will become relatively costlier than coffee. And the consumers who were earlier consuming tea will now start consuming coffee as they are getting the same satisfaction from tea and coffee, and they will be able to save their money by consuming coffee at this point of time. So as a result of that, the demand for coffee will increase, but the demand for tea will decrease. So this is basically the example which explains this aspect. Now let's talk about its vice versa effect. That is, if the price of the commodity decreases, then it becomes relatively cheaper than its substitute good. So the demand for its substitute good will decrease and the demand for commodity whose price have decreased will increase, right? For example, tea and coffee. Let's suppose the tea and coffee are available at the same prices. So the consumers will be indifferent between the two. But later on, the price of tea decreases. Now, as a result of decrease in price of tea, the coffee will become relatively costlier than tea. Or you can say the tea will become relatively cheaper than coffee. So the consumers who were earlier consuming coffee will now start consuming tea instead of coffee. And as a result of that, the demand for coffee will decrease and the demand for tea will increase. So why the demand for tea will increase in this case? It is because of the fact that when the price of tea decreases, then it becomes relatively cheaper than its substitute good. So the consumers who were earlier consuming the substitute good will switch towards consuming the tea. So as a result of that, the demand for tea will increase. So this is another aspect which shows that whenever the price of the commodity decreases, then why its demand increases. So this is all about the substitution effect. So students, this is all about the substitution effect. Now we will talk about the income effect. Income effect is also known as real income effect. Real income effect. Now what is real income? Real income is basically the purchasing power of the consumer. Purchasing power of the consumer. That is his ability to buy the goods and services. Now let's understand what is income effect with the help of an example. Suppose you love kurkure and your mother gives you 20 rupees daily in order to buy the packet of kurkure. Okay. So now let's suppose the price of one packet of kurkure is rupees 10. So now you will be able to buy 2 packets. This is basically your purchasing power, that you will be able to buy 2 packets of kurkure with 20 rupees, right? But now let's suppose the price of packet of kurkure increases to 20 rupees. Now, will you be able to buy the 2 packets from 20 rupees? No. You require 40 rupees in order to buy the 2 packets now. So now, with the 20 rupees, you will be able to buy only 1 packet of kurkure. So now your purchasing power have reduced. Earlier your purchasing power was 2 packets of kurkure and now it reduced to 1 packet. So what we have observed that whenever the price of the good increases, then the purchasing power, or you can say the real income or purchasing power of the consumer, will decrease. Now decrease in purchasing power means the consumer will be able to buy less quantity of the good at the same income level, right? So as a result of decrease in purchasing power of the consumer will be able to demand less. So whenever the price of the good increases, the demand of that particular good decreases because the purchasing power of the consumer decreases. Now let's suppose earlier the price of packet of kurkure was 20 rupees. So the consumer was able to demand 1 packet of kurkure only. Now let's suppose the price of packet of kurkure decreases to 5 rupees. So now with 20 rupees, the consumer will be able to buy 4 packets of kurkure. So here we can observe that the purchasing power of the consumer have increased from 1 packet to 4 packets, right? So whenever the price of the good decreases, then real income, or you can say purchasing power of the consumer, increases. That means the consumer is able to buy more quantities of the goods and services at the same income level. So as a result of increase in purchasing power or real income of the consumer, he will increase the demand for goods and services. So this is all about the income effect, that whenever the price of the good increases, then the purchasing power, or you can say real income of the consumer, decreases. So the consumer decreases the demand for the product and vice versa. So this is the reason about inverse relationship of price of the good and the demand for the good. So students, we have just discussed that whenever the price of the good decreases, then the quantity demanded of that good increases. Quantity demanded of that good increases. And whenever the price of the good increases, then quantity demanded of that good decreases. Right? So why it is so? It is because of the substitution effect and income effect. The substitution effect and the income effect together will lead to increase in quantity demanded when the price of the good decreases and vice versa. And the overall effect on the quantity demanded of the good when the price of the good changes is known as price effect. Price effect. Okay. Price effect is basically how the consumer changes its purchases of the quantity of the good when the price of the good changes. That is how the consumer changes, that is increases or decreases the purchases of a particular good when the price of that particular good changes, or you can say when the price of that particular good increases or decreases. So price effect is a combination of substitution effect and income effect, because whenever there is change in price of the commodity, then two effects become effective. First is substitution effect and the another one is income effect. So price effect takes place due to substitution and income effect. So we can say that price effect is a combination of substitution and income effect. That is, price effect is equal to substitution effect plus income effect. So this is all about the price effect, guys. I hope the price effect is clear to you. Students, let's go through the content about the price effect. So the price effect basically indicates the way the consumer's purchases of good X change when its price change. That is, price effect refers to the impact on the consumer's purchases, or you can say the effect on the consumer purchases due to change in price of the commodity itself. That is how the consumer's purchases will be affected due to change in price of the good. So here in the context of this content, price effect indicates that how the consumer's purchases of good X will be affected due to change in price of good X. Next, price effect is basically the combination of substitution effect and income effect. So we can say that price effect is equal to substitution effect plus income effect. So let's recall it, price effect. The price effect indicates the way the consumer's purchases of good X change when its price change. Price effect is the combination of substitution effect and income effect. Price effect is equal to substitution effect plus income effect. Next, let's talk about the substitution effect. Now, what is substitution effect? When the price of the good falls, then it becomes cheaper than its substitute good and hence demanded more at reduced price and vice versa. Vice versa here means when the price of the good increases, then it becomes costly than its substitute good and hence demanded less at increased price. Next, substitution effect was explained by, or you can say was given by, Hicks and Allen. Sir John Hicks is the full name of Hicks, and Allen, the full name of Allen is Sir Wixell Allen. These both were the prominent British economists. The substitution effect was given by Hicks and Allen. So let's recall it. Substitution effect. When the price of the good falls, then it becomes cheaper than its substitute good and hence demanded more at reduced price and vice versa. Substitution effect was explained by Hicks and Allen. Further we have when the price falls, the substitution effect is always positive and vice versa. Vice versa here means when price increases, substitution effect is always negative. Now what does it mean that when price falls, then substitution effect is positive? This means that whenever the price of the commodity falls, then the substitution effect will operate, and due to the operation of the substitution effect, the demand of this particular commodity whose price have fallen will increase, right? Because as a result of decrease in price of the commodity, this particular commodity will become cheaper than its substitute good, and vice versa in case of price increases. Whenever the price increases, then substitution effect is always negative. Substitution effect is always negative. This means whenever the price of the commodity increases, then due to the substitution effect, the demand of that particular commodity decreases, because that particular commodity becomes costly than its substitute good. So let's recall it. When the price falls, then substitution effect is always positive and vice versa. Next we will talk about cases in which substitution effect is stronger. Okay, the substitution effect will be stronger when goods are closer substitutes of each other. That is, there is greater degree of replacement among the goods. So whenever the goods are closer substitutes of each other, then these can be replaced easily by the consumers. For example, Coke and Pepsi. Right? For example, Mr. Ram loves Coke as much as he loves Pepsi. So for Mr. Ram, Coke and Pepsi are the closer substitutes of each other, and he will not have any problem while switching from Coke to Pepsi or Pepsi from Coke. Okay, so substitution effect is stronger whenever the goods are closer substitutes. That is, the consumer find it very easy to replace the goods in place of each other. Next, lower cost of switching to the substitute good. Here lower cost means less expenses. So whenever less expenses are involved while switching to the substitute good, then the consumer will be able to switch to the substitute good very easily, and hence in that case also the substitution effect will become stronger. Next, lower inconvenience while switching to the substitute good. Whenever the consumer faces less degree of discomfort, inconvenience means discomfort. So whenever the consumer faces less degree of discomfort in switching to the substitute good, in that case also the consumer will easily switch to the substitute good and the substitution effect will become stronger. So let's recall the cases in which substitution effect becomes stronger. So cases in which substitution effect is stronger: A, the goods are closer substitutes; B, lower cost of switching to the substitute good. C. Lower inconvenience while switching to the substitute good. Now, we will talk about the income effect. Income effect, as already discussed, is also known as real income effect. Now, when the price of a good falls, then the consumer's real income will increase. That is, the consumer's purchasing power will increase. Hence, he will demand more and vice versa. Vice versa here means when the price of a good increases, then the consumer's real income will decrease. And as a result of decrease in consumer's real income, he will demand less. So let's recall it. Income effect. When the price of a good falls, the consumer's real income will increase. Hence, he will demand more and vice versa. So students, this is all about the price effect. I hope the concept of price effect is clear to you. Now, in our next video, we will talk about the utility maximizing behavior of consumer as a point of rationale of law of demand. Utility maximizing behavior of consumers. Now, what do you mean by utility? See, whenever we consume anything as a consumer, we get the satisfaction. For example, whenever we drink the water, our thirstiness is gone, right? So our quench is satisfied. So this is the satisfaction that we are getting from consuming the water. So whenever we consume anything, we get the satisfaction. Like right now, you are consuming the recorded lectures of mine. Why? Because it is providing you the satisfaction. That is, you are able to understand the concept properly. You are able to prepare for your exams properly. Right? So whenever the consumer consumes something, that is, uses the goods and services, then he gets the satisfaction. So whatever amount of satisfaction that a consumer get after consuming the goods and services, then that is called utility. And students, every consumer wants to maximize the satisfaction that he is getting from consuming the goods and services. Here maximization, or you can say maximizing, means increase as much as possible. So every consumer wants to increase the amount of satisfaction as much as possible that a consumer get after consuming the goods and services. Now, every time whenever the consumer consumes something, his aim is basically to maximize his utility after consuming goods and services. So this is the consumer's behavior, that consumers are always engaged in maximizing their utility after consuming the goods and services. So now let us understand what does it means as a point of rationale of the law of demand. So let's understand the behavior of the consumers while making the purchasing decision. Now what is purchasing decision? Purchasing decision is basically when the consumer decides that whether to purchase the commodity or not. And if the consumer has decided to purchase the commodity, then in what quantity the commodity should be consumed. See, every time the consumer takes the buying decision by considering the utility of the good with the price of that, whenever the utility of the good, that is the amount of satisfaction that he will be getting after using that good, whenever the utility of the good would be greater than or equal to the price of that particular good, then the consumer buys that particular commodity. Because in this case, the consumer find it worth buying, right? Because the price is equivalent to the amount of satisfaction that he will be getting after consuming the good, or the satisfaction that he is getting on consumption of the good is greater than the price that he is paying to purchase that particular good. But in case whenever the utility of the good is less than the price of it, then in that case the commodity is costly for the consumer, because he need to pay the higher price and he is not getting as much as satisfaction from the good equivalent to the price, right? So he will not purchase the commodity or will not buy the commodity. So the consumer will buy the commodity only when the utility of the good is greater than or equal to the price of it. So this is all about how the consumer takes the buying decision about how to buy a particular good or not, right? Let's suppose if consumer wants to take the decision regarding the purchase of good X, that whether to buy the good X or not, then the consumer will compare the utility of good X with the price of good X. If the utility of the good X is greater than or equal to the price of good X, then the consumer will buy good X. And if the utility of good X is less than the price of good X, then in that case the consumer will not purchase good X. So this is how a consumer takes a buying decision about whether to buy the commodity, or you can say a good or not. Till now, students, we have discussed about how the consumer takes the decision about whether to purchase a particular commodity or not. Now we will decide about how the consumer will decide about how many units of a particular good to buy. Right. That is whether to buy 3 units of a particular good or to buy 5 units of a particular good in order to maximize the utility. So for every unit, the consumer will compare the utility of the unit of the good with the price to be paid to purchase that particular unit. Price for that particular unit of the good. Let's suppose for deciding that whether to purchase the second unit of the good or not, the consumer will compare its utility with the price to be paid for purchasing the second unit of the good. Let's suppose the utility that a consumer is getting on the consumption of the second unit of the good is greater than the price to be paid for purchasing the second unit of the good, then the consumer will buy the second unit of the good, right? Now, utility on any particular unit, like utility on the consumption of second unit of the good or utility on the consumption of third unit of the good, is basically the marginal utilities. Marginal utilities. If I talk about marginal utility 3, this means I am talking about the amount of satisfaction that the consumer will get on purchasing the third unit of a particular commodity. If I am talking about marginal utility 2, that means it is the amount of satisfaction that a consumer will get on the consumption of second unit of the commodity. If I talk about marginal utility 4, that means I am talking about the amount of satisfaction that a consumer will get on consumption of fourth unit of the commodity. So for deciding which unit of the commodity to buy or not, the consumer will compare its marginal utility with the price of that particular unit of the good. Okay. So till now, students, we have discussed that marginal utility and prices will be compared to each other in order to take the buying decision. If the marginal utility would be greater than or equal to the price, then the consumer will keep on purchasing the units of the commodity. Keep on purchasing the units of the good. And whenever the marginal utility would be less than the price of the good, then the consumer will stop purchasing the units of that good. Consumer will stop purchasing the units of that good. Okay. Now students, we will discuss about the specific meaning of marginal utility. See, utility means the amount of satisfaction that a consumer is getting on the consumption of goods and services, and marginal here means additional unit, or you can say extra unit, additional unit, or you can say extra unit of the commodity. Now, what is marginal utility? Marginal utility is basically the amount of satisfaction that a consumer gets on the consumption of extra unit or additional unit of the commodity. Okay, so the amount of satisfaction that the consumer is getting on the consumption of additional unit of the commodity, that is called the marginal utility. So this is all about the meaning of marginal utility. Now we will discuss about the law of diminishing marginal utility. This is also known as law of DMU. Now, law of diminishing marginal utility states. Now, this law of diminishing marginal utility states that if a consumer is involved in continuous consumption of a particular commodity, that if the consumer is consuming more and more units of a particular commodity, then the marginal utility on the consumption of extra units of the commodity, keeps on decreasing, right? So as a consumer is involved in consuming more and more units of a particular commodity, let's suppose a consumer is consuming chapatis in a continuous way. So as a consumer is increasing the consumption of chapatis from 1 unit to second unit to 3 units and so on, then what will happen? The utility on the extra units of the chapati will go on diminishing. That is, the utility from the consumption of second chapati would be less than the utility obtained from the consumption of first chapati, and utility obtained from the consumption of third chapati would be less than utility obtained from the consumption of second chapati, and so on. So as I already told you that the consumer compares the utility with the price while taking the buying decision. So since the utility on every subsequent chapati keeps on decreasing, so the consumer will ready to buy that subsequent units of chapati only at the reduced prices. For example, the consumer will buy the second chapati at a lesser price than the price of the first chapati, as the satisfaction from the second chapati is less than the satisfaction obtained from the first chapati. Similarly, the consumer will like to purchase the third chapati at a price lower than the price paid to purchase the second chapati. And so as the utility on the additional units keeps on decreasing, so the consumer will like to buy those units at reduced prices. So that's why when the price of the commodity decreases, the quantity demanded of that commodity will increase, and vice versa. And one more thing I would like to point here is that, as I told you, that the aim of every consumer is to maximize his level of satisfaction. Maximize his level of satisfaction, or you can say utility. So every consumer would be able to maximize its satisfaction whenever marginal utility of the good is equal to the price of that particular good. So every consumer wants to equalize the marginal utility with the price of that good. So every consumer wants to equalize the marginal utility with the price, right? Since and also as we know that whenever the consumer is consuming more and more units of a particular commodity, then the marginal utility of that commodity goes on decreasing. So as the marginal utility of the commodity goes on decreasing, so the consumer also wants to decrease the price in order to purchase that additional units, so that he could be able to maximize his satisfaction by equalizing the marginal utility with the price of the commodity. Okay. So both the law of diminishing marginal utility and the action of the consumer to equalize the marginal utility with the price leads to more demand of the commodity at the lower prices of the commodity. So consumers maximizing behavior is one of the reasons about why the demand is more at low prices and why the demand is less at higher prices, because the consumer will not like to pay the higher prices for the additional units of the commodity, because the utility decreases on the consumption of the additional units of the commodity. So students, I hope consumer maximizing behavior as a rationale of the law of demand is clear to you. So let's go through the content of utility maximizing behavior of consumers as a rationale of law of demand. The consumer has diminishing utility. Diminishing utility means decreasing amount of satisfaction for each additional unit of a commodity. That is, if the consumer goes on consuming more and more units of the commodity, then the utility obtained on the consumption of additional units goes on decreasing. So basically it is depicting the law of diminishing marginal utility, and therefore he will be willing to pay less for each additional units. So since on the consumption of the extra units, the marginal utility goes on decreasing, so the consumer will be ready to pay less price in order to purchase the additional units of the commodity. So let's recall it. The consumer has diminishing utility for each additional unit of the commodity, and therefore he will be willing to pay less for each additional unit. Further, as already discussed, that operation of diminishing marginal utility, that is the application of diminishing marginal utility, and the act of the consumer to equalize the utility of the commodity with its price, results in downward sloping demand curve. So as already discussed, that the operation of diminishing marginal utility and the task of the consumer about equalizing the utility of the commodity with its price results in downward sloping demand curve. That is, results in inverse relationship of price and quantity demanded of the same good. So let's recall it. The operation of diminishing marginal utility and the act of the consumer to equalize the utility of the commodity with its price results in downward sloping demand curve. So students, this is all about the utility maximizing behavior of consumers as a rationale of the law of demand, the arrival of new consumers as a rationale of law of demand. Now, what do you mean by the arrival of new consumers? The arrival of new consumers here indicates to the entry of new consumers, or you can say buyers in the market. Now in this video we are going to discuss about the entry of new consumers or buyers in the market as a rationale of law of demand. So let's get started. Now students, to understand the arrival of new consumers as a rationale of law of demand, let's take an example. The price of one lipstick of sugar is rupees 500. Now at the price of rupees 500, there will be various potential consumers who want to purchase this particular lipstick but cannot purchase it because they cannot afford it. Later on, the price of lipstick reduces to 400 rupees. Now various potential consumers who were not able to purchase this lipstick at 500 rupees are now able to purchase the lipstick at 400 rupees. So what happens whenever the price of any commodity reduces, then new buyers enters the market. New buyers, or you can say new consumers, enters the market. Now, with the entry of the new consumers in the market for the product, the total consumers, that is the previous consumers, or you can say old consumers, and new consumers, increases. So as a result of entrance of the new consumers in the market, the total consumers in the market for the product increases. And also we know that the demand for the product is dependent on the number of consumers for that particular product. So since the total consumers of the product increases in the market, so the demand for the product will also increase. Demand for the product, or you can say commodity, will also increase. So the arrival of new consumers is the reason that the product is demanded more at lower prices. Because with the decrease in price of the good, the new consumers enters the market. And as a result of the entry of the new consumers in the market, the total consumers for that particular product in the market increases, and hence the demand for the product increases in the market. So let's recall it, arrival of new consumers as a rationale of law of demand. When the price of a commodity falls, more consumers start buying it because some of those who could not afford to buy it earlier will now be able to buy it, right? And this raises the number of consumers of the commodity at a lower price, and hence the demand for the commodity increases. So let's recall it, arrival of new consumers. When the price of a commodity falls, more consumers start buying it because some of those who could not afford to buy it earlier may now be able to buy it. This raises the number of consumers of the commodity at a lower price, and hence the demand for the commodity increases. So students, this is all about the arrival of new consumers as a rationale of the law of demand. Different uses of the commodity as a rationale of law of demand. So let's get started. Let's discuss different uses of the commodity. As we know that there are various commodities which are used for various purposes, or you can say which are used for many purposes. For example, milk. Milk can be used for important purposes, or you can say uses, like for drinking purpose, for making tea, and milk is also used for non-important purposes, like for making the sweet dishes, preparing sweet dishes. Okay. So now, when the price of the commodity is reduced, or you can say when the price of the commodity is less, then the consumer demands the commodity for important as well as for non-important purposes, because the consumer is able to afford that commodity very easily. So he uses that commodity for important and non-important uses. For example, if the milk will be available at lower prices, then the consumers will purchase the milk for drinking purpose, for making tea, as well as for preparing the sweet dishes. That is, the people will even prepare the sweet dishes daily at their home if the milk will be available at lower prices, right? So in that case, when the commodity is available at the lower prices, the consumers demands it for important as well as for non-important purposes. So the demand for that commodity increases at the lower prices. And whenever the price of the commodity increases, now it is difficult for the consumers to afford that commodity. So the consumers will demand that commodity only for important purposes. Or you can say the consumers will use the commodity only for important purposes. For example, as we know that milk are available at higher prices, so the consumer uses the milk only for important purposes like for drinking purpose and for making tea. So since when the price increases, the consumer uses a commodity only for important purposes and avoid using the commodity for non-important purposes, so the demand for that commodity decreases. So let's go through the content. Different uses. Many commodities have multiple uses. Multiple uses means many uses. When the prices of such commodities are high, they are put to limited uses only. That is, whenever the prices of such commodities are high, then they are used for limited uses only. That is, for important uses only. And when the prices of such commodities fall, then they are put to more number of uses. Then they are used for important as well as for non-important purposes. That is, they are used for more uses than earlier. Then, therefore, their demand will increase. So, since a commodity will be used for important as well as non-important purposes, so the demand for the commodity will also increase. So, let's recall it. Many commodities have multiple uses. When the prices of such commodities are high, they will be put to limited uses only. And when the prices of such commodities fall, they will be put to more number of uses and therefore their demand will increase. So this is all about the different uses of the commodity as a rationale of law of demand. So with this we have just ended up the rationale of the law of demand. Now students, in our next video we will talk about the exceptions of the law of demand. Hello my dear students, so how are you all? I hope all of you are fit and fine. So in our previous videos, we have gone through the rationale of the law of demand. That is the reasons behind the law of demand. Now in this video, we are going to discuss about the exceptions to the law of demand. Now what do you mean by exceptions to the law of demand? Basically, exceptions to the law of demand means the cases or the situations in which the law of demand is not applicable. So as we know that according to the statement of law of demand, there exists an inverse relationship, or you can say negative or opposite relationship between the price of the good and its quantity demanded. That is, if the price of the good increases, then its quantity demanded decreases, and if the price of the good decreases, then its quantity demanded increases. Right? So this is according to the statement of the law of demand. Now, if we will talk about the exceptions to the law of demand, it means that there are certain situations in which the inverse relationship between the price and the quantity demanded of the same good doesn't apply. That is, there are certain situations in which the price of the good will increase, but its quantity demanded will not decrease. And also there are certain situations in which price of the commodity will decrease, but its quantity demanded will not increase. So we are going to talk about those situations or cases in which the inverse relationship between the price of the good and its quantity demanded is not seen. Okay. So these situations are called exceptions to the law of demand. Also, we know that it is only because of the inverse relationship between the price and the quantity demanded of the same good that we have a downward sloping demand curve. Now, exceptions to the law of demand means the situations or you can say cases where the demand curve would not be downward sloping. Okay. So basically in these situations the demand curve would be upward sloping. Okay. So let's understand about the meaning of upward sloping demand curve. So let's talk about the upward sloping demand curve. The upward sloping demand curve is also known as positively sloped demand curve. Okay. So first, students, I am going to draw a positively sloped demand curve. So first I will draw a panel and will mark the origin, y-axis and x-axis. On y-axis we show price of the good and on x-axis we show quantity demanded of the good. Now, positively sloped demand curve is like this. Basically, positively sloped demand curve means going upward from the origin, right? Now, what does this positively sloped demand curve indicate? So, to understand this, let's take a point A on a demand curve. Now, this indicates that at price OP, the consumer demands OQ quantity of the good. Now, when the price increases from OP to OP1, so now the price increases from OP to OP1. Now let's see what is the quantity demanded in this case. So at the price of OP1, the quantity demanded is OQ1, right? So the quantity demanded is also increased from OQ to OQ1. So this is indicating that whenever the price of a commodity will increase, then its quantity demanded will increase. And now let's see if the price of the commodity decreases, then what happens in this case. So here OP is the original price. Let's suppose the price reduces and becomes OP2. OP2 is the reduced price. Now let's see what is the quantity demanded at price OP2. The quantity demanded becomes OQ2, right? So the quantity demanded decreases with the decrease in price. As we can see, the original quantity was OQ and now the quantity at the reduced price, that is OP2, is OQ2. So with the decrease in price, the quantity demanded of the good also decreases. So positively sloped demand curve is basically indicating the positive relationship between the price and the quantity demanded of the same good. Quantity demanded of the same good. That is, if the price of the good increases, then its quantity demanded increases, and if the price of the good decreases, then its quantity demanded decreases. So in the situations where law of demand is not applicable, in that situations we will get an upward sloping demand curve, or you can say positively sloped demand curve, indicating the positive relationship, or you can say the direct relationship between the price and the quantity demanded of the same good. Now students, I will give you an overview about the exceptions to the law of demand. That is, I will give you an overview about the situations in which the law of demand will not operate. So let's go through the points. First, conspicuous goods. Now what are conspicuous goods? Conspicuous goods are the Veblen goods, or you can say status symbol goods. These goods are basically consumed by the rich people in order to show off their status in the society. For example, iPhone 14 Pro and luxury cars like BMW, etc. And these goods are basically becomes more attractive when their price increases. So these goods are demanded more at higher prices. So conspicuous goods are the exceptions to the law of demand. Next, Giffen goods. Giffen goods are a special type of inferior goods, that is low quality goods, which are demanded more when their price increases. So that's why these are also covered under the exceptions to the law of demand. Next, conspicuous necessities. Now there are certain goods which we use because our friends or relatives are using, and with the consumption of these goods become necessary for us. For example, televisions, fully automatic washing machines, etc. So even if the price of such goods increases, their demand doesn't fall with the increase in price. So that's why these also comes under exceptions to the law of demand. Next, future expectations about prices. If the consumer is expecting that the price of the good will further rise in near future, then he will demand more quantity of the good even at increased prices, and vice versa. Next, incomplete information and irrational behavior. If the consumer is ignorant about the prices prevailing in the market, that is, if the consumer is not having the complete information, or the consumer is not sensible to take the buying decisions, that is, he is showing irrational behavior while purchasing the goods, that is, he is purchasing the goods without considering the use of that particular good, without considering the satisfaction that he will get on the consumption of that particular good, then in that case law of demand is not applicable, because if the consumer is ignorant about the prices prevailing in the market for a particular product, then he will purchase that product at higher prices. Next, demand for necessaries. Now, necessity goods, or you can say necessaries, are basically the items which are important for our survival. For example, salt, sugar, etc. So these goods are demanded even at high prices. So there is a negligible effect on the demand for necessity goods when the price of the commodities increases or decreases. Since these are necessities and we are already purchasing the important quantity of these necessity goods, so there is negligible effect on the quantity purchased of the necessity goods whenever the prices of the necessity goods changes. Next, speculative goods. Now speculative goods are basically those goods which are used for making money out of money. For example, shares, debentures, etc. So these goods become more attractive whenever their prices increases. So speculative goods are demanded more at higher prices. So these are also covered under the exceptions to the law of demand. So students, this is all about the overview about the exceptions of the law of demand. In our next video, we will discuss about all these points in detail. Hello my dear students, so how are you all? I hope all of you are fit and fine. So in our previous video, we have gone through the overview of the exceptions to the law of demand. Now in this video, we are going to talk about those exceptions in detail. So first we will talk about the conspicuous goods. Conspicuous goods are also known as Veblen goods or luxury goods or status symbol goods. Status symbol goods. Basically, conspicuous goods are those goods which are used by the rich people in order to show off their financial status in the society. So that's why these goods are also known as status symbol goods. These goods are very expensive, so they are luxury goods. Okay. Conspicuous goods are basically the articles of prestige value. That is the articles, or you can say the goods to show off the status in the society. Prestige value here means the value of being high financial status. Or these are also known as articles of snob appeal. So snob appeal, we have already discussed about it. Snob appeal is basically the items which are purchased because those items are unique. No one is purchasing that particular item. So that is called snob appeal. Or conspicuous goods are also known as the articles of conspicuous consumption. Okay. So these are basically used by the rich people, as already discussed, as status symbol. That is to show off the status in the society, so that their social prestige, that means their value in the society, increases. Or for displaying wealth, or to show off their wealth in the society. Okay. So let's recall it. Articles of prestige value or snob appeal or articles of conspicuous consumption are used by rich people as status symbol for enhancing their social prestige or for displaying wealth. Further, so as already discussed, these goods or articles are those goods which are used to show off the status in the society. So these goods become more attractive when their prices are high, or when their prices keep going up, or you can say when their prices are continuously rising. It is because the higher the price would be, the higher it will show your financial status in the society. For example, diamonds, luxury cars like BMW, etc. So these goods like diamonds, luxury cars are purchased more at higher prices in order to show off the status in the society. So this is called the Veblen effect or prestige goods effect. So let's recall it. These articles are more attractive only if their prices are high or keep going up. For example, diamonds. This is known as Veblen effect or prestige goods effect. Veblen goods are also known as prestige goods. So Veblen effect is also known as prestige goods effect. Next, Giffen goods. So students, Giffen goods were named after Sir Robert Giffen. Sir Robert Giffen was a Scottish statistician and economist. So basically, Giffen goods were invented by Sir Robert Giffen. Now, what are Giffen goods? As already discussed, Giffen goods are basically the type of inferior goods whose demand increases with the increase in its price. So that's why Giffen goods comes under exceptions to the law of demand. So now how the Giffen goods were invented? So basically Giffen goods were invented by Sir Robert Giffen with his observation that when the price of bread increases, then the British workers were consuming more bread than they used to consume it earlier. So the quantity demanded of bread increases. So it was against the law of demand, right? So let's understand the meaning of Giffen goods with the help of an example. Let's suppose Mr. Ram is economically backward and he is able to earn very less amount of income. He likes meat very much. So as we know that there are 7 days in a week. 1st, 2nd, 3rd, 4th, 5th, 6th, 7th. Now Mr. Ram consumes bajra chapati on the 6 days of the week, and somehow he is able to manage his income in such a way that he can consume meat on the 7th day of the week. So, bajra chapati, bajra chapati, bajra chapati, bajra chapati, bajra chapati. Now comes the 7th day of the week on which he consumes meat. Okay? Students, here we need to focus on that. Since Mr. Ram is having very less amount of income, so it is very difficult for him to consume meat for one day in a week. But still, somehow he is able to manage. But it's very difficult for him to manage with such a very less amount of income. But yes, he is able to manage to have meat on the 7th day. Okay. But later on, what happens? The price of bajra increases. Okay. Now, when the price of bajra increases, then the expenditure of consuming bajra chapatis increases. Now, as a result of increase in expenditure of consuming bajra chapatis in 6 days of a week increases, now Mr. Ram is not able to manage his income to consume the meat on the 7th day of the week. So, on the 7th day also, he will consume bajra chapati now. Although he wants to consume the meat on the 7th day of the week, but now he cannot with the increase in price of bajra, because with the increase in price of bajra, he doesn't left any income with himself to consume the meat on the 7th day. Okay. So he cannot afford the meat even on 7th day of the week now. So he will consume the bajra chapati even on the 7th day. So what happens with the increase in price of bajra? The quantity demanded of bajra increases, right? As now Mr. Ram will consume bajra on all the 7 days of the week. And we know that bajra is basically an inferior good, right? Inferior goods are basically those goods which are of low quality. And so now what are jiffin goods? Jiffin goods are basically the type of inferior goods which are demanded more when the price of those goods increases. In this example, Mr. Ram doesn't want to consume bajra chapati on the 7th day of the week, but he is compelled to consume the bajra because none other option is left with Mr. Ram, right? So this is called Jiffin paradox. Jiffin paradox. Jiffin paradox is basically a situation in which a person is compelled to consume the Jiffin goods. So let's go through the content about Jiffin goods. The Jiffin goods were named after Sir Robert Jiffin. Jiffin goods are a type of inferior goods with no substitutes. These are basically those inferior goods which do not have any substitute available. So these are demanded more at higher prices. For example, bajra, low quality rice, etc. So let's recall it. Jiffin goods. The Jiffin goods were named after Sir Robert Jiffin. Jiffin goods are a type of inferior goods with no substitutes available, are demanded more at higher prices. For examples, bajra, low quality rice, etc. Next we have conspicuous necessities. So as I already explained you about conspicuous necessities, these are basically certain goods whose demand are affected by the demonstration effect. Now what is demonstration effect? We have already discussed about it, that whenever the consumer demands about certain goods because his friends or his relatives are using that particular good. Okay. So that is called demonstration effect. So these goods, due to the constant usage, because we also consume such type of goods which our relatives and friends are consuming. So due to the constant usage of these goods become necessities of life for us. Okay. For example, LEDs, automatic washing machines. Okay. Since these goods are become necessities of life, so there is no decrease in demand for such goods even when their prices increases. So let's recall it conspicuous necessities. The demand for certain goods is affected by the demonstration effect. These goods, due to their constant usage, become necessities of life. Further we have, in spite of the fact that prices of television sets, refrigerators, air conditioners, etc. So these are basically the examples of conspicuous necessities like television sets, refrigerators, air conditioners, etc. So the prices of such goods are continuously rising, okay, but their demand doesn't show any fall, or you can say their demand doesn't decline. So let's recall it. In spite of the fact that the prices of television sets, refrigerators, air conditioners, etc. have been continuously rising, their demand doesn't show any fall. Next we have future expectations about prices. Students, this we have already discussed under the point consumers' expectations about future prices as a determinant of demand. Basically, we discuss it deeply under the topic of determinants of demand. There we discuss that if the consumers are expecting that the prices of the commodity will further rise in near future, then the demand for that particular commodity will increase, and vice versa, right? So let's go through it. When the prices are rising and households, that is the consumers, are expecting that prices in the future will be even higher, right? That the prices in the future will be higher than the present prices. Then such type of goods will be demanded more even at higher prices, and vice versa. Vice versa here means when the prices are reducing and households are expecting that the prices in the future will be even lower than the prices are in the present for the goods, then the consumers will demand less of that goods even at lower prices. So let's recall it. Future expectations about prices. When the prices are rising and households are expecting that the prices in the future will be even higher, then these goods will be demanded more at higher prices, and vice versa. Next, incomplete information and irrational behavior. Incomplete information means lack of complete information. For example, a consumer may demand larger quantity of a good even at higher prices because of his ignorance, or you can say because he was ignorant or he was unaware. Ignorance here means unaware about the ruling price, that is the market price, or you can say running price of the commodity. Generally, the male members of the family are ignorant about the prices of fruits and vegetables. So they purchase more quantity of fruits and vegetables even at higher price because of their ignorance. So this is basically the incomplete information leads to high demand of the product. So let's recall it. A consumer may demand larger quantity of a good even at a higher price because of ignorance about the ruling price of the commodity. Now we will talk about the irrational behavior of the consumer. Now what do you mean by irrational behavior of the consumer? This means the consumer behaves in an insensible way. The consumer doesn't behave in a sensible way. Okay. So the consumer is not rational while taking the purchasing decisions. The consumer is not sensible or rational while taking purchasing decisions. Okay. So law of demand is also not applicable when the consumer purchases the goods in an insensible way, or you can say without any sensible thinking. Okay. So whenever the consumer purchases the goods without thinking about the usefulness of the good, then in that case also law of demand is not applicable. Or you can say whenever the consumer purchases the goods without comparing the price of the good with the utility of the good, then also the law of demand might not be applicable, because the consumer might demand the goods more even when the utility of the good is less than the price of the good. So let's recall it. Law of demand is not applicable when the consumer purchases the goods without thinking about the usefulness of the product. Next, demand for necessaries. Here necessaries refers to the necessity goods or necessities. Necessity goods or necessities are those items, or you can say are those goods which are important for our survival, right? For example, salt, sugar, milk, etc. Without salt, sugar, milk, we will not be able to survive, right? So these goods are basically the necessity goods. So law of demand does not apply much in the case of necessaries of life. Why it is so? It is so because already the consumers are purchasing the essential quantity of the necessity goods. So whenever the price of the good changes, even then the consumers, or you can say people, have to consume the minimum quantities of necessary commodities, or you can say the required quantities of the necessary commodities. So there will be negligible change in the demand for necessity goods whenever their price changes. So let's recall it. Demand for necessaries. The law of demand does not apply much in the case of necessaries of life. Irrespective of price changes, people have to consume the minimum quantities of necessary commodities. Next, speculative goods. Speculative goods, as already discussed, speculative goods are those goods with the help of which we can do the speculation. Now what is speculation? Speculation is basically making money out of money. That is earning money by investing the money in certain financial securities. That is called speculation. And with the help of speculative goods, we can do speculation. And what are the examples of speculative goods? These are basically stocks and shares. For example, people generally buy the shares at lower prices and sell it out at the higher prices in order to get the capital gain. So this is an example of speculation with shares. Okay. So where the speculation is done, where the speculative goods are bought and sold. So these are bought and sold in speculative market. So in the speculative market also, law of demand is not applicable. So in the case of stocks and shares, or you can say speculative goods, law of demand is not applicable. Why it is so? Because speculative goods are demanded more when the price are rising. Or you can say speculative goods are demanded more even at high prices and demanded less even at less prices. Or you can say are demanded less when the prices decline. Why it is so? When the prices of shares of a particular company are rising continuously, okay, then the investors, or you can say the shareholders, have confidence in the shares of that particular company, and they expect that the price of share of this particular company will further increase in near future. So it's good to purchase these shares. So they are more attractive towards those shares whose share prices are increasing continuously, and vice versa. So let's recall it: speculative goods in the speculative market, particularly in the market for stocks and shares, more will be demanded when the prices are rising and less will be demanded when the prices decline. Students, with this I would like to finish the exceptions to the law of demand, and I hope that this topic is clear to you. Hello my dear students, so how are you all? I hope all of you are fit and fine. So till now we have discussed and finished the main topic of law of demand. Now in this video we are going to conclude about the law of demand. As I told you, the law of demand is not related to any single economist, but yes, the major contribution towards the development of law of demand goes to Alfred Marshall. And he took various assumptions to develop the law of demand. And those assumptions were the factors affecting the demand which are other than the price of the good itself. Price of the good itself will remain constant. That is, the price of the related good will remain constant, the disposable income of the consumer will remain constant, taste and preferences of the consumers will remain constant, and consumers' expectations will remain constant, etc. Next, statement of the law of demand. Now, according to the statement of the law of demand, other things remaining constant, there is an inverse relationship between the price of the good and its quantity demanded. Basically, law of demand defines a relationship between the price of the good and its quantity demanded, and it defines that there exists an inverse relationship or negative or opposite or indirect relationship between the price of the good and its quantity demanded. That is, if the price of the good increases, then its quantity demanded decreases, and vice versa. That is, if the price of the good decreases, then its quantity demanded increases. Now we will conclude about the causes of law of demand, or you can say rationale of law of demand. First, price effect. So as already discussed, that price effect is the combination of substitution effect and income effect. Second, consumers' utility maximizing behavior. Basically, the consumer's aim is to maximize the satisfaction that he gets after consuming the goods and services, and the act of maximizing his satisfaction and the operation of the law of diminishing marginal utility leads to the operation of law of demand. Third one, arrival of new consumers. Now, whenever the price of a commodity decreases, then new consumers enters the market. As a result of that, the total consumers in the market for the product increases, and that's why the demand for that particular product in the market also increases. Next, different uses of the commodity. Now, there are certain commodities which are used for many purposes, or you can say which are used for many uses. If the price of the commodity increases, then the consumers start using that commodity only for important purposes and avoid using it for non-important purposes. So that's why the demand of that particular commodity decreases with the increase in the price of that commodity. And when the price of the commodity decreases, or you can say the commodity is available at lower prices, then the consumers will use that commodity for important as well as non-important purposes. That's why the consumer will demand more quantity of the commodity at lower prices. So this is all about the causes of law of demand, or you can say rationale of law of demand. Now we will discuss about the exceptions to the law of demand. Now, exceptions to the law of demand means those situations in which the law of demand is not applicable. First, conspicuous goods. So these are basically those goods which are used to show off the status in the society. These are generally purchased by the rich people, and these goods become more attractive in case their prices are rising continuously or they are having very high prices. So these goods are demanded more at higher prices. Next one is Giffen goods. Giffen goods are a special type of inferior goods like bajra, low quality rice, which have no substitutes available, and these are demanded more at high prices. Third, conspicuous necessities. So these are basically those goods which becomes our necessities because of the demonstration effect. For example, LEDs, refrigerators, ACs, etc. Now the demand for LEDs, ACs, refrigerators will not decrease even if their prices are rising continuously. Fourth, incomplete information and irrational behavior. So whenever the consumers are not having the complete information about the prices prevailing for the product in the market, then the consumer might purchase more quantity of that particular product even at higher prices. And when the consumer doesn't buy the products by considering its usefulness or utility, then also the irrational behavior will lead to exception to the law of demand. Next, necessity goods. Necessity goods are basically those goods which are important for our survival. These are also known as essential goods. Essential goods. Since these are essential goods, so the consumers are already purchasing the important quantity of these goods, or you can say the required quantities of these goods. So with the increase or decrease in prices of such goods will not lead to increase or decrease in demand for such goods. Basically, there will be negligible effect on the demand of such goods due to change in prices of the goods. Next, speculative goods. Speculative goods are used for speculation purposes. These goods are also become attractive whenever the price of these goods increases. So law of demand is also not applicable in case of speculative goods. Next, expectation about future prices. If the consumers expect that the price of the particular commodity will further rise in future, then he will currently demand the commodity more, and vice versa. So this is all about the exceptions to the law of demand. So this is the entire conclusion about the law of demand. We are going to understand about the concept of wants. We have already studied about wants in chapter 1, right? So what are wants? Wants are basically our desires, or you can say wishes. Let's suppose Mr. Ram wants to have BMW car, iPhone 15 Pro, right? So what are these? These are basically wants of Mr. Ram. Okay. So now let's understand the wants in detail. See, as already discussed, wants are basically wishes or desires of any individual. Desire or wish to own and use goods and services. Basically, to purchase the goods and services and to use those goods and services that give satisfaction to the consumer, or you can say that gives benefit to the consumer, right? So let's recall it. Wants are the wishes or desires to own and use goods and services that give satisfaction. Now students, to have a good understanding of wants, let's go through the features of wants. So here are the features of wants. Now what do you mean by features of wants? Features of wants means characteristics, or you can say attributes of wants. So let's have a look on the features of wants. First, wants are unlimited in nature. So this we have already discussed under chapter 1 that wants are unlimited in nature. That is, wants are never ending, right? Wants are never ending. When one want is satisfied, another comes up. Like you can observe your behavior with your parents. When you ask your parents for a cycle and they give you cycle, then you ask them for a motorcycle. And after getting the motorcycle, you ask them for a car. After getting the car, you ask them for a luxury mobile phone like iPhone 15 Pro, right? So our wants are never ending. These are basically unlimited in nature. Next, wants differ in intensity. That is, different wants are having different degrees of intensity. Some are more intense and some are less intense. That is, some wants are urgent and some wants are not very urgent. For example, the want for a medical service after the accident is an urgent want, whereas the want to go for a trip is not an urgent want. It can be postponed, right? That is an less urgent want. Next, each want is satiable. Now what is this satiable? Satiable means ability to get fulfilled. Okay, so we have the power to fulfill all our wants. Okay, so each want can be fulfilled. Each want can be fulfilled, or you can say each desire of yours or each wish of yours can be fulfilled by you. Next, intensity of wants is the determinant of utility. Now what do you mean by utility? Utility means the amount of satisfaction that a consumer get after consuming any good or service. Okay, so the satisfaction which the consumer get from the use of any good or service is basically dependent on the intensity of wants of that particular good or service. If the consumer is having more intensity of want towards that good, then he will be able to get more benefit from the use of the good and vice versa. Next, wants are competitive in nature. Basically, all the wants compete with each other, right? And you can see we are having limited resources in order to satisfy our wants, and our wants are unlimited. And also we want to satisfy all of our want, right? We do not want to sacrifice any of our want. So that's why all the wants are competitive in nature. That is, they are providing competition to each other. So let's recall it till now. Unlimited in nature. Wants differ in intensity. Each want is satiable. Intensity of wants is the determinant of utility. Wants are competitive. Further, we have some wants are complementary in nature. Now, by saying wants are complementary in nature, we mean that some wants are satisfied with the help of two goods. Okay? Or you can say some wants are satisfied with the help of complementary goods. For example, if you want to travel, then you require car with petrol, right? If you want to go for a walk, then you require the right shoe as well as the left shoe, right? So some wants are satisfied with the help of complementary goods. Next, wants are subjective in nature. Now, what do you mean by wants are subjective in nature? Wants are subjective in nature means that wants are affected by the feelings, opinions, and taste of people. For example, nowadays people are having the taste of Android mobile phones. So their wants are mostly to buy the Android mobile phones, not the keypad mobile phones. Next, wants vary with time, place and person. That is, wants changes with the change in time, change in places and change in person. That is, wants are different at different time periods. For example, in summer season, we usually have the wants to buy the cotton clothes, right? Whereas in winter season, we have the wants to buy the woolen clothes. Next, wants are different even at different places. That is, when you are at your home, you prefer to have homemade food, right? But when you go out for a trip, then you prefer to take junk food, unhealthy food, right? But while you are at home, you prefer to have the healthy food. And wants differ from person to person. That is, different persons are having different types of wants. For example, some people are having the wants to buy iPhone 15 Pro and some people are having the wants to buy BMW car, right? So wants differ from person to person. Next, some wants reoccur again. That is, some wants are repetitive in nature. They arise again and again. For example, desire for better job. For example, desire for companionship, etc. Whereas others do not occur again and again. And some wants are like that, which do not occur again and again. For example, desire to get married do not occur once you get married. So let's recall it. Wants are complementary. Wants are subjective. Wants vary with time, place and person. And some wants reoccur again, whereas others do not occur again and again. Further, we have wants are affected by income, taste, fashion, advertisements and social norms and customs. That is, wants are dependent on the income level of the consumers, the taste of the consumers, fashion, advertisements, and the social norms and customs. Okay, let's see how the wants are affected by the change in income level. See, the people who belongs to high level of income, they prefer to go out on a foreign trip, whereas the people who belongs to middle class families, they prefer to go in domestic trips, right? Next, taste. Nowadays, people are having the taste of using the Android mobile phones, right? They do not have the taste of using keypad mobile phones. So most of us have the wants to purchase Android mobile phones rather than keypad mobile phones. Next, fashion. The goods which are in fashion are demanded more, right? Most of us are having the wants for the goods which are in fashion and less wants for the good which are outdated. Next, the goods which are advertised more by the firms are generally demanded by the people. That is, people are having more wants for those products which are advertised, right? But less wants for the products which are not advertised. Next, social norms and customs. In India, most of us wants to have the sari to wear, suits to wear, right? But less demands for the goods which are against our social norms and customs, like wants for vulgar dresses, etc. So let's recall it. Wants are affected by income, taste, fashion, advertisements, and social norms and customs. So students, this is all about the features of wants. Now let's go through the classification of wants. Classification of wants means the types of wants. Basically, the wants are divided into three types, or you can say three categories. And those are: number 1, necessaries; number 2, comforts; number 3, luxuries. Now, what are necessaries? Necessaries are basically essential items that an individual require for the survival of his life. Basically, necessaries makes the life possible. For example, minimum food, minimum clothes, etc. Next, comforts. While necessaries makes the life possible, comforts makes the life comfortable, or you can say comforts makes the life convenient. So comforts are basically those wants which makes our life convenient. For example, labor saving equipments. Next, luxuries. Luxuries are basically wants for having expensive goods. For example, want to have an iPhone 15 Pro, right? This is a luxury. Okay. So wants are basically classified into three, and those are necessaries, comforts, and luxuries. So students, this is all about the overview of the classification of wants. Now let's go through the classification of wants in detail. First, necessaries. Now, as already discussed, necessaries are those items which are essential for living. That is, necessaries are those items which are important for living, or you can say important for survival. For example, minimum food and minimum clothing, right? These necessaries are basically divided into three categories, and those are necessaries for life, next, necessaries for efficiency, and conventional necessaries. So we will understand all these one by one in detail. So before that, let's recall it. Necessaries are those items which are essential for living. Types of necessaries are necessaries for life, necessaries for efficiency, and conventional necessaries. First, necessaries for life. So necessaries for life are those items which are important, or you can say necessary, to meet minimum physiological needs. Physiological needs are basically the needs for those are basically those items which are required for survival, or you can say for maintenance of life, like minimum amount of food, shelter and clothing. So these are basically very basic requirements of life. That is minimum amount of food, shelter and clothing. So minimum requirements are basically called necessaries for life. So let's recall it. Necessaries for life. Items which are necessary to meet minimum physiological needs for the maintenance of life, such as minimum amount of food, shelter and clothing. Next we have necessaries for efficiency. Now necessaries for efficiency are above the necessaries for life. Now what are these necessaries for efficiency? Every one of us wants to maintain longevity. Now what is this longevity? Longevity means long life, right? Every one of us wants to have long life. Next, energy. Each of us wants to maintain energy level, right? That is, each of us wants to maintain a good stamina. Next, efficiency of work. Each of us wants to be efficient while doing any work. That is, each of us wants to be more productive while carrying out any work, right? So, for maintaining the longevity, energy level and efficiency at work, we require some items like nourishing food, clean water, education, etc. So these items are basically necessaries for efficiency. That is, those items which enables the individuals to maintain longevity, energy and efficiency of work. So let's recall it. Men require something more than the necessities of life. So as already discussed, necessaries for efficiency are above the necessities of life, or you can say necessaries for life, to maintain longevity, energy and efficiency of work. For example, nourishing food, clean water, education, etc. Next, conventional necessaries. Now, conventional necessaries are those items which we require due to our habit, okay, or due to compelling social customs and conventions. The items that we require due to our habit are basically the habitual goods. Habitual goods. For example, some of us have a habit of taking morning tea, right? So having a morning tea is a conventional necessary. Okay, if someone is having a habit of any good, then it becomes necessary for that particular person, right? So morning tea would be conventional necessary for those who have the habit of consuming morning tea. Next, we prefer to wear ethnic clothes during religious ceremonies, right? Why? Because it is due to our social customs and conventions, or you can say it is due to our social traditions, that our elders also used to wear ethnic clothes. So we people, we the younger generation, also prefer to wear ethnic clothes during religious ceremonies. So the ethnic clothes are the conventional necessaries for religious ceremonies. So conventional necessaries are not necessary, or you can say important, for existence or for efficiency, but these become necessary due to pressure of habit, or you can say due to compelling social customs and conventions. So let's recall it. Conventional necessaries. Conventional necessaries arise either due to pressure of habit or due to compelling social customs and conventions. They are not necessary either for existence or for efficiency. So this is all about the conventional necessaries. So till now we have discussed about the necessaries. Now we will talk about the comforts. Now what are comforts? As I already told you, necessaries makes life possible. right? Our survival is possible with necessaries, but comforts makes our life comfortable, or you can say comforts makes our life convenient. Okay, like good house, labor saving equipments, clothes that suits different occasions. These are basically the items which makes our life comfortable. Comforts are less urgent than necessaries, right? Necessaries are very urgent wants, whereas comforts are relatively less urgent wants. So let's recall it. While necessaries makes life possible, comforts makes life comfortable. So comforts are basically those type of wants which makes our life convenient, or you can say which makes our life comfortable. Comforts are less urgent than necessaries. That is, the intensity to have comforts is less as compared to the intensity to have necessaries. For example, good house, labor saving equipments, clothes that suits different occasions, etc. Next we have luxuries. Now what are luxuries? As I already told you, luxuries are basically those wants which are superfluous and expensive. That is the wants to have expensive cars, expensive clothing, classy furniture. These are basically luxuries. Here superfluous means much more than requirements. Much more than requirements. So luxuries are basically those wants which are much more than requirements and expensive, that is costly. These are not essential for life. These are not important for our survival, right? So luxuries includes basically those goods which are not required for survival, okay, or you can say which are not important for survival, but yes, these are important for show off the status in the society. For example, iPhone 15 Pro is a luxury. BMW car is a luxury. So let's recall it. Luxuries. Luxuries are those wants which are superfluous and expensive. These are not essential for living. For example, expensive clothing, classy furniture, etc. So this is all about the types of wants. So students, let's conclude about the content that we have gone through till yet. So we have gone through the meaning of wants. Wants are basically the desires or wishes to own and use the goods and services which gives satisfaction. There are various features of wants that we have discussed, like wants are unlimited in nature, competitive. Wants are affected by income level, passion, advertisements, etc. Right? Wants are subjective, etc. etc. Then we have gone through the types of wants. The wants are basically classified into three categories, and those are necessaries, comforts, and luxuries. So students, this is all about the concept of wants. In our next video, we will go through the meaning of utility and the types of utility. So till now we have gone through the concept of wants. We have gone through the meaning of wants, features of wants, and the classification of wants. Now we are going to understand about the concept of utility. Okay. So what is utility? See, utility means the satisfaction, or you can say amount of satisfaction that a consumer get after consuming the goods and services. Let's suppose someone is feeling thirsty. Then he will intake water, or you can say consume water. And after consuming water, he will be able to quench his thirst, right? So what is that? That is the amount of satisfaction that he got after consuming the water. If someone is feeling hungry, then he will consume chapatis, and after consuming chapatis, his hunger will gone, right? So what is that? That is satisfaction that he got after consuming chapatis. So whenever we as a consumer consume any good or service, or you can say use any good or service, then we get the amount of satisfaction. Whatever the amount of satisfaction that we get after consuming any good or service, that is called utility. Okay? So as already discussed, utility is basically the amount of satisfaction that a consumer get from the consumption of the goods and services. That is, utility is the amount of satisfaction that a consumer get after consuming, or you can say using, the goods and services. Now students, can we measure the utility, right? So basically, based on the measurement of utility, the economists are divided into two. Some economist says that utility can be measured in numbers. That is, utility is a cardinal concept, which means utility can be measured in numbers, and the unit in which the utility can be measured is utils. Okay, Marshall was in favor of measuring the utility in utils. Okay, whereas there were some economists who said utility cannot be measured. So utility is an ordinal concept. Utility cannot be measured, right? They said utility can only be ranked. Can be ranked. We can only rank the utility. We can only say that I get more satisfaction after consuming one mango than after consuming one apple. Alright, because I love mango more as compared to apple. So mango gives me more satisfaction as compared to apple. But what amount of satisfaction I'm getting from apple and mango cannot be determined. That is called utility is an ordinal concept. And J.R. Hicks were in favor of utility is an ordinal concept. So some economists said that utility cannot be measured, whereas some economists said that utility can be measured. So let's recall it utility. Utility refers to the amount of satisfaction that a consumer gets from the consumption of the goods and services. Next we will discuss about the two main types of utility. See students, the utility is divided into two main types, and those are total utility and marginal utility. Okay, so now we will understand what is total utility and what is marginal utility. So let's understand the total utility first. Let's suppose Mr. Ram is feeling thirsty. Okay, so he consumed the glasses of water. Basically, he consumed 3 glasses of water to quench his thirst. Okay, and the 3 glasses of water gives him satisfaction, right? Let's suppose the first glass of water gives him satisfaction of 10 utils, whereas the second glass of water gives him satisfaction of 8 utils, and whereas the third glass of water gives him the satisfaction of 5 utils. Okay, so now students, what is the total amount of satisfaction that he get after consuming all the 3 glasses of water? Is the total utility in this case. So he get basically 23 utils, right? So here 23 utils is the total utility. So what is the total utility? Total utility is basically the total amount of satisfaction that a consumer get after consuming all the units of a particular commodity. So here we have total utility refers to sum total of utilities derived from the consumption of all the units of a commodity consumed by the consumer at a given time. So let's recall it. Total utility is represented by TU. Symbolically, total utility is represented by TU. It refers to the sum total of utilities derived from the consumption of all the units of a commodity consumed by the consumer at a given time. So this is all about the total utility. Now we will have a look on the marginal utility. Basically, marginal utility is represented by MU. Okay. Now what is marginal? Marginal means extra unit. Extra unit. Or you can say additional unit. And utility we know about amount of satisfaction, right? So marginal utility is basically utility derived from the consumption of an additional unit of the commodity. Okay. So let's understand it with the help of an example. Let's suppose Mr. Ram is hungry. So he took 4 chapatis earlier. 4 chapatis earlier, right? And the total utility that he got after consuming 4 chapatis were 50 utils. And later on, he consumed 5 chapatis. And the total utility that he get after consuming 5 chapatis is 55 utils. Okay. So earlier Mr. Ram was consuming only 4 chapatis, whereas now he is consuming 5 chapatis. So that means fifth chapati is the extra unit of chapati, right? Extra unit of chapati, right? So what is the amount of satisfaction that he get from consuming the fifth chapati? So students, we will calculate it by 55 utils minus 50 utils, right? Which is 5 utils. As we can see, from consuming 5 chapatis, Mr. Ram is getting the total satisfaction of 55 utils, and from consuming 4 chapatis, he is getting the satisfaction of 50 utils. So that means the extra 5 utils is basically the satisfaction that he get from consuming the fifth chapati only, right? So that is the marginal utility in this case. As I told you, fifth chapati is the extra unit of chapati, and the satisfaction that he is getting from fifth chapati is the satisfaction that he get from consuming an extra unit of chapati, and that is the marginal utility of fifth chapati for Mr. Ram. Okay, so marginal utility is 5 utils. So now students, you can pay attention here that whenever you want to calculate the marginal utility, what you need to do is you need to apply the formula, which is marginal utility N is equal to TUN minus TUN minus 1. That is, whenever you want to calculate the marginal utility, then what you need to do is you need to go through the change in total utility whenever any additional unit is consumed. Alright. So for getting the change, so we can use this formula to calculate the marginal utility. MUN is equal to TUN minus 1. Okay. Basically, N is the unit of consumption for which you need to calculate the marginal utility. Let's suppose here I want to calculate the marginal utility for fifth unit. So I'll write MU5 is equal to TUN, N means 5, right? TUN, that means TU5 minus TU5 minus 1. So which is TU5 minus TU4, which is 55 utils minus 50 utils, which comes out to be 5 utils. Okay. So this is how you need to calculate the marginal utility. So let's recall it. Marginal utility. It is the utility derived from the consumption of an additional unit of the commodity. Now students, let's understand few points in order to get a better idea about total utility and marginal utility. Please students, what is the difference between MU5 and TU5? Basically the difference is MU5 will indicate the utility from consumption of fifth unit only. Utility from consumption of fifth unit only, right? Basically MU5 doesn't include the utility that the consumer get from consumption of first unit, from consumption of second unit of the commodity, and from consumption of third unit of the commodity, and from the consumption of fourth unit of the commodity. MU5 only indicates about the utility that a consumer get from consumption of fifth unit of the commodity only. Okay, whereas TU5 includes the satisfaction, or you can say utility, that a consumer get after consuming all the 5 units of the commodity. That is, TU5 here includes utility that a consumer get after consuming first unit, second unit, third unit, fourth unit, and fifth unit of the commodity. Okay. So TU5 is very wider term as compared to MU5, because TU5 includes the satisfaction that a consumer get after consuming all the 5 units of the commodity, whereas MU5 only includes the amount of satisfaction that a consumer get after consuming fifth unit of the commodity only, right? Similarly for MU3 and TU3, right? MU3 includes the utility that a consumer get from consumption of third unit only, right? Whereas TU3 includes the amount of satisfaction, or you can say the utility that a consumer get after consuming all the 3 units of the commodity, right? So I hope the difference between total utility and marginal utility is clear to you. Now students, we will discuss the formulae related to TU, that is total utility, and marginal utility, that is MU. So as already discussed, if we want to calculate the marginal utility from the total utility, the formula is MUN is equal to TUN minus TUN minus 1, right? And the second formula, if we want to calculate total utility from the marginal utility, then the total utility is equal to sigma marginal utility. That is, the sum of marginal utility will give us the total utility. For example, units consumed 1, 2, 3. Marginal utility 10 utils in utils, 8 utils and 5 utils. Okay, and here we need to calculate the total utility in utils. So what we need to do is, we need to just sum the marginal utilities at every step. So at the first step, the marginal utility is equal to the total utility. So at the first unit, marginal utility is equal to the total utility. Next, then to calculate the total utility at second unit consumed, what we need to do is, we need to add 10 plus 8. So we get 18. Afterwards, we need to add 18 plus 5. Then we get 23. So this is how you need to calculate the total utility. Like students, you calculate the cumulative frequency from the frequency given to you. In the same way, you need to calculate the total utility from the marginal utility. Okay. So these are the two formulas which are related to the total utility and marginal utility. Now students, we will go through the relationship between total utility and marginal utility. So let's have a look. So we will first prepare a schedule. Units consumed 1, 2, 3, 4, 5. Okay. and the marginal utility in utils. Students, always remember one thing while taking the figures of marginal utility, that marginal utility first remains positive but declines. Okay, that is marginal utility falls but remains positive, and then marginal utility becomes 0, and later on marginal utility becomes negative also. I will tell you the reasons behind this whenever we'll do the law of diminishing marginal utility in our further discussions. Okay, as if now just remember one thing, whenever you are taking the marginal utilities, make sure you first decrease the marginal utility, but the marginal utility will remain positive. Later on it will reach to 0, and later on the marginal utility will become negative. Okay, so here I am taking the marginal utility in utils 10, 8, 4, 0, minus 2. Okay. Now, I will calculate the total utility in utils. So students, we already know how to calculate the total utility from the marginal utility given to us. We need to apply the formula. Total utility is sigma marginal utility. That is, we need to add the marginal utilities in order to get the total utility. Since at the first unit the marginal utility is 10 utils, so total utility is also 10 utils. And later on 10 plus 8 is 18 utils. 18 plus 4 is 22 utils. 22 utils plus 0 is again 22 utils. And 22 utils minus 2 is 20 utils. Right? So, what have you observed? We have observed that till the marginal utility is falling but remains positive, the total utility is increasing, right? You can see whenever the marginal utility was 10 utils, 8 utils and 4 utils, the total utility becomes 10 utils, 18 utils and 22 utils. So, whenever the marginal utility is positive, okay, then total utility is increasing. And whenever the marginal utility becomes 0, or you can say marginal utility reaches 0, then total utility is at its maximum, right? We can see 22 utils is the maximum value of total utility. So, when marginal utility is 0, then total utility is maximum. Next, later on when marginal utility becomes negative, then total utility decreases. You can see as a result, when marginal utility becomes minus 2 utils, then total utility decreases from 22 utils to 20 utils. So, whenever marginal utility becomes negative, then total utility decreases. So, students, this is all about the relationship between total utility and marginal utility. So, let's recall the relationship between total utility and marginal utility. At first unit of the commodity, the total utility is equal to the marginal utility. Next, when marginal utility is positive, total utility increases. Next, when marginal utility is 0, total utility reaches its maximum. Next, when marginal utility becomes negative, total utility decreases. So students, this is all about the relationship between total utility and marginal utility. Now students, let's conclude the content until yet. So we have discussed about utility. Utility is basically the amount of satisfaction that a consumer gets after consuming the goods and services. Utility is basically divided into two categories, and those are total utility and marginal utility. Total utility refers to the total amount of satisfaction that a consumer gets after consuming all the units of a particular commodity, whereas marginal utility refers to the amount of satisfaction that a consumer gets after consuming an additional unit of the commodity. And we have gone through the two formulae related to total utility and marginal utility. Basically, marginal utility is equal to total utility n minus total utility n minus 1. This formula will be applicable to calculate marginal utility whenever the total utilities are given to you. And whenever you want to calculate the total utility with the help of marginal utility, then this formula will be applicable. That is, total utility is equal to summation marginal utility. Also, we have gone through the relationship between total utility and marginal utility. So whenever the marginal utility is positive, TU increases, and whenever the marginal utility reaches 0, TU is at its maximum, and whenever the marginal utility is negative, then TU decreases. So this is all about whatever we have studied till yet. Students, till now we have discussed about the meaning of utility, about the main types of utility, that is marginal utility and total utility, and the relationship between marginal utility and total utility. Now we are going to discuss about the law of diminishing marginal utility. This law is related to the marginal utility. And as we know that diminishing means decreasing, right? So this law of diminishing marginal utility states that as the units consumed of a particular commodity increases, then the marginal utility that a consumer get from the consumption of additional units of that particular commodity goes on decreasing, or you can say falling. That is, there is basically indirect, or you can say negative or opposite relationship between number of units consumed and the marginal utility of the commodity. That is, if the number of units consumed will increase, then the marginal utility will decrease. Or you can say, as the consumer consumes more and more units of a particular commodity, then the marginal utility derived from the consumption of the additional units of that particular commodity goes on decreasing. Now, why it is so? What is the reason behind law of diminishing marginal utility? We will study further in this video. Before going through the logic behind law of diminishing marginal utility, first we will go through the assumptions on which the law of diminishing marginal utility is based. Okay, so basically the law of diminishing marginal utility has been based on certain assumptions, and those are: the consumer is rational, that is, the consumer is sensible. Okay, next, the consumer consumes only one good. So there is only one good that a consumer uses. Okay, next, the income of the consumer remains constant. That is, there is no change in the income level of the consumer. Next, all the units of the commodity are identical, or you can say all the units of a particular commodity are similar. Means all the units of a particular commodity are same in terms of size, in terms of taste, etc. So let's recall these assumptions. The consumer is rational. The consumer consumes only one good. The income of the consumer remains constant. All the units of the commodity should be identical. Further, we have the price of the good that the consumer is consuming is constant. That is, there is no change in the price of the good that the consumer is consuming. Next, there is continuous consumption of the commodity. That is, consumer is using, or you can say consuming, the units of the commodity continuously. There is no time gap between the consumption of one unit and the consumption of another unit of the commodity by the consumer. All the units are consumed continuously without any break between them. The taste of the consumer remains same. The taste and preferences of the consumer remain same. That is, there is no change in the taste and preferences of the consumer. Next, the law doesn't apply to articles like gold, cash, etc. So the law doesn't apply to those articles whose increase in quantity will increase the lust among the consumers to have them more. For example, gold, diamonds, cash. So this law is not applied, or you can say is not applicable in case of articles like gold, cash, etc. Next, the another assumption is related to the utility. Utility is basically cardinal in nature. That is, it assumes that the utility can be measured in numbers, and the unit of expression for measuring the utility is utils. So let's recall these assumptions. The price of the good is constant. There is continuous consumption of the commodity. The taste of the consumer remains same. The law does not apply to articles like gold, cash, etc. The utility is cardinal in nature. So this is all about the assumptions of law of diminishing marginal utility. Now students, let's go through the statement of law of diminishing marginal utility. So as already discussed, that if a consumer consumes more and more units of a particular commodity, that is, if the consumer increases the consumption of the units of a particular commodity, then the extra satisfaction that he derives from the consumption of an extra unit, that is the marginal utility, right? Marginal utility keeps on falling, that is decreases. Okay, so let's recall it. As a consumer consumes more and more units of a commodity, the extra satisfaction that he derives from the consumption of an extra unit of the commodity keeps on falling. Now students, we will understand the reason behind the statement of law of diminishing marginal utility. That is, we are going to understand that why the marginal utility of the commodity keeps on decreasing when the number of units consumed of a particular commodity increases. Let's suppose Mr. Ram is feeling hungry as well as thirsty. Okay, so Mr. Ram will require both the chapatis and water. But now let's suppose the two cases are there. Mr. Ram is feeling more thirsty than hungry. Then he will consume water first and then chapatis, right? And vice versa, right? That is, if Mr. Ram will be more hungry than thirsty, then he will demand chapatis first and then water, right? So basically, when the Mr. Ram is feeling more thirsty than hungry, then water will provide the more satisfaction than chapatis, and vice versa. That is, if Mr. Ram is feeling more hungry than thirsty, then in that case, chapatis will provide more satisfaction to Mr. Ram than water, right? So basically, the satisfaction that a consumer get on the consumption of good and service is basically dependent on the need of that good to the consumer, right? If the consumer is having a strong need of that particular good, then that will provide more satisfaction to the consumer. If the consumer is not having a strong need of that particular good, then the good will provide relatively less satisfaction to the consumer. So it is basically the intensity of the need on which the satisfaction of the good is dependent. Now students, let's take the example of Mr. Ram. Mr. Ram is feeling hungry. Since he is feeling hungry, so it arises the need to take chapatis, right? Need to take chapatis, right? Now let's suppose this is the appetite which is faced by Mr. Ram. Okay, Mr. Ram is feeling very hungry, right? He is about to die because of hunger. So he is having the strong need to have first unit of chapati, because the first unit of chapati will somehow save him from the worst situation of being die. Alright. So let's suppose he consumed the first chapati. Okay. And the first chapati gives him the satisfaction of 10 utils. And the portion of appetite which is satisfied with the first chapati is this much. Now student, here we need to focus is, before having the first chapati, the portion of appetite was this much, right? But now after consuming the first chapati, the portion of appetite is this much. Basically, the portion of appetite decreases, right? So since the portion of appetite decreases after having first chapati, so that means the consumer is having less need to have second chapati. However, the consumer needs the second chapati because the portion of appetite is still there. But yes, the need of second chapati is comparatively less than the need of the first chapati. So, the second chapati will provide comparatively less satisfaction as compared to the first chapati, because the need of second chapati is less as compared to the need of the first chapati, right? So, the second chapati will provide, let's suppose, 8 utils to the consumer, okay? Because as we know that it is basically the need on which the satisfaction is dependent, right? Now students, let's suppose this much amount of appetite is satisfied with the second chapati. Now you can see the appetite which is left after consuming first and second chapati is this much, right? So, since the portion of appetite decreases after having first and second chapati, so the need for third chapati is less than as compared to the need for second and first chapati, right? So, the third chapati will provide comparatively lesser satisfaction as compared to first and second chapati. Let's suppose it provided 5 utils of satisfaction to the consumer. And with the third chapati, the consumer is able to satisfy this much amount of appetite. Okay. So now the consumer do not require any more chapatis, since all the portion of the appetite is being removed from the use of 3 units of chapatis, right? Now the consumer consumes fourth chapati. Since there is no appetite, this means there is no need of fourth chapati, right? So the fourth chapati will not provide any satisfaction to the consumer. So that means the satisfaction that the fourth chapati provide to the consumer is 0 utils. Okay. Now, even after the fourth chapati, if the consumer keeps on consuming more units of the chapati, let's suppose the consumer consumes fifth chapati. Now, after consuming the fifth chapati, the consumer is having the feeling of overeating and the consumer vomits due to that. So, that means the fifth chapati doesn't provide any satisfaction to the consumer. Rather, it provides dissatisfaction to the consumer. So, that's why the marginal utility is now in negative. Let's suppose minus 5 utils is the satisfaction that the consumer get from consumption of fifth chapati. So here you can see as the number of units of chapati consumed by the consumer increases, then the marginal utility from the consumption of additional units of that chapati keeps on decreasing, right? So this is the reason. So as we consume more and more units of a commodity, then the intensity of need of that particular commodity goes on decreasing. That's why with the additional units of the commodity consumed, the satisfaction that we get after consumption of the additional units of a particular commodity also goes on decreasing. So this is all about the reason behind law of diminishing marginal utility. Now students, we will talk about the shape of marginal utility curve. See, the marginal utility curve is downward sloping curve. You can see here, right? And even you can notice here that marginal utility is below the panel also. As we have seen that marginal utility first decreases but remains positive, right? Then marginal utility reaches 0 and later on marginal utility becomes negative also. Alright. So the portion of marginal utility curve which is below the panel represents that marginal utility is negative here. And the point at which marginal utility curve cuts the x-axis, at that point marginal utility is equal to 0. And the portion of the marginal utility curve which is above the panel, right, it denotes that marginal utility is positive. Okay. Now the question arises, why the shape of marginal utility curve is downward sloping, or you can say negatively sloped. So it is because of the law of diminishing marginal utility. As we know that there exists an inverse relationship between number of units consumed and marginal utility, right? That is, if the number of units consumed increases, then the marginal utility decreases. That's why the marginal utility curve is downward sloping curve. So students, let's conclude about the content done till yet about law of diminishing marginal utility. So basically, law of diminishing marginal utility states that as the consumer consumes more and more units of a particular commodity, then the marginal utility derived from the consumption of additional units of that particular commodity goes on decreasing, right? And the reason is because with the increase in consumption of more and more units of the commodity, the intensity of need of that particular commodity goes on decreasing. That's why the marginal utility on the additional units of that particular commodity also goes on decreasing. Law of diminishing marginal utility is based on various assumptions like the consumer is rational, the consumer is consuming only one good, the taste and preferences of the consumer remain same, the income of the consumer remains same, utility is a cardinal concept, etc. Right? And also it is because of law of diminishing marginal utility curve is basically downward sloping, or you can say negatively sloped. So this is all about the law of diminishing marginal utility. Hello my dear students, so how are you all? I hope all of you are fit and fine. So till now we have discussed about law of diminishing marginal utility, in which we have discussed that as the consumer consumes more and more units of a particular commodity, then the marginal utility that is derived from the consumption of additional units of that particular commodity goes on decreasing, right? Now we are going to understand about the marginal utility approach of consumer's equilibrium. Okay, basically there are two approaches of consumer equilibrium, and those are marginal utility approach, or you can say marginal utility analysis, and the another one is indifference curve approach, or you can say indifference curve analysis. Okay, marginal utility approach is also known as cardinal utility approach. Basically, under marginal utility approach, we consider that utility can be measured in numbers and the unit of expression of measuring utility is utils. Whereas indifference curve approach, or you can say indifference curve analysis, is also known as ordinal utility approach. Now, what is this ordinal utility approach? Ordinal utility approach considers that utility cannot be measured in utils, but yes, utility can be ranked. There can be ranking of utility. Okay. So, these are the two approaches of determining the consumer's equilibrium. Now we will understand what is consumer's equilibrium. Consumer equilibrium is basically that point where the consumer get maximum possible satisfaction after consuming the goods and services. Students, as we know that the consumers uses the goods and services, or you can say purchases the goods and services and consumes the goods and services to get the satisfaction. The point where the consumer gets the possible maximum satisfaction, okay, that point is called the point of consumer's equilibrium. Basically, consumers consume the units of a particular commodity till the consumer gets the maximum possible satisfaction. When the consumer's satisfaction starts decreasing with the increase in units of the particular commodity, then the consumer will stop using that commodity. Or you can say the consumer will stop consuming the extra units of that particular commodity. So consumer's equilibrium is that point where the consumer stops the consumption of the additional units of the particular commodity. Okay, or you can say it is a point where the consumer discontinues the consumption of any particular good or service, because the consumer has already got the maximum possible satisfaction. So we can determine the consumer's equilibrium using the marginal utility approach as well as the indifference curve approach. Under marginal utility approach, we can determine the consumer's equilibrium using the marginal utility and price of the units of the particular commodity. And under indifference curve approach, we can measure the consumer's equilibrium using the indifference curve and budget line. Now students, we will understand both the approaches, marginal utility approach and indifference curve approach in detail. Now let's first start with the marginal utility approach. Now students, let's understand what is marginal utility approach. First, we will talk about the assumptions on which marginal utility approach is based. Basically, the assumptions of marginal utility approach is same as the assumptions taken under law of diminishing marginal utility. Each and every assumption is same. Okay, let's recall those assumptions one by one. The consumer is rational. That is, the consumer is sensible, right? Next, the consumer consumes only one good. The consumer consumes only one good. The units of the good, or you can say all the units of the good, are identical. That is, similar in terms of size, taste, etc. The price of the commodity remains constant, or you can say the price of the good remains constant. That is, there is no change in the price of the commodity. Next, the income level of the consumer remains constant. The income level of the consumer remains constant. That is, there is no change in the income level of the consumer. The taste of the consumer remain constant. Okay. Next, the utility is cardinal. That is, the utility can be measured in numbers and the unit of expression of utility is utils. Next students, there is one additional assumption related to marginal utility approach, and that is marginal utility of 1 rupee is constant. That is, there is no change in the marginal utility of 1 rupee. Now, what is the marginal utility of 1 rupee? Marginal utility of 1 rupee is basically the perceived satisfaction obtained after spending the additional 1 rupee on the purchase of good or service. So these are the assumptions of marginal utility approach, or you can say marginal utility analysis. Now students, we will understand about the buying behavior of the consumers in order to understand the marginal utility approach. Okay. Now students, whenever we buy anything, before buying the good or any service, what we do, we compare the satisfaction with the price, right? For buying any commodity, we compare the amount of satisfaction that we will get after consuming that commodity with the price that we need to pay for purchasing that particular commodity. And we take the decision regarding whether to buy that commodity or not. For example, if satisfaction after using that commodity is greater than or equal to the price that we need to pay for that commodity, then the consumer will buy the commodity. Consumer will buy the commodity. But if the satisfaction, or you can say amount of satisfaction that a consumer will get after consuming that particular commodity is less than the price he need to pay to purchase that particular commodity, then the consumer will not buy that commodity. Consumer will not buy the commodity, right? Because for him the commodity is costly now, because the price is greater than the amount of satisfaction that he will get after consuming that commodity, right? So the consumer always compares the amount of satisfaction that he will get after consuming that particular commodity with the price that he need to pay for that particular commodity in order to purchase it, right? So whenever the satisfaction is greater than or equal to the price, then the consumer will buy the commodity, and whenever the satisfaction is less than price, the consumer will not buy the commodity. This is basically the buying behavior of the consumers, and we know that satisfaction concerned with the individual units of the commodity is basically the marginal utility, right? So we can say that the consumer compares a marginal utility with the price of the commodity for taking the buying decision. Okay. So now students, we will understand how a consumers decide about how many units of a particular commodity to buy, or you can say purchase. So for taking the decision regarding how many units of a particular commodity to purchase, the consumer basically compares a marginal utility that he gets from consuming the unit of a particular commodity with the price that he need to pay to purchase that particular unit of the commodity. But now students, there is a problem. What is the problem? The problem is the price is expressed in terms of rupees, whereas the marginal utility is expressed in terms of utils. And we know that for doing the comparison between two variables, there must be one unit of expression. There must be the same unit of expression of both the variables. Only then the comparison is possible. Otherwise, the comparison is not possible. Now, to make the comparison possible, the marginal utility in utils is converted into marginal utility in rupees. Now, how do we convert the marginal utility in utils into marginal utility in rupees? So, the formula is marginal utility in rupees is equal to marginal utility in utils divided by, or you can say upon, marginal utility of 1 rupee. So for calculating the marginal utility in rupees, what we need to do is we need to divide the marginal utility expressed in utils by the marginal utility of 1 rupee. For example, students, let's suppose the marginal utility in utils is 10 utils. Okay. And marginal utility of 1 rupee is 1. So, to get the marginal utility in rupees, we will apply this formula, that is marginal utility in utils divided by marginal utility of 1 rupee. So, 10 divided by 1 will be equal to rupee 10. Okay. So, this is how you need to calculate the marginal utility in rupees in order to compare the marginal utility with the price. So, students, as already discussed, that the consumer will compare the marginal utility of the unit of the commodity in rupees with the price that he need to pay to purchase that particular unit of the commodity. And he will take the buying decision. Now see how a consumer will decide as to how many units to buy. See students, whenever the marginal utility in rupees would be greater than price, then the consumer will buy that unit. The consumer will buy that unit. Right? Because here the consumer is benefited by purchasing the commodity, because the amount of satisfaction that he will get after consuming that particular unit of the commodity is greater than the price that he need to pay to purchase that particular unit. Next, whenever the marginal utility in rupees is equal to price, then also the consumer will buy that unit of a particular commodity. Consumer will buy that unit of a particular commodity, because here also buying the unit of a particular commodity is worthful, because here the amount of satisfaction that a consumer is getting after consuming that particular unit of the commodity is equal to the price that he need to pay to purchase that particular commodity. Next, whenever the marginal utility is less than the price, then in that case the consumer will not buy that unit of the commodity. Why? Because in this case the consumer is not getting any benefit for purchasing that unit of the commodity, because here in this case the purchasing of that particular commodity is costly, or you can say expensive, because the satisfaction that the consumer will get from this particular unit is less than the price that he need to pay for it. So for the consumer, this unit of the commodity is costly, so he will not purchase that unit. So on a conclusion, we can say that the consumer will purchase the units of the particular commodity till the marginal utility in rupees is greater than, or you can say equal to, price of the units of that particular commodity. But whenever the marginal utility in rupees is less than the price, then the consumer will not purchase that particular commodity. Okay. Now students, let's understand this with the help of a schedule. Let's suppose the consumer consumes the units of good X. Now here we'll write units of good X consumed. 1, 2, 3, 4. Now marginal utility in utils. N, 8, 5, 2. Now students, let's suppose the price of 1 unit of good X is 5 rupees. Okay. Now price in rupees is basically 5, 5, 5, 5. As one of the assumptions under marginal utility approach is the price of a commodity will remain same, right? So I have taken the same prices for all the units of good X, that is 5 rupees. Okay. Now how a consumer will decide as to how many units to buy? The consumer basically compares the marginal utility with the price of that particular unit in order to decide whether to buy that particular unit or not. But here marginal utility in utils, but the price is in rupees. So for the comparison, we need to convert the marginal utility in utils into marginal utility in rupees, right? And we have already discussed that we can convert the marginal utility in utils into marginal utility in rupees using the formula marginal utility in rupees is equal to marginal utility in utils divided by marginal utility of a rupee, right? And also we have assumed that marginal utility of a rupee will remain same, right? Now students, let's suppose the marginal utility of a rupee is 1. So now I will convert the marginal utility in utils into marginal utility in rupees by dividing the marginal utility in utils by the marginal utility of a rupee, which is 1. So 10 divided by 1 is 10 rupees. 8 divided by 1 is 8 rupees. 5 divided by 1 is 5. 2 divided by 1 is 2. So this is the marginal utility in rupees. So now I will compare the marginal utility in rupees with the price in rupees, right? And we'll find out whether the consumer will purchase a particular commodity or not. So let's first compare the price and marginal utility of unit 1 of good X. So for the first unit of good X, the price is 5 rupees, whereas the satisfaction that a consumer will get is 10 rupees, right? So the consumer is benefited here, right? The consumer will get the more satisfaction as compared to the price. So he will get the additional satisfaction of 5 rupees. So here the consumer will get the benefit of 5 rupees by purchasing the first unit of good X, because he will get the satisfaction of 10 rupees, whereas he need to pay only 5 rupees to purchase that particular commodity, right? So here's a consumer will get the benefit of 5 rupees on purchasing first unit of the good X. Okay. Next, at second unit of good X, the consumer will get the satisfaction of 8 rupees, whereas he need to pay the price of 5 rupees only in order to purchase second unit. Here also the consumer will get the benefit of 3 rupees, right? As the satisfaction of second unit of good X is greater than the price of good X by 3 rupees, right? So in both the cases, since the consumer is benefited, so the consumer will buy the commodity. Now let's see at the third unit of the good X. At the third unit, the price is 5 rupees and the marginal utility is also 5 rupees. That means the consumer will get the satisfaction of 5 rupees and also the consumer needs to pay 5 rupees to purchase the third unit of good X. So this is also worth buying, right? The consumer will buy the third unit of good X, because here the consumer is neither getting the benefit nor the consumer is in loss, right? Next, at the fourth unit of good X, the consumer is getting the satisfaction of 2 rupees, whereas the consumer needs to pay 5 rupees in order to purchase the fourth unit of good X. So here the consumer is at loss of rupees 3, right? Because the amount of satisfaction that the consumer will get after consuming fourth unit of good X is less than the amount of price that he need to pay to purchase the fourth unit of good X, right? So here the consumer is at loss of 3 rupees. So the consumer will not buy the fourth unit of good X. So you can see the consumer will buy the units of good X till the third unit of good X, right? So the consumer is in equilibrium. Consumer is in equilibrium at third unit of good X. So students, here we have the condition of consumers equilibrium under marginal utility approach. Marginal utility in rupees is equal to price of the commodity, right? And we know that marginal utility in rupees is calculated as marginal utility in utils upon marginal utility of a rupee. So we can also rewrite it as marginal utility in utils divided by marginal utility of a rupee equal to price of the commodity. So this is a condition of consumers equilibrium under marginal utility approach. Now students, let's go through the marginal utility approach of consumers equilibrium. See, the consumer is in equilibrium when the marginal utility of a good is equal to the price of it, right? That is, marginal utility of good X is equal to the price of good X. So let's recall it. Marginal utility approach of consumers equilibrium. The consumer is in equilibrium when the marginal utility of a good is equal to the price of it. That is, marginal utility of good X is equal to price of good X. Here MUX denotes the marginal utility of good X, whereas PX denotes the price of good X. Now let's see the graph which is indicating the consumer's equilibrium under marginal utility approach. We know that marginal utility curve is a downward sloping, right? And whereas it is the assumption that the price of the commodity remains constant. Since the price of the commodity remains constant, that's why the price line is parallel to x-axis. And here at point E, the marginal utility curve and the price line is intersecting with each other. That is, at this point E, the marginal utility is equal to the price of the commodity. So this is the point of consumers equilibrium. Consumers equilibrium. Okay. And whenever we draw this graph, make sure you label price and marginal utility on the y-axis and number of units of a commodity consumed on the x-axis. Now students, this is all about the consumer's equilibrium under marginal utility approach. Now students, this is all about the consumer's equilibrium under marginal utility approach. Now students, we will go once again to schedule in order to understand about consumer's surplus. Now what is consumer surplus? See, here when the consumer consumes first unit of the commodity, or you can say when the consumer consumes first unit of good X, then the consumer is getting the benefit of 5 rupees, right? The amount of benefit that the consumer get for consuming a particular unit of the commodity is basically the consumer's surplus. Okay. And by consuming the second unit of good X, the consumer is getting the benefit of 3 rupees, right? So the amount of benefit that the consumer is getting after consuming second unit of good X is rupees 3. So this is the consumer surplus at second unit of good X, right? So how do we calculate the consumer surplus? See, the consumer is getting the satisfaction of rupees 10 on consuming first unit of good X, right? So the consumer can pay 10 rupees to purchase first unit of good X, right? But actually he need to pay only 5 rupees, right? He need to pay only 5 rupees to purchase first unit of good X. So consumer surplus is being calculated as the price that a consumer can pay for a particular unit of the commodity minus the price that he actually pays. That is 10 rupees minus 5 rupees, which is 5 rupees, right? Similarly, for the second unit of good X, the consumer can pay rupees 8 for purchasing second unit of good X but actually he need to pay only 5 rupees to purchase second unit of good X. So here the consumer surplus is 8 rupees minus 5 rupees, which is 3 rupees. So students, consumer surplus is being calculated as the difference between the amount what a consumer is ready to pay. Okay, that is the amount that a consumer can pay for a particular unit of the commodity minus what he actually pays. That is the actual price of the unit of that particular commodity. So now we are going to start the supply part of this particular chapter. In this video, we are going to understand about the meaning of supply and the determinants of supply, or you can say factors affecting supply. Okay, so let's start with the meaning of supply. Students, this is the godown. Okay, this is the godown. And here there are certain units of the commodity. You can see there are 12 units of the commodity. Okay, now students, the total units of the commodity kept in the godown is called stock. Okay, now the supplier wants to supply, that is wants to sell these units in the market. Basically you can see the supplier wants to sell these 3 units of the commodity in the market, and he is able to sell also. Okay, so this is called supply. These 3 units is called supply. So supply is basically part of stock, okay, which represents the units of a particular commodity which the seller wants to and able to sell in the market. Okay. Now students, as I already discussed that while telling the demand of a particular commodity to someone, we need to mention the 3 items, and those are quantity, price and time. Similarly, in case of supply also, we need to mention the quantity, price and time. Basically, we need to mention the quantity of the good that the producers, or you can say sellers, are willing and able to offer to the market. Okay, and we need to mention the price also, that the particular commodity is offered in the market by the producers or sellers at what price. Okay, and also we need to mention the time also, because like demand is a flow variable, in the same way supply is also a flow variable. So supply is also measured during a particular period of time. Okay, so we need to mention the time in case of supply also. So let's have a look. Supply basically refers to the amount of a good or service, that is the quantity of a good or service that the producers, or you can say suppliers or sellers, are willing and able to offer to the market at various prices during a particular period of time. So let's recall it. Supply refers to the amount of a good or service that the producers are willing and able to offer to the market at various prices during a particular period of time. Okay, let's understand this example. Ram supplies 10 kgs of rice at the rate of rupees 50 per kg in a month. Okay, so here we are having the quantity, that is 10 kgs of rice, and price, that is 50 rupees per kg, and particular period of time, that is a month, or you can say 1 month, right? So Ram supplies 10 kgs of rice at the rate of 50 rupees per kg in a month. So let's understand some of the points related to supply. Important points about supply. See students, supply is all about what a firm offer for sale in the market, not what it is actually able to sell in the market. Okay. It is all about what is offered for sale in the market. Okay. Let's suppose Ram have supplied 10 kgs of rice in the market, right? It doesn't mean that Ram will be able to sell 10 kgs of rice in the market, right? So, supply is all about what a firm offer for sale in the market, not what they succeed in selling. Okay. Also, supply refers to the willingness, that is the wish of the supplier to supply, and ability to supply. That is, they are actually able to supply the particular quantity of the good in the market. Moreover, what we are having here is production cost is the main determinant of ability to supply, or you can say that production cost is the main factor of deciding supply of a particular commodity. So basically we know that whenever the production cost increases, the profit margin of the supplier decreases, and the supplier's aim is to earn the profit, right? So all the decisions of the supplier regarding to increase the supply of a particular good or to decrease the supply of a particular good is dependent on the profit margin that the supplier will get from that particular good. So whenever the production cost will increase, the profit margin will decrease and the supplier will decrease the supply of a particular commodity. And whenever the production cost will decrease, the profit margin of the particular commodity will increase, and hence the supply of that particular commodity will be increased by the suppliers. So production cost is the main determinant of ability to supply, or you can say supply of a particular commodity. So let's recall it. Important points about supply. It is what a firm offer for sale in the market, not what they succeed in selling. Next, supply requires both willingness and ability to supply. Production cost is the main determinant of ability to supply. Now further we have supply is a flow. So as already discussed, like demand, supply is a flow as it is measured over a particular period of time. Okay. So supply is a flow. Okay. As it is connected with the length of time. Like when we discuss about the supply, we discuss about the time period also. Like supply in 1 month, or supply in 1 year, or supply in 1 day, etc. Okay. So time dimension is connected to supply. That's why supply is a flow concept. Hello my dear students. So how are you all? I hope all of you are fit and fine. In this video we are going to understand about the determinants of supply. That is factors affecting supply of the commodity. Students, as already discussed, that the aim of the supplier is to earn profit, right? So the supplier takes the decision on the basis of the profit margin. If the profit margin will increase, the supplier will increase the supply of the product, and vice versa. That is, if the profit margin will decrease, the supplier will decrease the supply of the product. Okay. So let's have a look on the determinants of supply. There are various determinants of supply like price of the good, or you can say price of the good itself. Next, price of related goods. Next, price of factors of production, state of technology, government policy, nature of competition and size of industry, expectation about future prices, and number of sellers. Okay, so students, we are going to understand the determinants of supply one by one. So let's first understand about the price of the good. Okay, so when we discuss the price of a good as a determinant of supply, that is how the price of the good itself affects the supply of the good. Okay, then we take the assumption that other determinants are constant. Other determinants are constant. Okay, that is, we assume that the cost of production of the good will remain constant, the state of technology that the firm is using to produce the goods and services will remain constant, and etc. Okay. So students, whenever the price of the good increases, then the profit margin on that good will increase for the supplier, as we are assuming that the cost of production will remain same, right? So since the profit margin will increase, the supplier will increase the supply of the commodity. That is, the quantity supplied in this case will increase. And vice versa. That is, if the price of the good decreases, then the profit margin on that good will decrease, and hence the supplier will supply less quantity of the good now, right? So the quantity supplied will decrease in this case. Okay. Let's recall it price of the good. So whenever the price of the good increases, then the profit margin on that good will increase, and hence the supplier will increase the quantity supplied of that particular good, and vice versa. That is, when the price of the commodity will decrease, or you can say when the price of the good will decrease, then the profit margin on that good will decrease, and hence the supplier will supply less quantity of that particular commodity, or you can say the quantity supplied of the commodity will decrease. Now students, here we need to mention one thing also. See students, when the quantity supplied of the commodity increases due to increase in price of the commodity, that is called expansion, or you can say extension of supply. Let's suppose the price of this digital pen increases. So the supply of this digital pen increases. So this is called expansion of supply or extension of supply. Okay. And whenever the quantity supplied of a particular good decreases due to decrease in price of that good, then it is called contraction of supply. Contraction of supply. Let's suppose the supply of this digital pen decreases due to decrease in price of the digital pen, then it is called contraction of supply. Okay. Now let's have a look on the second determinant of supply, that is price of related goods. Related goods are also known as other goods. So we can say that price of related goods or price of other goods. Now students, to understand this, we need to understand what is the meaning of related goods. See, here related goods means the producer is producing two goods, let's suppose good X and good Y, using the same level of resources. Let's suppose this is the resources. This is basically the amount of resources which is being used by the producer in producing good X and good Y. Okay. So here good X and good Y are the related goods, or you can say other goods. Now let's suppose students, good X and Y are having the same prices, and the cost of production of good X and good Y is also same. Okay. So since both will give the same profit margin to the producer, so the producer is producing both the goods in equal quantities, and since he is producing both the goods in equal quantities, so he is using equal amount of resources to produce good X and good Y. So he is using half of the resources to produce good X and half of the resources to produce good Y. Okay, but later on the price of good X increases. Now when the price of good X increases, the profit margin on good X will increase for the supplier, and now good X is more profitable as compared to good Y, right? So now the producer will increase the production of good X so that the producer will be able to supply more of good X, right? So for that he need to transfer more resources to the production of good X, right? Now let's suppose this much amount of resources is now being transferred for the production of good X. Now since resources are limited, now very less portion of resources or very less amount of resources is being available for the production of good Y, right? This red portion represents the available resources for the production of good Y. And since the available resources for the production of good Y decreases, so the producer will be able to produce less of good Y and the supply of good Y will decrease. So to increase the production of good X here, in order to supply good X more, since it is more profitable in this case, the producer has to reduce the production of good Y, okay, and hence the supply of good Y will decrease. So whenever we talk about the related goods, in related goods, there is inverse relationship between the price of one good and the supply of another good. Like in the example, we have seen that when the price of good X increases, the supply of good Y decreases, right? So there is inverse relationship, or you can say negative relationship, between the price of one good and the supply of another good. That is, when the price of one good will increase, the supply of other good will decrease, and vice versa. So let's recall it till now. Price of related goods, or you can say price of other goods. There is inverse relationship between the price of one good and supply of other good, or you can say supply of another good. Okay. Now here we have the third determinant of supply, and that is price of factors of production. Now students, we know that the producer requires the factors of production in order to do the production of goods and services, right? Basically, the factors of production that the producer requires are land, labor, capital, etc. Right? Now students, we know that factors of production has a price, right? Like for land, we need to pay the rent to the landowner. For labor, we need to pay the wages to the laborers. And for capital, we need to pay the interest to the capitalist, right? So these are basically the prices of the factors of production. And price of the factors of production is basically the determinant of supply of the commodity. That is, the price of factors of production affects the supply of the commodity. Now let's understand how the price of factors of production affect the supply of the commodity. So students, let's suppose the price of factors of production increases. For example, the wage rate for the laborers increases. What will happen with that? The cost of production will increase, right? And with the increase in production of goods, the profit margin on that goods will decrease, and hence the supplier will now supply less quantity of that particular good, right? And vice versa. Now let's suppose the price of factors of production decreases. Let's suppose the wage rate of the laborers decreases. Now what will happen with this? The cost of production of producing the goods and services will decrease, and this will result in increase in the profit margin, right? And now since the profit margin increases, the supplier will now increase the supply of the commodity. So let's recall it, price of factors of production. When the price of factors of production increases, then cost of production increases, and hence the profit margin decreases, and hence the supply decreases, and vice versa. Now further we have the state of technology. Now students, we know that there are basically two states of technology, and that is advanced technology, or you can say updated technology, and backward technology, or you can say inferior technology. Okay, and we know that students, whenever the firm uses the advanced technology in order to produce the goods and services, then the firm is able to produce more quantity of the goods, and even the firm is able to produce that quantity at a low cost. Okay, so the supplier will increase the supply of the commodity in case the firm uses the advanced technology, because the firm is able to produce more quantity, and hence the firm will supply more quantity of the good. And since with advanced technology the firms are able to produce the commodities at low cost, okay, this will increase the profit margin, and hence the supplier will increase the supply of the products, and vice versa. In case of backward technology, firms is able to produce less quantity of the good, and hence the supplier will be able to supply less quantity of that particular good because of the less availability of the good, right? And also the firm will be able to produce the good at high cost due to the backward technology, which will result in decrease in profit margin. So the supplier will decrease the supply of the product. Okay. So let's recall it. State of technology. Advanced technology. Firm is able to produce more quantity of the good and even at low cost. The supplier will increase the supply and vice versa. In case of backward technology, firm is able to produce less quantity of the good even at high cost. So the supply will decrease. Next we have government policy. Now government policy refers to the rules and regulations of the government, right? Now government policies includes tax rates and subsidies. Basically these tax rates and subsidies affect the supply of the commodities. Now let's understand it how. See students, tax rate is basically composed of the cost of production, right? We know that government imposes the tax on the goods and services like GST. Basically government imposes the indirect taxes. We know that the taxes which are imposed on the goods and services are called indirect taxes like GST we have, right? So whenever the tax rate will increase on the production of goods, it will lead to increase in the cost of production, as tax rate is basically an expense of producing the goods and services, right? So with the increase in tax rate, the cost of production will increase, and with the increase in cost of production, the profit margin will decrease, and hence the supplier will supply less quantity of the product. Okay, and vice versa. When the tax rate decreases, then the cost of production will decrease, and with the decrease in cost of production, the profit margin will increase, and hence the supplier will increase the supply of the commodity. Okay, so let's recall it till now. Government policy includes rules and regulations of the government. Government policy related to tax rates and subsidies affect the supply of the commodity. So far we have just gone through the tax rate as a determinant of supply. Later on I'll tell you the subsidy as a determinant of supply. So in case of tax rate, when the tax rate increases, the cost of production increases and the profit margin will decrease, and hence the supply will decrease, and vice versa. Okay. Now we will talk about the subsidy as a determinant of supply. See students, on the goods where subsidy is being provided by the government to the producers, so it helps in reducing the cost of production for the producers. Okay, and hence the profit margin will increase, and with the increase in profit margin, the supplier will increase the supply of the commodity, and vice versa. That is, on the goods where subsidy is not provided by the government to the producers, then the cost of production for such commodities will increase, and hence it will reduce the profit margin on such commodities, and hence the supplier will decrease the supply of those goods. Okay, so let's recall it till now. Subsidy. So where the subsidy is being provided, the cost of production is decreased, and with the decrease in cost of production, the profit margin will increase, and hence the supply will be increased by the supplier, and vice versa. Now further we have the nature of competition and the size of industry. Now students, further we have the nature of competition and size of industry as a determinant of supply. Okay. See students, in monopoly market we know that there is only one seller. Since there is only one seller, so the supply of the commodities would be less as compared to the monopolistic competition market, because in monopolistic competition market there are many sellers, right? So definitely the supply of the commodities would be high in case of monopolistic competition market. Let's recall it till now. Nature of competition and size of industry. In monopoly market situation, supply of the commodities would be less. And in monopolistic competition market situation, supply of the commodities would be high. Further, students, we will understand about the expectations about future price as a determinant of supply. See students, whenever the suppliers expects that the price of the commodities will further rise in near future, then they will supply less at current prices. Because when the price will further rise in the near future, the supplier will increase the supply then, right? And whenever the suppliers expects that the price of the commodity will further decrease in near future, then the supplier will supply more at current price. Okay? So let's recall it till now. Expectations about future price. Expectations about future prices. If sellers expect that the price of the commodity will further rise in near future, then the sellers supply less quantity of the good at current price and vice versa. That is, if the sellers expect that the price of the commodity will further decrease in near future, then the supplier will supply more quantity of the good at current price. Now students, we will go through number of sellers as a determinant of supply. See students, we know that sellers supply the goods and services in the economy, right? So with the increase in the number of sellers, the supply of the commodity will increase and vice versa. If the number of sellers will decrease in the market, then the supply will decrease. Okay. So there is a direct relationship between number of sellers and supply of the commodity. Okay. So let's recall it. Number of sellers. When the number of sellers will increase in the market, the supply will increase and vice versa. That is, when the number of sellers will decrease in the market, then the supply will decrease. Now students, we will talk about some other factors affecting supply, and those are goals of the firms. See, some firms are having the goals of profit maximization and some firms are having the goal of social welfare. Although mostly firms have the objective of profit maximization. So the firms who are having the objective of profit maximization will increase the supply of the product when the price of the product will increase, and will decrease the supply of the product when the price of the commodity will decrease, right? So with the increase in price, the supply of the product will increase, and with the decrease in price, the supply of the product will decrease. Because we know that with the increase in price, the profit margin increases. So that's why the seller increases the supply of the product and vice versa. But in case the firms are having the objective of social welfare, then in that case, the firm supplies more even at less price of the good. So here, where the goal of the firm would be social welfare, we will see that at less prices, and or you can say when the price is less, the supply of the product is more. So here we can see one of the exception to the positive relationship between price and supply of the commodity. Okay. Generally, there exists a positive relationship between price and supply of the commodity. But in case the firms are having the objective of social welfare, then that would be the exception to the positive relationship between price and supply. There exists a negative relationship between price and supply of the commodity. That is, when the price of the commodity will decrease, the supply of the commodity will increase. Next, infrastructural facilities. If in a country there are perfect infrastructural facilities, or the infrastructural facilities are too good, then the suppliers will be able to produce more quantities of goods and services, and they will be able to supply more and vice versa. Next, natural factors. If there will be any earthquake or flood, so if any economy which is being hit by the natural factors, or you can say natural calamities like earthquake and flood, then that economy would be able to produce less output of goods and services and would be able to supply less quantity of the goods and services. Next, human factors like war and labor strikes. Labor strikes and war would also reduce the output of goods and services that is being produced in the economy, and hence the supply of goods and services will reduce. So natural factors and human factors will reduce the output of goods and services in the economy, and hence the supply of goods and services will decrease. Okay, so this is all about the determinants of supply. So students, having understood the meaning of supply and the determinants of supply, now we are going to discuss about the law of supply. See, the law of supply basically defines the relationship between price and quantity supplied of the same good. Okay, basically law of supply will give you the information about the type of relationship between the price and the quantity supplied of the same good. That is, if the relationship between price and quantity supplied of the same good is direct or indirect. So let's start the discussion of law of supply. First, students, we will go through the assumptions on which law of supply is based. That is, assumptions of law of supply. Now students, to have the better understanding of the assumptions of law of supply, we will divide the determinants of supply into two categories, and those are price of the good itself, or you can say own price of the good, and determinants other than the price of the good itself, like state of technology, government policies, price of related goods, etc. Okay. So basically in the first category we have price of the good itself, and in the second category we have all the factors that affect the supply apart from the price of the good itself, like state of technology, government policies, price of related goods, etc. Okay. Now what are the assumptions of law of supply? See, basically the determinants other than the price of the good itself remains constant. This is the assumption of law of supply. Okay. That is, the state of technology remains constant. That is, there is no change in the state of technology. The government policies will remain same. That is, there is no change in the government policies. The price of related goods will remain same. That is, there will be no change in the price of related goods, right? So, all the factors which affect the supply of the commodity apart from the price of the good itself will remain same. Okay. So, factors other than own price of the commodity that affects the supply are constant. This is also known as ceteris paribus. Ceteris paribus is basically a phrase which denotes that all the factors apart from the own price of the commodity remains constant. Now students, this is all about the assumptions of law of demand. Now students, we will talk about the statement of law of supply. See, the statement of law of supply is related to the relationship between price and quantity supplied of the same good. So, the statement of law of supply is other things remaining constant. That is ceteris paribus. Ceteris paribus. By saying other things remaining constant means all the factors apart from the own price of the commodity will remain constant. That is, only the own price of the commodity can change. Next, there is basically a positive relationship between the price of the commodity and its quantity supplied. That is, if the price of the commodity increases, then the quantity supplied of the commodity also increases. And if the price of the commodity decreases, then the quantity supplied of the commodity also decreases. Okay, so there is a positive, or you can say direct relationship between the price of the commodity and the quantity supplied of the commodity. So let's recall it: statement of law of supply. other things remaining constant, there is a positive relationship between the price of the commodity and its quantity supplied. Now students, we will talk about the reason behind the law of supply. That is, we will talk about the reason that why the law of supply operates. That is why it happens that with the increase in price of the commodity, the quantity supplied of the commodity increases, and with the decrease in price of the commodity, the quantity supplied of the commodity decreases. So it is because of the objective of almost every firm or seller is to earn profit, right? And when the price increases, the profit margin increases, and hence the quantity supplied of the good increased by the seller. And whenever the price of the commodity decreases, then it reduces the profit margin of the seller on that particular commodity. So the quantity supplied of that particular commodity decreased by the seller, right? So this is the reason behind operation of law of supply. Students, this is all about the law of supply. Now we will talk about some general terms related to supply, that is supply schedule. Now supply schedule is basically a tabular presentation that shows different quantities of the commodity supplied at different prices of the commodity. Let's have a look. See, I am providing you the information about good X in the form of table. Here I am writing price of good X in rupees, and here quantity supplied in units. When the price of good X increases from 10 rupees to 20 rupees, then the quantity supplied of good X increases from 100 units to 180 units. So what is this? This is basically a supply schedule, because it is showing you that at the price of rupees 10, the quantity supplied would be 100 units, and at the price of rupees 20 per unit, the quantity supplied would be 180 units, right? So this is in the form of table, and this is giving you the information that what would be the different quantity supplied at different prices of the commodity, right? So supply schedule, let's recall it. It is a tabular presentation that shows different quantities of the commodity supplied at different prices of the commodity. Next we will talk about the supply curve now. So curve is basically a graphical presentation, and the graphical presentation of the supply schedule is the supply curve. Basically, supply curve is a curve that shows different quantity supplied of the commodity at different prices of the commodity. Okay, let's suppose here's a panel, origin, y-axis, x-axis. Y-axis we label price, and on x-axis we label quantity supplied. Okay, and here's a supply curve. Now let's suppose the supplier is on point A of the supply curve. This indicates that the supplier is supplying OQ quantity of the commodity at price OP. Now let's suppose the supplier moves to point B. Now this indicates that the supplier is now supplying OQ1 quantity of the good at the price OP1, right? Now let's suppose the supplier moves to point C. Now this indicates that the supplier is supplying OQ2 quantity of the commodity at price OP2, right? So here the supply curve is a curve which shows different quantity supplied of the commodity at different prices of the commodity. Let's recall it, supply curve. It is a graphical presentation of the supply schedule. So whatever the information is shown by supply schedule in the form of table, the same information is shown by the supply curve in the form of graph, or you can say in the form of curve, right? So that's why we say that supply curve is a graphical presentation of the supply schedule. Now supply curve is upward sloping, or you can say positively sloping towards right. Now you can see that supply curve is upward sloping, right? It is moving up from the origin. Now why this supply curve is upward sloping? It is because of the positive relationship between price and quantity supplied of the same good. That is, if the price of the commodity increases, then the quantity supplied of that commodity also increases, and vice versa. That is, if the price of the commodity decreases, then the quantity supplied of that particular commodity also decreases. So it is because of this positive relationship the supply curve is upward sloping. So let's recall it. It is upward sloping or positively sloping towards right. Next we have market supply. The other name of market supply is total supply or aggregate supply. Now as we know that the supply in the market is done by the suppliers, right? There are various suppliers which are doing supply of goods in the market, right? Now the total supply done by all the suppliers of the economy for a particular product is called the market supply of that product. Now let's understand it with the help of an example. Let's suppose, students, there are only two suppliers of sugar in the market. Okay? That is Ram and Sham. Now at the price of 50 rupees per kg of sugar, Ram is supplying 10 kgs of sugar in the market, whereas Sham is supplying 20 kgs of sugar in the market. So that means the overall supply made by Ram and Sham is 30 kgs for sugar, right? So 30 kgs here is the market supply because there are only two suppliers of sugar in the market, and that is Ram and Sham. So together Ram and Sham is supplying 30 kgs of sugar in the market. So the total supply of sugar is 30 kgs. Now what is market supply? Market supply is basically the total supply of the product made by all the suppliers available in the market. So let's recall it. Market supply. It is the sum of supplies of a commodity made by all the sellers in the economy. Next we have market supply schedule. See, market supply schedule is a tabular presentation that shows different market supply of the commodity at different prices of the commodity. Now let's suppose the prices are 10 rupees and 20 rupees. And there are only two suppliers in the market, Ram and Sham. Quantity supplied by Ram is here. Quantity supplied by Ram. Here quantity supplied by Sham. Okay. Now let's suppose Ram is supplying 100 units at the price of 10 rupees per unit, and Ram is supplying 200 units at the price of 20 rupees per unit, and Sham is supplying 500 units at the price of 10 rupees per unit and 800 units at the price of rupees 20 per unit. Now let's calculate market supply. So we will calculate the market supply by adding the quantity supplied by Ram and Sham, right? So at the price of rupees 10, the market supply is 100 plus 500 units, which is 600 units, and at the price of rupees 20 per unit, the market supply is 200 units plus 800 units, which is 1000 units. Okay. So this is a table which is showing you the information about different market supply at different prices of the commodity. So this is basically a market supply schedule. So let's recall it. It is a tabular presentation that shows different market supply of the commodity at different prices. Next we have market supply curve. Now students, we know that a simple supply curve means a graphical presentation that shows different quantities supplied of a commodity at different prices. So similarly, market supply curve is a curve that shows different market supply of the commodity at different prices of the commodity. Basically, market supply curve is the graphical presentation of market supply schedule. So let's recall it, market supply curve. It is a graphical presentation that shows different market supply of the commodity at different prices of the commodity. Hello my dear students, so how are you all? I hope all of you are fit and fine. So having discussed about the meaning of supply, determinants of supply and law of supply. Now we are going to discuss about the change in quantity supplied and change in supply. Basically we are going to discuss about the difference between change in quantity supplied and change in supply. So let's have a look guys. See students, change in quantity supplied is basically when the supply of a commodity increases or decreases due to change in price of that particular commodity. Okay, that is when the price of this digital pen will increase, then the supply of this digital pen will increase, and whenever the price of this digital pen will decrease, then the supply of this digital pen will decrease. So whenever the supply of a particular commodity increases or decreases due to increase or decrease in its own price, then that is called change in quantity supplied. Let's go through the supply schedule of good X. Here's the price of good X in rupees, and here's the quantity supplied of good X in units. So when the price of good X increases from 10 rupees per unit to 20 rupees per unit, then the supply of good X increases from 100 units to 200 units. So the supply of good X increases due to increase in price of good X, right? That is the increase in its own price. This is called change in quantity supplied. Whereas change in supply means the supply increases or decreases at the same price. That is when the supply of a particular commodity changes at the same price, then that is called change in supply. For example, if the price of this digital pen is 1000 rupees, okay, now the supply of this digital pen increases at the price of 1000 rupees, right? So the price of this digital pen remains same, but its supply increases. So that is called change in supply. Or let's suppose the price of this digital pen is 1000 rupees, but its supply falls at the price of 1000 rupees. That is, its supply falls without change in its price. Okay, then that is also called change in supply. So change in supply means when the supply of a particular commodity increases or decreases, but the price of that commodity remains same, then that is called change in supply. Let's understand it with the help of a supply schedule of good X. Here's the price of good X in rupees. Here's the quantity supplied of good X in units. When the price of good X was 10 rupees per unit, the quantity supplied was 100 units. And later on the price of good X remains same at 10 rupees per unit, but its supply increases to 300 units, right? So this is basically change in supply. Here you can see that price remains same. There is no change in the price of the commodity, but the supply of the commodity increases at the same price. So that is called change in supply. Okay. So let's recall it. See students, whenever the supply of a particular commodity increases or decreases due to change in price of that commodity, then that is called change in quantity supplied. Whereas when the supply of a particular commodity increases or decreases at the same price of that particular commodity, then that is called change in supply. Now let's recall it, change in quantity supplied. When the supply of the commodity changes due to changes in the own price of the commodity, then that is called change in quantity supplied. And change in supply, when the supply of the commodity changes at the same price of the commodity, then that is called change in supply. Change in quantity supplied, when the supply of the commodity changes due to changes in the own price of the commodity, then it is called change in quantity supplied. Whereas change in supply, when the supply of the commodity changes at the same price of the commodity, then that is called change in supply. Okay. So students, this is all about the meaning of change in quantity supplied and change in supply. Now we will go through the components of change in quantity supplied. See students, there are basically two components of change in quantity supplied. One is contraction of supply and the another one is expansion of supply, which is also known as extension of supply. Now let's understand what is contraction of supply. See, whenever the supply of the commodity decreases due to decrease in the price of it, okay, that is whenever the supply of the commodity falls due to fall in its own price, then that is called contraction of supply. Okay, let's understand it with the help of supply schedule of good X. Supply schedule of good X. Price of good X in rupees and quantity supplied of good X in units. So when the price of good X decreases from 10 rupees per unit to 8 rupees per unit, as a result of that, the quantity supplied of the commodity decreases from 100 units to 80 units. So this is called contraction of supply. Here you can see price of the commodity decreases by 2 rupees per unit and the quantity supplied of the commodity decreases by 20 units. So here there is a contraction of supply of 20 units of the commodity. Now students, let's understand it with the help of a supply curve. So here's a panel, here's the origin, here's the y-axis, here's the x-axis. On y-axis we will label the price and on x-axis we will label the quantity supplied. Okay, and here's the supply curve. Now students, let's suppose that the supplier is on point A on the supply curve. This indicates that the supplier is supplying OQ quantity of the good at the price OP. Okay. Now let's suppose the price of the commodity decreases. Now let's suppose the price of the commodity decreases from OP to OP1. Now at the price OP1, the quantity supplied would be OQ1, right? So here you can see when the price of the commodity decreases to OP1, then the quantity supplied of the commodity also decreases to OQ1, right? And as a result of that, the supplier moves to point B on the supply curve. So here it is the downward along the same supply curve. So downward movement along the same supply curve occurs in case of contraction of supply. So let's recall it. Contraction of supply. When the supply of the commodity decreases due to decrease in the price of it, then it is called contraction of supply. Now students, we will talk about the expansion of supply. Now expansion of supply is also known as extension of supply. Okay. Now what is this extension of supply or expansion of supply? Let's go through the supply schedule of good X. Supply schedule of good X. Here's the price of good X in rupees and here the quantity supplied of good X in units. Okay. Now let's suppose the price of good X increases from 10 rupees per unit to 20 rupees per unit. As a result of increase in price of good X, the quantity supplied of good X increases from 80 units to 100 units, right? So here what we can see is, here we can see when the price of good X increases by 10 rupees per unit, then the quantity supplied of good X also increases by 20 units, right? So here the supply of good X increases due to increase in its own price. So this is called expansion of supply. So when the supply of the commodity increases due to increase in price of that particular commodity, then that is called expansion of supply. Now let's have a look on the graph. Here's the panel. Here's the origin. Here's the y-axis. Here's the x-axis. On y-axis we will label price, and on x-axis we will label the quantity supplied, right? And here's the supply curve. Now let's suppose the supplier is on point A of this supply curve, which indicates that at the price OP of the commodity, the supplier is supplying OQ quantity of the commodity. Now let's suppose the price increases. The price increases from OP to OP1. Okay. Now at the price of OP1, the quantity supplied is OQ1, right? So here we can see when the price of the commodity increases from OP to OP1, the quantity supplied of the commodity also increases from OQ to OQ1, right? And the supplier moves from point A to point B on the same supply curve. So here is the upward movement along the same supply curve. So in case of expansion of supply, there is upward movement along the same supply curve. So let's recall it expansion of supply or extension of supply. When the supply of the commodity increases, when its price increases, then it is called expansion of supply. Next, now we are going to talk about the components of change in supply. Now there are two components of change in supply, and those are increase in supply and decrease in supply. Now let's first talk about the increase in supply. Observe the supply schedule of good X, students. Here's the price of good X in rupees, and here's the quantity supplied of good X in units. 10 rupees, 10 rupees, and the quantity supplied is basically 1000 units and 2000 units. Now here we can see that the price of good X remains same at 10 rupees per unit, but the supply of good X increases from 1000 units to 2000 units. That is, the supply of good X increases by 1000 units, right? So when the supply of a commodity increases at the same price of the commodity, then that is called increase in supply. Or you can say when the supply of a commodity rises at the same price of it, then that is called increase in supply. Basically, in case of increase in supply, the supply rises without increase in price of the good itself. Okay. So let's have a look. When the supply of the commodity rises at the same price of the commodity, then that is called increase in supply. Now let's have a look on the diagram. So here's the panel. Here's the origin. Here's the y-axis. Here's the x-axis. On y-axis we will label the price, and on x-axis we will label the quantity supplied, right? And here's the supply curve. Now let's suppose, students, the supplier is at point A on this supply curve. This means the supplier is supplying OQ quantity of the good at price OP. Now the price will remain same, that is OP, but at the same price the supply will increase, right? Let's suppose the supply increases to OQ1, right? But the price will remain same. So here we'll get a point, that is a new point, right? So a new supply curve will emerge in this case. So basically there is a shift of supply curve and there is rightward shift of supply curve in this case. So in case of increase in supply, there will be rightward shift in supply curve. So let's recall it, students. Increase in supply. When the supply of the commodity rises at the same price of the commodity, then it is called increase in supply. Next, now we will talk about decrease in supply. So before understanding decrease in supply, let's consider the supply schedule of good X. So here's the price of good X in rupees and here's the quantity supplied of good X in units. Price is 10 rupees and 10 rupees. The quantity supplied is 1000 units and 800 units. So students, here you can see that the price of good X remains same at 10 rupees per unit only, but the supply of good X decreases from 1000 units to 800 units at the same price, right? So this is called decrease in supply. That is, whenever the supply of a commodity falls at the same price of the commodity, then that is called decrease in supply. So here in this schedule, the supply of good X decreases by 200 units. Now students, we will understand this with the help of a graph. So here's the panel, here's the origin, here's the y-axis, here's the x-axis. On y-axis we will label price and on x-axis we will label the quantity supplied. Okay. Now students, let's suppose this is the supply curve and the supplier is on point A of this supply curve. This indicates that the supplier is supplying OQ quantity of the good at price OP. Okay. And as we know that in case of decrease in supply, supply decreases at the same price. Let's suppose now the supplier is supplying OQ1 quantity of the commodity, right? So, and at the same price, right? So, here we'll get the point. Here we'll get a new point basically. That is point B. And here's a new supply curve, which is denoted by S dash S dash. So, there is a shift in supply curve and there is basically leftward shift in supply curve, right? So, in case of decrease in supply, there is leftward shift in supply curve. So, students, you can see that in case of increase in supply and in case of decrease in supply, there is shift in supply curve, right? There is no movement along the same supply curve, but there is shift in supply curve. So, let's recall it decrease in supply. When the supply of the commodity falls at the same price of it, then it is called decrease in supply. Okay. So students, let's recall the effects on the supply curve. See, in case of change in quantity supplied, there is basically movement along the same supply curve. Movement along the same supply curve, right? And in case of change in demand, there is shift in supply curve, right? In case of change in quantity supplied, upward movement occurs. In case of expansion of supply. And downward movement occurs in case of contraction of supply, right? And in case of change in demand, rightward shift occurs in case of increase in supply. And in case of decrease in supply, there is leftward shift in supply curve. Leftward shift in supply curve in case of decrease in. Okay. So students, this is all about the change in supply and change in quantity supplied.